Welcome everyone. Hello and welcome for a marathon revision session of SCMPE. I'm sure we all are waiting for this subject for the last time, and we wish to study this for the last time. And I'm sure you have already prepared everything, but still, from our side, since we have promised you that we'll be there till the last day, I will revise the entire syllabus quickly, but covering all important points, so that you can refer to this whenever you need it. Okay, so let's get started with the first chapter. The first chapter is decision making. Of course, we can also call it as marginal costing. We can also call it as marginal costing. Now, you guys already know this chapter is divided into several parts. First part is absorption costing versus marginal costing. Second part is CVP analysis, cost, volume, profit, where you will be given the data and you will be required to find out break-even point, PV ratio, margin of safety, required sales and all that petty calculations. Then I generally consider key factor as a separate division where limiting factor is taken care of. We also have some small miscellaneous items like shutdown point, cost break-even point, point of indifference calculation. Then we will slowly, steadily move towards the major part, the main part, which is decision making part, where we'll have to go for relevant costing. In relevant costing, we'll be discussing several different types of questions like make or buy decision, whether to continue with the project or not, whether to discontinue, whether what, anything related to the project. Then you have some questions related to service sector, which are a combination of marginal costing and service sector costing. And then some special questions which have been asked in the past exam, plus which are important from the exam perspective. So guys, this is what we are supposed to revise in your chapter called as decision making. Now, it has been a trend since last so many attempts that the major part of your paper is based on theory subjects, theory chapters. Introduction to strategic management, lean system, performance evaluation and all that. Now, being a last attempt, I don't know why, but my gut feeling says it will not be 75-25, it can be 50-50 or even 60-40. They will probably increase proportion of practical questions. There is a possibility. I'm not giving you any guarantee, but then that's what I feel. That's what my gut feeling says. So we'll be revising this concept properly, then we'll be heading towards the next chapter. Okay, so what did we do in case of absorption versus marginal? Very simple it is. When you talk about absorption costing, you do consider fixed cost as a part of decision making. When you talk about marginal costing, your fixed cost is not considered for the purpose of decision making, because it is going to be constant irrespective of whether you take the decision or you accept the proposal or you decline the proposal or whatever. So, for absorption costing, in simple terms, just prepare cost sheet where your fixed overheads will be charged on the basis of absorption rate. So, calculate absorption rate first. Calculate absorption rate first by doing budgeted fixed overheads upon budgeted output calculation. Get the fixed overhead absorption rate, apply that in the cost sheet. You prepare cost sheet in this manner, you will get some profit. For marginal costing, sales minus variable cost, contribution minus fixed cost, profit is what we are supposed to do. Sales minus variable cost, contribution minus fixed cost is equal to profit, is what you are supposed to do. So, from revenue, you remove the variable cost of sales. Variable cost of sales means you prepare a cost sheet without considering fixed cost. You prepare a cost sheet without considering fixed cost, that becomes a variable cost sheet. That will give you variable cost of sales. So, you will take material, you will take labor, you will take direct expenses, you will find out prime cost. Then from factory overheads, you will consider only variable factory overheads. Even in all other expenses, you will consider only variable cost structure. You will get cost of sales. Now, since you have not taken into consideration fixed cost structure, that very cost of sales will be a variable cost of sales that you subtract from sales. You will be getting contribution, accumulate your fixed cost and reduce it from contribution to get profit. As far as JKC material is concerned, it is already covered in question number 1. So, you will get this solution completely in detail in question number 1. So, this was basically your absorption versus marginal costing chapter. Just have a glance on this, nothing else is to be done. Then second calculation will be CVP analysis. CVP analysis means, as I told you, just use some data, use some concepts and determine break-even point, margin of safety, required sales and all that. For that, you just need to understand how to get break-even point, how to get margin of safety. Now, I will not waste much time in that, because that part is quite, we have been doing this since CA Inter, okay. So, there is no point in discussing what is break-even point on the last day. I will not waste my time in that, but basically you need to recover your fixed cost and your per unit contribution is something that you are earning by selling 1 unit. So, if you want to recover fixed cost of 15,000, if you want to recover fixed cost of 15,000 and if your contribution per unit is 4, ideally 3750 units. Ideally 3750 units are required to be produced and sold, so that 3750 units if I produce, 4 rupees per unit is a contribution, 15,000 will be my total contribution, 15,000 will be my fixed cost to be recovered and my no profit no loss stage will arrive. Now, margin of safety is by what margin you are safe. So, the calculation is pretty simple. You have suppose produced 10,000 units in reality. Your break-even level is 7,000 units. Your break-even level is 7,000 units. That means to be at no profit, no loss, you have to produce and sell 7,000 units. You have produced 10,000, that means you are 3,000 units above the break-even point. That means you are quite safe. Even if you start reducing quantity by one unit, till 3,000 units, you will not be having any problem. So, your margin of safety is 3,000 units. It is a quantity that contributes directly towards profit, because break-even is something that contributes directly towards the cost. So, break-even gives you cost recovered. Margin of safety directly gives you profit. Directly gives you profit. So that is about your CVP analysis. In CVP analysis, you just need to be worried about one thing, just that one formula. Sometimes they will not give you complete data, like in question number 2, what we have done. This was CVP analysis, cost, volume, profit. They will give you sales and they will give you total cost. Now, if 22,23,000 is your sales and 19,83,600 is your cost, that means 2,39,400 is going to be your profit. And out of 24,51,000, if I am reducing 21,43,200, 307,800. 307,800 will be the profit. Now, this is what you need to understand. Difference in profit upon difference in sales will give you PV ratio. So, 307,800 minus 239,400 divided by difference in sales. And you will be getting PV ratio there. So, 68,400 is your difference in profit, 2,28,000 is your difference in sales into 100. So, 68,400 divided by 2,28,000 will give you PV ratio to be 30%. Pretty simple. Once you know your PV ratio is 30%, apply that PV ratio on any sales. 22,23,000 is your sales of the first year. Sales multiplied by PV ratio always gives you contribution of 6,66,900. Sales multiplied by PV ratio will give you contribution. From that contribution, you will subtract your profit for the first year, and profit for the first year, if you subtract, you will be left with fixed cost. So, ideally, you will be having PV ratio, fixed cost, sales, profit, everything, anything that is asked here can be calculated. It's going to be very simple. I am honestly not expecting such questions, but these concepts, applying PV ratio, finding out contribution directly, finding out PV ratio on the basis of sales of 2 years and profit of 2 years, you will require these calculations for your future decision making purpose. So, question number 2 covers your CVP analysis. You should revise question number 3 before you go for the examination, because this is very important. You should revise your question number 3, which is very important. So, we will be solving it now. A Limited makes and sells a single product, and the company's trading result for the year 20-something-6 are. Now, all figures are in 1000 for the year 20-something-6. Direct material cost, direct labor cost, overhead cost is already mentioned. Now, when you say overheads, they have not specified whether it is variable or fixed. That means definitely it is total overhead figure. Sales is given, profit is also made available. For the year 20-something-7, that means for the next year, we are anticipating reduction in selling price by 10%. We are also anticipating increase in quantity sold by 50%, inflation of direct material cost, and then price inflation as well as reduction in fixed overhead expenses. So, these are 5 changes which we are anticipating in the next year. So, we have been given data for 20-something-6. We have been given some changes for the year 20-something-7. It is also known that in 2020-something-5, overhead expenditure total 8 lakhs. So, please remember, your first information was related to the current year. Next data was pertaining to the next year. It is anticipated data. It is a change which is expected, and now suddenly they are going in the past. They are giving you information of the last year. During the last year, they have clearly said that overhead was totaled 8 lakhs, and total overhead cost inflation in 20-something-6 has been 5% more. So, your cost has gone up by 5%. So whatever you have incurred in 20 something 6 is already 5% more than what you had incurred in the last year. Plus production and sales volume have been more by 25%. Guys, that means, can I say your variable cost must have gone up first by 25% because there is a 25% rise in the volume, plus there is a 5% rise in terms of pricing. So variable cost will be affected because of quantity. Total variable cost, of course, will be affected because of quantity as well as price. But fixed cost will be affected only because of price. So 25% rise in the sales volume, production volume will not affect your fixed cost of the previous year. You are supposed to prepare a statement showing estimated trading result for the year 2020 something 7. You're supposed to find out result for 20 something 7. Calculate break-even point for 20 something 6 and 20 something 7 and comment on break-even point and all. Now, first of all, you don't have a clear data. We don't have breakup of this overhead figure. We'll have to first find out this breakup. What you can do is, you already know the total of the last year. So let the variable cost of 20 something 5 be X and fixed cost be Y. I'm assuming that last year variable cost was X and fixed cost was Y. Therefore, I can always say X plus Y is equal to 8 lakhs because they have clearly told us that last year the total was 8 lakhs. So I can clearly see this as equation number 1. Now there is a revision in the cost structure. So I would like to go for change in the variable overhead first. If last year it was X, there is a rise in the volume, quantity has gone up. So it will be 1.25x now. Last year it was X. Quantity has gone up by 25%, cost will also go up by 25%. So now it will be 1.25x plus there is 5% rise in the pricing. So 1.25 plus 5% rise is equal to 1.3125, never forget X, correct? Then you have revised fixed cost. As I told you, your fixed cost will not be affected because of change in the quantity. So fixed cost will go up only by 5%. So it will be 1.05y. So with this, now there will be a new equation, 1.3125 x variable cost, 1.05y. This revised cost structure you are calculating for the year 20 something 6, which is already mentioned in the question, and it is given to be 9 lakhs. And it is given to be 9 lakhs. Are you clear with it? Now you know the next part. You will multiply whole equation 1 by 1.3125 by 1.3125, and once you solve it, now I'm not wasting time in that, you will get value of y to be 5,71,429, and if you substitute this in the equation, any equation of your choice, it will be 2 lakh, x value will be 2,28,571. So this is your variable cost for the last year, this is your fixed cost for the last year. So for 20 something 6, variable cost is 1.3125x. So that comes to 3 lakhs. Since the total is 9, ideally fixed cost should be 6, but still we'll verify the work. We'll verify the answer. 1.05y, y is 571,429. 571,429, 1.05, 6 lakhs. I hope your total tallies with 9 lakhs now. I hope you guys are clear with it. Now at this stage, you are ready with the data. At this stage, you are ready with the data. You know the cost structure of 20 something 6, you know the cost structure of 20 something 7. What is asked in the question first? Prepare a statement showing estimated results for 20 something 7. Okay. So since we have clear data, for the year 20 something 6, we can directly go for the cost structure. So I'm going for statement of profit. 20 something 6 will be my base here. 20 something 7 is something that is asked in the exam. Sales minus cost. When I say cost, I have material, labor, variable overheads, fixed overheads. I'll get the total cost here and then I can find out profit. Okay, let me first complete the data for 20 something 6. 3916. Breakup of variable cost and fixed cost we have already got, bachcha log. So 24 lakhs is the total cost. Sales will be marked as 1, total cost will be marked as 2, profit will be 1 minus 2. Profit is going to be 1 minus 2. So that comes to 6 lakhs. Correct? Now, if you want to show it in a marginal costing format, you are free to do that. 30 lakhs minus 18 lakhs, 12 lakhs will be your contribution, 6 lakhs fixed cost. The final profit has to be the same. And then we have to incorporate changes now. This is anticipation for the next year. Selling price going down by 10%. 30 lakhs is your sales minus 10%. Now your revised sales will be 27 lakhs. But then they have also said that there is a rise in the quantity by 50%. So again it will go up by 50%. So 40 lakh 50,000. Now don't worry about the chronological order. 30 lakhs plus 50% minus 10% will also give you the same answer. Are you getting me? Yeah. So 30 lakhs minus 10% fall in selling price plus 50% add because there is a rise in the quantity structure. Then you have material. Material cost is going up by 8%. Material cost is going up by 8%. 9 lakhs goes up by 8%. 9,72,000. And please remember, there is a rise in the quantity by 50%. If there is a rise in the quantity by 50%, material cost will also go up by 50%. Your quantity rise of 50% will affect these 4 structures, and plus their individual change will give you the answer. Labor cost. Labor cost, they have not specified. So labor will have only one effect, only quantity effect. 6 lakhs is a cost, 50% up. 9 lakh will be the revised cost. Variable overheads, 3 lakhs is the cost, plus 50% is bound to be there. By what margin variable has gone up? Price inflation by 6%. So additional 6% will take your cost to 4,77,000. Now let's talk about fixed cost. Your fixed cost is 6 lakhs. It is going down by 25%. Trust me, it has got nothing to do. This will not have any impact of quantity rise. So 6 lakhs minus 25%, 4,50,000 will be your fixed cost. So 4,50,000 fixed cost, 4,77,000 variable portion, 9 lakhs and 1458, 32 lakh, 85,000. So 7,65,000 is going to be your revised profit. You understood all these changes. Of course, in the classwork, we have done it in a much detail. We have prepared working note also. But since this is a revision, you must have done that calculation. I'm not focusing more on that right now. Okay. Working note part, you have seen my presentation. Every new figure which is generated is an outcome of working note. So we prepare working note accordingly. Since this is a revision, we are doing it directly. So that was your first part of the question. That was your first part of the question. Second part, break-even point for 2006 and 2007. Break-even point for 2006 and 2007, and then comment on break-even point. Listen, that was again a simple part. Sales minus variable cost gives you contribution. Fixed cost upon contribution into sales for both the years. If you do, you have fixed cost. You can find out contribution. Sales minus variable cost will give you contribution. You can easily find out break-even point, and fixed cost upon contribution into sales will give you break-even point of both years. So that was again a CVP analysis, cost volume. This was important part, so that is the reason why I solved it. They gave you data of 2006, 20-something 6. They gave you anticipation, some change into 20-something 7, and they gave you base data for 20-something 5. So on the basis of 20-something 5, we found out the real breakup of 20-something 6, which is used to find out cost structure of the next year. Remember, quantity rise will affect sales, variable cost, material, labor, variable overheads. Price rise will affect all. Clear? So, next is you were supposed to comment. Now see, your PV ratio has gone down, still your break-even is maintained, because your fixed cost has also gone down. This is what you were supposed to comment on. Your fixed cost is going down, your contribution is going down, your break-even point is same. Some 15 lakhs you will get as an answer. Break-even point will be 15 lakhs for both the years. How come it is same? Array, your earning capacity has gone down because of the fall in the contribution, that is fine, but your fixed cost has also gone down. So it has given a counter effect, and your break-even is same. This is what you were supposed to comment in the next part. So that was again CVP type question to be considered. With this, we have taken care of this and this. Now the next concept we are supposed to discuss is point of indifference, which is also called as cost break-even point. See, whenever you have two options, option 1 and option 2, any one is to be selected. Now, if you select option 2, your variable cost goes down, but your fixed cost goes up. So, if you try to save variable cost, option 2 is better, but then there will be rise in the fixed cost. If you try to focus on fixed cost, you would like to go for option number 1, but in that case your operational cost, your variable cost increases. Now, in that case, we will have to find out the point of indifference, the level of activity at which both the options are costing you the same thing, same amount. So, for that, there was one question, question number 5. This was your cost break-even point, which is also known as point of indifference. It clearly says for 100 copies, you are currently spending 140 on machine A, 70 on machine B, 40 on machine C. Material cost and labor cost total is getting reduced from 140 to 70, from 70 to 40. That means variable cost is saved if you go from A to B and B to C. But then your fixed cost increases. Your fixed cost increases due to that change. So, it is quite simple. Between A and B, if I talk about machine A and machine B, I am saving 70 rupees. But to save 70 rupees per unit or per 100 copies, for saving 70 rupees per 100 copies, I will have to bear an additional cost of 28,000. So, ideally 400, and this was for 100 copies. So, I would say 40,000 is my cost break-even point or point of indifference of machine A and machine B. Machine B and machine C, if I talk about, my variable cost goes down by 30 per 100 copies, that means 0.3 per copy. But then my cost increases by 42,000. So, my saving of 0.3 per unit will be utilized. My saving of 0.3 per unit will be utilized to recover my extra fixed cost of 42,000. That means the real benefit will start after 1,40,000. So, if I talk about A and B, 40,000 is the point of indifference. If I talk about B and C, 1,40,000 is my point of indifference. That means if I talk about A and B only, where my point of indifference is 40,000, if there are 40,000 cases, whether I go for A or B, it doesn't matter. But if my cases are more than 40,000, level of activity is high, revenue may be high, higher fixed cost can be taken into consideration. Option with a higher fixed cost can be selected because you have a high level of activity. But if your level of activity is low, your revenue is going to be low, you keep your fixed cost less. So, machine A will be preferred. Machine A will be preferred when you have cases less than 40,000. Machine B will be preferred if your cases are more than 40,000. And at 40,000, of course, you can go for A as well as B because cost is same. But if you talk about machine B and C, C is having a higher fixed cost. So, if my level of activity crosses, if my number of cases crosses 1,40,000, option C is wonderful because higher level of activity, higher will be the revenue, higher fixed cost can be afforded. And if you talk about A and C, actually it is of no use, it's somewhere in the middle. If you talk about ANC, you will end up spending 100 rupees per 100 unit. That means you are saving 1 rupee per unit. But for that, you are spending 70,000 more. So, point of indifference is 70,000 cases between A and C. Now, when you come across this, first of all, the middle part is not to be seen. The lowest is 40,000, the highest is 1,40,000. The lowest is 40,000, the highest is 1,40,000. Machine A is the best one if the level of activity is less than 40,000. Machine C is the best one when the level of activity is more than 1,40,000, and between 40,000 to 1,40,000, machine B is better. So, don't go for something which is lying in the middle. Take the lowest segment, take the higher segment, lower segment will be considered as a base. Machine A, if I am below even the lower segment, machine C is the base with the highest fixed cost for the highest level of activity. And meanwhile, from 40,000 to 1,40,000, B is anytime acceptable, because when it comes to A and B, B is better from 40,000 onwards. And when it comes to B and C, B is better till I reach 1,40,000. So, don't focus on something in the middle. Just focus on the least and highest activity, and you can solve these questions. So, that was about cost break-even point of indifference. Then there can be a shutdown cost concept, shutdown point. Where you temporarily shut down your business for a temporary period of time, you are not permanently closing it. So, as per this question, 2 lakh per annum is the quantity manufactured so far. Material 7.80, labor 2.10, variable overhead 2.50. So, fixed overhead is 4, product cost is 16.40. Each unit has a selling price of 21. So, this is selling price. This is variable cost. So, 7.8. So, 21 minus 12.4. 12.4 is your variable portion. 21 minus 12.4 is going to be your contribution, but then apart from that, they have also said variable selling cost is 0.60. So, 12.4 plus 0.6. So, 13 per unit will be your revised variable cost structure. So, 21 minus 13, 8 per unit is your contribution right now. During the next quarter, only 10,000 units can be produced and sold. Okay, first of all, this calculation was done, this 4 rupees per unit calculation of fixed cost was done on the basis of 2 lakhs. That means definitely your annual fixed cost is 8 lakhs. 4 per unit was given to you based on 2 lakh units. So, your annual fixed cost is 8 lakhs. Since they are talking about 1 quarter, my quarterly fixed cost will be 2 lakh rupees. So, guys, ideally 2 lakhs divided by 8. Can I say 25,000 is my break-even point? 25,000 is my break-even point. My demand for the next quarter is 10,000. So, I am going below break-even point. So, the plant is, the company plans to shut down the plant. The company is planning to shut down the plant. If we shut down the plant, the fixed manufacturing cost will be reduced to 74,000. Let me see, right now my fixed cost is 2 lakhs. If I shut down the plant, it will be 74,000. That means, boss, in any case, 74,000 has to be incurred by me. I don't have a choice. 74,000 has to be incurred by me. I don't have a choice. Now, Apart from this, they have also told you shutdown cost is 14,000, cost of shutting down. That means you shut down the machine now, so after 3 months you will restore machines. So you'll have to undergo overhauling, servicing, maintenance of the machine. All these extra expenses to restore the plant is 14,000. So if you shut down, ideally 74,000 plus 14,000, 74,000 plus 14,000, 88,000 must be your 88,000 must be your fixed cost. Any which way you're going to incur. You continue, your fixed cost will be 2 lakhs. You shut down, still your fixed cost will be 88,000. But still you are saving 1,12,000 somehow. Correct? So 88,000 is unavoidable fixed cost. 88,000 is unavoidable fixed cost. That means 1,12,000 can be avoided. Now the question is asking you, what is the shutdown point? Shutdown point is the quantity which indicates that you can continue with the production. There is no need to shut down. So 1,12,000 I am incurring additionally if I continue. 1,12,000 I am incurring additionally if I continue at the rate of 8 rupees per unit. If I want to earn 14,000 units at least should be sold. Now if my quantity is going even below 14,000, you should shut down. If your quantity is 14,000 and more, you can still continue. Because see, ultimately this is your loss which cannot be avoided. 88,000 is your loss which you cannot avoid. But balance 1,12,000 you can avoid by producing 14,000 units. So even if you produce 14,000, your 1,12,000 will be recovered and 88,000 will be your loss, which is any which way going to happen. Like if I talk about the overall structure, what we discussed was direct. Okay, if you want to calculate things directly, then if we continue, $10,000 units into 8 per unit, 80,000 will be the contribution. 2 lakhs will be the fixed cost and my loss will be 1,20,000. If I shut down, there will not be any quantity, so your contribution will be nil. Shutdown cost is 74,000 unavoidable fixed cost plus 12 to 14,000 your shutdown expenses. So your loss will be 88,000. So it is always better to shut down the plant if you are producing 10,000 units. If you are supposed to calculate it directly, we have already done that. 14,000 was my shutdown point. So at 14,000, I am recovering, see, if I take 14,000, 14,000 into 8, 14,000 into 8, I am getting contribution of 1,12,000 minus fixed cost of 2 lakhs is giving me loss of 88,000, which is any which way going to happen. Now, if I am going even below 14,000, my loss is more, which I don't want. For that, you just have to calculate things directly. For that, there is a very simple formula which is being given. Of course, we don't study formula based, so that is why I explain the logic to you. It is avoidable fixed cost of divided by contribution per unit. So at least I can recover salary of my staff. I can retrench them. That is, it is avoidable. I can surrender the premises also. I can save the rent also if I shut down. So if you are recovering that cost, there is a point in continuing. Otherwise, you shut down. So that was your shutdown point. There is one more special question on shutdown point, which we will be discussing now, which is question number 21. Shutdown point. Hotel Nico, Zealand, an affordable leisure hotel resort, is an ideal retreat to escape, unwind, and enjoy peace of mind. Set amid expansive tropical greenery in the enclave of Zealand, Hotel Nico is designed for pleasure and where services reign supreme and Italian-style architecture of its 25 classic rooms harmonize with the nature. Hotel Nico, Zealand, okay, they have given you some information. Let's come back to the point. We don't have time. We are charging Zealand dollar 2,700 per room per night. So that is a fare. So between you and me, it is a selling price only. Variable cost is 900. Variable cost is 900. The Nico is available throughout 365 days in a year and has 75% budgeted occupancy rate. Fixed cost is 9 million, which is incurred evenly throughout the year. During the second quarter, usually room occupancy remains substantially below the level expected at other quarters for the year. Nico is expecting to sell 900 occupied rooms. So in this quarter, our sale is going to be 900 rooms. The management is considering strategy to improve the profitability. See the chart. See, it goes this way. The change is your fixed cost is going to be 12 lakhs. Your fixed cost is going to be 12 lakhs. From 9 lakhs, it is going up to 12 lakhs. Okay, from 9 million, it is going up to 12 millions. Okay, and this is occupancy. Now, if you see, every 2 blocks is 1,500, another 2 blocks 1,500. This is also 1,500, but now there is only one block here. So that is a block of 750. So you understood, till here it is 7,500 plus this is half block. This is one block. 2 blocks are 1,500. So half block, half of it, not half block, but half of it is going to be 750. So the data is given for 8250. The data is given for 8250. And now we are supposed to find out, we are supposed to decide profit improvement plan. Now see, 2,700 is your selling price and 900 is your variable cost. So 1,800 is your contribution per room per night. If your occupancy is expected to be 900, 16,20,000 will be your collection, will be your contribution. Now that shows that your entire profit will go down by 16. Your entire profit will be going down by 16,20,000. So if we shut down, revenue from these 900 rooms will be lost. Currently, you know that 900 rooms will be occupied. If you decide to shut down, that means these 900 rooms will not be occupied. So whatever contribution I would have earned by renting those 900 rooms will not be earned. So that is your loss of profit. You are sacrificing your remainder contribution of 16,20,000. After that, you have one more option, of course, and even during shutdown, there are other problems also. You may not get the employees again. That may spread a wrong news about your management, about your company, your investment. Your investors may get affected because of all this. Your supplier will stop giving you benefits which they were offering earlier because you were buying on a regular basis. Some discounts and all will be eliminated now. So these are other non-financial factors. Financial factor is my contribution goes down by, my contribution will be lost to the extent of 16,20,000. My fixed cost is not going to be same. In fact, it is going to be more. So there is a loss of contribution if I shut down. And the other plan given by them is 30 million is your revenue of 8250. I hope you got how 8250. Two blocks are 1500. Till here we have 7500 and one block is remaining. Two blocks is 1500, one block will be 750. So the current total level of activity is 8250. So 30 million divided by 8250, 3636.36 is your selling price, or you can say revenue per room per day. Your total cost is 23.75, your fixed cost is 12, that means 11.75 million is your variable cost. That will be divided by 8250 and I get 1424.24 as my variable cost structure. I hope you understood this. My total is this, my fixed is this, so balancing figure, the balance is, the difference is variable portion. The difference is variable portion. When I subtract it from 3636.36, I get 2212.12 contribution per room per night. Are you getting me? Now, how much is the occupancy expected? 75%. So, there are 25 rooms, 75% will be occupied for 365 days. 6843.75 was the total occupancy, but now they have clearly said, because of that Italian restaurant and all, their expected occupancy is 7310. Their expected occupancy is 7310. So 2212.12 will be multiplied by 7310. 16.1705 million will be your total contribution minus 2. 4.17 million will be your contribution. So around 41 lakh rupees, 41 lakh 70,000 rupees will be your profit, ultimate profit. So I think we should go for it because it is increasing our profit. In this, we calculated shutdown point also. Many students had a problem in understanding how did we get 8250. So that is why I am discussing this. This is projection, 30 lakh sales for 8250. Your anticipated occupancy is 7310. Okay, so from selling price, we deducted variable cost per unit. We got contribution per room per day. Total room days will be, total room nights will be 7310. So that gives me total contribution here. I subtracted fixed cost and finally I got a profit figure, 4.17 million approximately. This is what you were supposed to present. So it is better to keep it open along with the new structure because your profit will be more. Your profit is going to be more. Currently, your profit is less. So, as per 6844, you must have calculated the original profit. 25 rooms into 75% into 365 days. If I consider 6843.75 was the occupancy and your old contribution rate was 1800. Your fixed cost was 9 million. So earlier your profit was 3.31 million, which is going up to 4.17 million. So there is a rise of around 8.5 lakhs. So this is what we were supposed to do in this case. So with this concept of shutdown point, we have also covered special questions. Now I'm heading towards key factor. Now, key factor means limiting factor. Whenever your resources requirement is more but availability is less, there is a scarcity created. In that case, that resource will be called as key factor. Like you need more number of hours, but your number of hours are restricted. If you need more kgs of raw material, but your number of kgs available is restricted, that material and that labor will be considered as limiting factor. And all your decisions are taken on the basis of that limiting factor. So for that, there is a standard procedure available. You somehow calculate cost per unit of the product. Then you find out quantity of the limiting factor for that product. Now, I'm assuming that number of hours is a key factor. So try to find out how many hours are required for each unit. Suppose if you are dealing with 3 different types of products A, B and C, and the contribution per unit is 50, 80, 90, you may get a feeling that C is the highly profitable one. Then you try to find out how many hours are required. You try to find out how many hours are required. Hours is a key factor. Number of hours per unit for each product is required to be found out. Then we found out that 1 unit of A requires 1 hour, 1 unit of B requires 2 hours, 1 unit of C requires 3 hours. So ideally, this says that if you work for 1 hour, you can produce 1 unit, and that 1 unit can give you 50 rupees. So naturally, that 1 hour contributes straight away 50 rupees towards the production, towards the earnings. Here you work for 2 hours and you produce 1 unit, and that 1 unit gives you 80. So ideally 1 hour gives you only 40 rupees, and here 1 hour gives you only 30 rupees. 1 hour gives you only 30 rupees. So ideally, if you see the ranking part, rank wise, this is the first rank, this is second rank, this is third rank. So don't look at contribution per unit, focus on contribution per unit of key factor. If number of kgs were limiting factor, I would have gone for kgs per unit. Suppose 1, 2, 3 kgs are required. Then in that case, this would have been contribution per kg, and we would have got the ranking done. Now, since your time is a limiting factor, you will utilize your time in such a manner that your highly profitable product will be produced first, followed by the second, followed by the third one. So use your time for A. If thereafter some time is left, use your time for B. If there is any time left, even after that, use it for C. In that case, you will not be able to fulfill the 100% requirement of C, but something can be produced and sold. So we will be solving one question based on this, which will cover your whole concept here. Question number 16. Says Limited produces 3 products SQL, which use same resources but in varying quantities. Product S uses 1 unit of component P, which is purchased from outside suppliers at 120 per unit. So we are using component P, we are using material P, which is purchased at 120 rupees. Annual demand is also available for 3 products. Then we have selling price, we have cost structure. For S, you need component P. For producing S, you need component P. So 120 is the material cost, which is considered first. Then you have direct material. Direct material cost is given to be 8 rupees per kg. If it is 8 rupees per kg, and if you have spent 24, that means 3 kgs, 4 kgs, and 3 kgs must be the consumption part. At the rate of 40, if you have incurred 20, 60 and 40, that means the requirement is 0.5 hours, 1.5 hours and 1 hour. Unskilled labor at the rate of 24, if you are spending 18, so it will be 0.75 hours, 1 and 1.5. 0.75 hours, 1 and 1.5. Variable overheads are 6 at the rate of 6 rupees per machine hour. At the rate of 6, if you are spending 18, 24, 24, that means 3 machine hours, 4 machine hours, 4 machine hours is the requirement. Your annual fixed cost is given in a combined manner, 15 lakhs. maximum availability of skilled labor is 16,200 hours. So guys, it is pretty clear that we have skilled labor as a limiting factor. So I am interested in knowing a number of hours required only for skilled labor. Since the question says skilled labor has a limiting factor, I am interested in skilled labor only now. Engineering division of company came forward with a proposal to make the component P in-house with the following cost breakup. Instead of buying P for 120, what you can do is you can produce P for 90 rupees. For in-house making of product P, it will not be any change in the annual fixed cost of the company. So fixed cost remains same. So if fixed cost is not going to change, fixed cost doesn't matter to me, fixed cost is not considered for any decision making. Now, as far as limiting factor is concerned, we already know skilled labor is limiting factor. So I need to focus only on skilled. 40 rupees per hour is the rate. At the rate of 40, if you are spending 40, that means component P requires 1 hour to get manufactured. So guys, your skilled requirement is 0.5 hours, 1.5 hours and 1 hour, right? When you produce SQNL, now to produce S, you are buying P. If instead of buying P, if you start producing P, you will have to spend 1 more hour on P. So can I say your S will now take 0.5 as well as 1.5 hours, 1 hour to produce P and then 0.5 hours to produce S. So your S will take 1.5 hours if you produce P in-house. If you are buying P, it will take only 0.5 hours, but you will have to pay 120 instead of 90. Okay, you understood the scenario? Now, the company can either buy component P or make it in-house. Recommend the optimum production plan and profit for the year. Show calculation in support of your answer. Okay. So you already have number of hours with you. Okay. Now we'll have to see profitability of P if it is purchased. We have two options: profit, purchase, produce. Purchase P, consume it for S. Produce P, then consume it for S. Let's go for the first option. Option 1. Buy P. Buy P. I'll first find out contribution and I'll decide ranking. Statement of contribution and ranking. If I am buying P, I have 3 products S, Q, L. I do have selling price of all 3. $310, $275, $224. $310, $275, $224. As far as variable cost is concerned, we are just supposed to take the total. So this is 120 plus 24 plus 20 plus 18 plus 18. So this is 200. $32, $60, $48. So this is 200, this is 140, and the next one is 124. 200, 140, 124. So 110, 135 and 100 is my contribution per unit. Since skilled labor is a limiting factor, I need to know number of hours of skilled labor, which we already discussed, 0.5, 1.5 and 1. I have textbook with me, so I'm picking up data directly. I'm not changing screens. Okay. Contribution per hour will be 110 divided by 0.5. 0.5 hours give you 110. 1 full hour will give you 220. This will give you 90. This will give you 100. So if you talk about rank, it is 1, 2, 3. Correct? So now we'll have to go for statement of optimum mix. Now we'll have to go for statement of optimum mix. How do we go about it? Very simple. You take different types of products first. Find out how much is a quantity to be produced. Find out number of hours required of skilled labor. That will give you total hours. So, as per the priority, S will be given the first priority, followed by L, and if time permits, I will go for Q. Now, requirement of S is 9,000, L is 7,800. S is 9,000, you need 0.5 hours to produce S, so 4,500 hours will be utilized. You have total 16,200 hours. Out of that, 4,500 hours are utilized for S. 7,800 is a requirement of L, which will take 1 hour. So another 7,800 hours will be allocated to L. So 7,800 hours, 4,500 hours, 12,300 hours are gone out of 16,200. So I am left with only 3,900 hours. Hold on. I can produce Q. Remember, Q is not a loss-making one. Q is also giving me profit. Since it is lesser than what we were generating from S and L, we have kept Q as a last priority. So 3,900 hours are left with me at the rate of 1.5 hours per unit. $2,600 is my quantity required. This is what my statement of optimum mix is. I hope you are understanding this. First priority S, done. First priority S. Second priority L. So I could produce entire quantity of L. My demand for Q was 5,700, but I did not have much time left. So at the rate of 1.5 hours, available 3,900 hours will be utilized for producing 2,600 units of Q. Now, I just need to know the profitability. Now, for profit, there is no need to start with the sales and variable cost, we can directly pick up contribution as a base because we already have this amount with us. SQL 9,000. Guys, be very careful when you write this. In the statement of optimum mix, you have SLQ. Now you are writing SQL as per the given in the question. So please make sure that you are picking up right quantity of Q and L. You already have contribution per unit 110, 135, 100. 110, 135, 100. So if I take the total of this will be 21,21,000 contribution minus fixed cost. How much is the fixed cost given for you? 15 lakhs, I suppose, if I'm not wrong. Annual fixed cost is 15 lakhs. So 21, 21, 000, 6,21,000 is your profit right now. So if you decide to buy P, this is going to be my profit. So now I have option 2. Produce P. Now guys, if you produce P, your number of hours required, revised hours for S will be, first of all, you'll have to spend 1 hour to produce P and then 0.5 hours to produce S. So S will now take 1.5 hours. S will now take 1.5 hours. So if I go for statement of contribution and ranking, I'll have to start everything with a scratch. S Q L. Guys, we already have contribution per unit here. But wait. This 110 was when you are buying material P at 120. You have decided to produce it for 90. So can I say you are saving 30 rupees there? So 110 plus 30. Your revised contribution per unit will be 140, then 135, and then 100. I hope you are understanding this. Instead of paying 120 to buy, you are spending 90 to produce. Your cost went down by 30 rupees. Naturally, contribution will go up by 30 rupees. This will be divided by number of hours per unit, and your number of hours per unit will now be 1.5 hours for S, 1 hour for producing P, we calculated that in the textbook itself, 1 hour for producing P and 0.5 hours for producing S. So instead of 0.5, it is 1.5. For Q and L, there won't be a change. So your contribution per hour, 140 divided by 1.5. So it's going to be 93.33, 90 and 100. Again, if I talk about the rank, it is 1, 2 and 3. Now suddenly it has become L, S, Q. So your optimum mix will also be different. Optimum mix means the combination which gives me maximum profit. The combination that gives me maximum profit. L, S, and if the need arises, Q. So I will first go for 7,800 units of L. Are you remember the format? No. 7,800 units of L. You need 1 hour to be spent on that. So 7,800 hours will be utilized out of 16,200 for L only. Then I have 9,000 units to be produced. Don't write. If I produce 9,000, 9,000 into 1.5 will require a huge amount, huge number of hours. You don't have that much time. You understood this. So out of 16,200, you are left with 7,800. So you are left with only 8,400 hours. So first of all, Q is out of question. In 8,400 hours, at the rate of 1.5 hours per unit, (5,600) units can be produced. So 5,600 units of S and 7,800 units of L. Q is not produced because we did not have enough time. Contribution per unit revised 140 for S and 100 for L. It is revised only for S. So your total contribution will be 15,64,000. Fixed cost to be deducted is 15 lakhs. Your overall contribution will be only 64,000. Bachcha log. That means it is an indication that you should not produce P. You should buy P. The first option was better because it was giving me more profit. So that was your key factor. This is what you're supposed to do. Let's move towards the next part. And the next part is about, see, key factor we finished. Now I'll be starting with this one, relevant costing, which is very important. Now the next concept that we are going to start is relevant costing. Relevant costing is basically used for decision making. Now whenever you take a decision about launching a product, discontinuation of product, starting with a new branch or curtailing one of the branches or one of the divisions, your decisions are always dependent on profitability. Either your profit should be more or your loss should be minimized. Sometimes if there is no profitability, then there should be a cost savings. If I'm going to save some cost by implementing one of the options, I would prefer going for it. So relevant costing, when I talk about, there is a simple chart, simple table you're supposed to make. It is going to be statement of relevant loss or statement of relevant gain. If you are getting a gain in the calculation, you accept the proposal. If there is a loss in the calculation, you decline the proposal. And it goes this way. You start with relevant revenue. Relevant revenue minus relevant cost will give you either gain or loss. And what do you mean by relevant revenue? Relevant revenue is the income due to acceptance of the proposal or expenditure saved due to acceptance of proposal. Like for example, by accepting the proposal, I'm going to get 10,000. It's my relevant revenue. By accepting the proposal, if I'm going to save my 10,000, that is also considered as relevant revenue. Amount earned or outflow avoided, both will be treated as relevant revenue. And relevant cost means money to be spent, like expenditure to be incurred on acceptance of the proposal or your inflow sacrificed. So if I have a property on rent, I'm getting 50,000 rent per month. I'm starting a new venture for which I'm going to use that property as my office. That means I'm going to sacrifice my rent of rupees 50,000. That is considered to be my relevant cost. Revenue earned, expenditure avoided is relevant revenue. Expenditure incurred, revenue sacrificed will be treated as a relevant cost. Now, when you do the calculation, you need to understand a few cost structures, whether they are relevant or not. If your cost structure is getting incurred, anyhow, whether you implement a proposal, you don't implement a proposal, whether you implement 50% of the proposal, whether you implement 200% of the proposal, your cost is any which way getting incurred. That cost will never be considered as relevant cost. Relevant cost is something which is incurred by you exclusively, deliberately, precisely, distinctively, specifically, motivatively, particularly by accepting the proposal. And that is why fixed cost is generally not considered for all these calculations, all this decision making, because whether you produce the product, you don't produce the product, fixed cost will be incurred anyhow. But if there is an additional fixed cost precisely for acceptance of the offer, then in that case, that fixed cost has to be considered as a part of calculation. That fixed cost will be considered as a part of calculation. Are you getting me? So, relevant revenue minus relevant cost will give me either relevant gain or relevant loss. If there is a gain, we'll accept the proposal. If there is a loss, we'll decline the proposal. If there is a cost which is already incurred, which is a sunk cost. If there is a cost which is already incurred, which is a sunk cost, like whether you have already incurred that cost, then that cost is also not considered to be relevant. Anything that is incurred, anything that is earned because of the proposal, anything which is avoided because of the proposal is relevant. So, let us talk about material cost first. Now guys, whenever we talk about material, there are two types of scenarios possible. One is your material is not in stock. One is your material is not in stock. If your material is not in stock, that means you will have to buy the material specifically for executing the proposal. If your proposal requirement is 1 lakh kgs of raw material, and if you don't have 1 lakh kgs with you, that means entire 1 lakh kgs needs to be purchased. Then in that case, the current purchase price cost is relevant cost for us. But if you have material in stock, but it is of a regular use, so if it is not used for the proposal, it is any which way getting used in my factory. So it is of a regular use, it is used regularly, it is not specifically meant for this project. Now I have material in stock. Ideally, even if I don't accept the proposal, the same material can be used for my routine production process. Now in this scenario, if I am using this material for the proposal, there is a shortage created here. I am having 50,000 kgs of stock. I am having 50,000 kgs of stock which is regular in use. Out of 50,000, 10,000 is getting used for the proposal. If out of 50,000, 10,000 is getting used for the proposal, for my routine production process, for my general production process, only 40,000 will be available to be consumed. So if you need more, you will have to buy more. So it is as good as, since the shortage is created because of consumption on proposal, the shortage will be fulfilled by buying the material again. So it is as good as you are paying for the fresh material. You are having 50,000 which was purchased for 10 per kg. Now, since you have already purchased at the rate of 10 per kg, 50,000 kgs we have already consumed at the rate of, already purchased at the rate of 10 per kg. 5 lakhs is not an important cost for me. It is not a relevant cost for me. It's a sunk cost for me. Why sunk cost? Why sunk cost? because I have already incurred that cost. Now, out of 50,000, if I am using 10,000 for project, special offer, for my routine consumption, I will have to buy another 10,000. So, it is as good as I am buying 10,000 for the fresh lot, and that is why current purchase cost is important. And that is why current purchase cost is important. What if I have material in stock, which is a special stock? Special stock means it was a specific stock, which was a special stock. It was a specially required quantity or quality, which was a specially required tailor-made manufactured product, which is available with me, which was used earlier in some production process. Now I'm having that in my stock. If I'm using that stock, then there are two types of scenarios. I have some special stock which is useless. Once in a while, I had got some offer from the local minister. He told me to produce something for him with a specified fabric and all that. So, I purchased a specified fabric. Out of that specified fabric, 90% is already consumed, 10% is left with me. The offer is over, the matter is solved. Since it was a special offer, I don't accept the same order to be received on a frequent basis, right? So, in that case, if 10% is still with me as a stock, there are two scenarios, either that will be useless or that will be useful. Guys, if it is useless, again there are two different types of scenarios. It is useless and there is no sellable value available. Neither there is a disposal cost, neither you're going to earn anything, nor you're going to spend anything on that. Then the entire calculation is immaterial for us. It has got no disposal cost, it is an irrelevant cost for us. But I have some 10,000 kgs with me. I purchase 1 lakh kgs of specially required stock. I consume 90 kgs for my customer. The customer is gone, finished goods are produced, customer is happy, customer paid me everything. Now I am having 10,000 kgs with me lying in my warehouse, which was purchased exclusively for that previous offer. Now, in order to dispose that 10,000 kgs, I have to pay 5,000 rupees. Now, in this scenario, I have a stock. In order to dispose that stock, I have to spend 5,000. In this scenario, if I am getting an offer where that 10,000 can be used, can I say I am saving my disposal cost of 5,000 rupees? Can I say I am saving my disposal cost of 5,000 rupees? If my disposal cost of 5,000 is saved, that means it is relevant revenue for me. So, disposal cost saved is a relevant revenue. 10,000 kgs were with me. Neither I am earning anything nor I am spending anything. The entire structure is irrelevant. But if I am having some special stock which is required to be disposed for 10,000 rupees, and if I am using it for the proposal, I am no longer supposed to spend 10,000 on disposal. So, that 10,000 expenditure, outflow avoided will be considered as relevant gain, relevant revenue. Now, you have stock which is useful in nature. You have stock which is useful in nature. In that case, it will be valued at the usable value of the stock and the buying cost, whichever is lower. Usable value and buying cost, whichever is lower. Why so? Suppose if the value of the stock is 10 and if it is available in the market for 12, I already have something in stock which is not frequently used, which was a special order, which is not required to be used on a regular basis. It was purchased for some specific offer, it is still unutilized. That is why it is there with me as a stock. If this is not utilized anywhere, then it is useless, having no disposal cost at all. But if it has a value, if I can use it somewhere, I can save 10 rupees. If I am using it somewhere, I will save 10 rupees. But if I go and buy it from the market, I will have to pay 12 rupees. Then I will definitely use this for 10 rather than spending 12 rupees. No? The value is 10, why would I spend 12? What if the value is 10 but it is available in the market for 8? See, the value is 8. The stock which I am having, the value of that stock is 10 rupees. The stock that I am having, the value of that stock is 10 rupees. If I buy that stock from the market, I will be buying it for 8 rupees, then I might as well, I will use it for 10 rupees, I will recover 10 rupees, and for fresh purchase, for the order, I will buy a fresh lot at 8 rupees. So, it is always usable value or buying cost, whichever is less. Had it been 18, the value is 10, I can earn 10. But if I go for earning 10, for proposal, for the project, I will have to buy material at 18. Earning 10, spending 18 makes no sense. I don't mind sacrificing 10 rupees. So, 10 will be the cost. What if it is, the value is 10, but I am getting it in the outside market for 8. Use it, earn 10 and then spend 8 rupees to buy it. So, it is always whichever is less. But then how will you decide the value? The value will be decided on two bases. One is resale value and cost savings. Suppose the material can be sold at 10 rupees. Suppose the material can be sold for 10 rupees. If the material is sold for 10 rupees, guys, if the material is sold for 10 rupees, you can earn 10 rupees easily. But if you can use it as a substitute of some of the products inside your factory, if you are using it as a substitute product within your factory, you will not be required to buy that material. Like I have material X and somewhere in the other department, I need material Z. Now, X can be used as a substitute of Z. Z is available for 15. Then tell me one thing, is it advisable to sell X for 10 and spend 15 on Z? Of course, we will not do that, bachcha log. What I'll do is, instead of selling it for 10, I will use that X in the respective department in order to replace Z. So, I will save 15 rupees. I will not be having outflow of 15 anymore. So, the value is 15. Is this clear? But what if the value is only 5? You are having X in stock, 1 unit can give you 10. But then Z is getting used in one of the departments in the company which is available in the market for 5. Then boss, you better sell it for 10, earn 10 rupees and then spend 5 rupees on buying Z. But if it is not 5, if it is 15, don't waste your 10 rupees. You sell X, earn 10 and then spend 15. Are you wrong? Are you mad? Why are you doing? Why would I do that? Instead of earning 10, what I am going to do is, instead of selling it, I will use it to replace Z. That means that outflow of 15 rupees will be saved. So, that is why it is always resale value or the cost saving. Cost saving means cost saving by using stock as a substitute. If you are saving 50, resale value is 40, of course I will not sell it, I will replace it and save 50. What if you are saving 50 by using it as a substitute and the sellable value in the market is 60? Boss, sell your stock for 60, don't use it as a substitute. Sell your stock for 60 and buy that material for 50. My value is 60 then. So, the value of the material is decided on the basis of resale value and cost saving, whichever is higher. Resale value and cost saving, whichever is higher. And the moment you get value, that value or buying cost, whichever is less, will be your material requirement. Now, what can be the relevant cost for labor costing? For labor costing, there are various systems of payment. One is piece rate system. Piece rate system means you will start paying your employee on the basis of per unit. So, if you are accepting an offer of 10,000 units, you will have to pay your workers for all 10,000 units. That means whatever you are paying on piece rate basis is a relevant cost for you. If instead of 10,000, if you have got an offer of 20,000 units, you will pay workers for 20,000 units. If you got an offer for 50,000 units, you will pay your workers for 50,000 units. So, ultimately, you have been paying for every unit that is being produced for the project. That means if it is a piece rate system, entire amount is relevant. Then you have piece rate with guaranteed wages. Now, guaranteed wages means you have given a minimum guarantee to the worker, that worker will be minimum, this will be the minimum amount that will be paid to the worker, or worker's actual wages, whichever is higher. So, basically it is wada ya zada, whichever is higher. Got it? So, if you have given a commitment of 10 lakhs, your actual work done by the worker is of 8 lakhs, you will still have to pay 10 lakhs to the worker. If the worker has actually done work of 11 lakhs, now worker will not settle for 10 lakhs, you will have to pay your worker for 11 lakhs. That's how the guaranteed wages payment works. Now, just imagine your worker has worked for 8 lakh rupees, the labor cost comes to 8 lakhs. How much is the minimum guaranteed wages? 10 lakhs. That means ideally you are very much clear about one thing, that even if the work done is of 8 lakhs, you will have to pay your worker for 10 lakh rupees. You will have to pay your worker for 10 lakh rupees. That means your unavoidable payment in terms of labor cost is 10 lakhs. Now you accept a proposal. Now there is some proposal in front of you and you have to take the decision about acceptance and denial of the proposal. Then you evaluated that you have to spend some amount on material, some amount on direct expenses, some amount on overheads, and you also found out that you are supposed to spend 2,50,000 on labor. This is your additional cost. Are you getting me? I'll start right from the beginning. You have given minimum guarantee to your worker of 10 lakhs. Worker has actually worked for to the extent of 8 lakhs. Still, even if the worker has done work worth rupees 8 lakhs, still you will have to pay your worker for 10 lakhs. You will have to pay your worker for 10 lakhs. Now you have accepted a proposal. You have accepted a proposal where your potential labor cost is 2,50,000. So ideally 8 lakhs plus 2,50,000, your labor cost actually will be 10,50,000. Now if you recollect, since your minimum guaranteed wages is 10 lakhs, any which way 10 lakhs was about to be paid. Because of the proposal, 8 lakh went to 10,50,000. Because of the proposal, 8 lakh went to 10,50,000. Because of that proposal, 8 lakh goes up to 10,50,000 and 10 lakhs was any which way getting paid. I will consider only 50,000 as my relevant labor cost. I will consider only 50,000 as my relevant labor cost because 10 lakhs I was any which way paying. If I wouldn't have accepted this proposal, I would have still paid my worker 10 lakhs. Because of acceptance, 8 lakhs goes up to 10,50,000. So by what margin I am crossing 10 lakhs? I am crossing 10 lakhs by 50,000. So 50,000 I crossed. 10 lakhs by 50,000 just because I accepted the proposal. So, I am not going to charge 2,50,000 to my customer, I will charge only 50,000 to my customer. Are you guys understanding this? So, anything in excess of guaranteed wages, the incremental amount is relevant. Are you clear? And then you have time rate system. Now, when you pay according to the time rate system, there is a possibility that there will be an idle time. If there is an idle time, that means there is a time where your workers are without work. You cannot give them work. Now, it is not their fault. If you don't have work, you still have those workers hired on payroll. If you cannot give them work, and if there is idle time, workers are sitting idle, you will have to pay your workers for that span of time. So, naturally, you will dismiss your workers. Now, the question arises, are you really planning to dismiss your workers? Are you really planning to dismiss your workers? If the answer is yes, either the answer will be yes or the answer will be no. What if you have already decided that 10 workers will be retrenched? I am having excess load of 10 workers will be retrenched, whereby I will be able to save 10 lakhs. I was about to retrench 10 employees and I got this proposal. I recalculated things, I realized that I need 2 workers now. So, I cannot retrench 10, I have to retrench 8 workers. 8 workers will cost me 8 lakhs. That means now my 10 lakhs was getting saved if I wouldn't have accepted the proposal. Since I have accepted the proposal, only 8 lakh is getting saved. So, that 2 lakhs additional amount, the cost saving which got sacrificed is a relevant cost for me. Plan to dismiss idle workers. Yes, but because of acceptance of proposal, now you cannot dismiss actual workers. Then the labor cost becomes relevant. But yeah, I had no intention whatsoever of retrenching my workers. I absolutely had no intention of retrenching my workers. That means I was any which way about to pay them. If I was any which way about to pay them, there is no relevant cost, because I had 10 workers in excess. I did not have a plan to retrench them. That means I was mentally and financially prepared to incur a cost of 10 lakh rupees on that towards labor cost. Now, even if this proposal is accepted, same 10 workers will be utilized. It is good. No, they were getting 10 lakhs free of cost. Now, I can get some work done out of that 10 lakhs. I am not incurring anything extra. I am not saving also anything extra. So, there is no relevant cost. But if you are hiring them on incremental rate or a differential rate for doing the work, then in that case the incremental cost becomes relevant. I decided not to retrench them, but then they were about to be paid at a different rate. Then whatever incremental cost that you are incurring is relevant. See, remember one thing, anything that you are incurring additionally is relevant if it is related to project. If because of the project you are incurring any additional cost, that additional cost becomes relevant. Clear? What if there is no idle time? There is no spare time. If there is no spare time, that means you will have to go for fresh employment for the new job. I have 100 employees, all 100 employees are packed. I cannot even think of diverting them to any other project. And if I am getting a new proposal, I will have to go for fresh employment. Then in that case, whatever I am paying to those fresh employees will be a relevant cost for you. Because if I wouldn't have accepted the new proposal, if I wouldn't have accepted the new proposal. If I wouldn't have accepted the new proposal, I wouldn't have hired additional employees. I wouldn't have accepted the fresh employment. Then whatever fresh employment is costing me, that will be considered as relevant cost. If I am giving overtime, then the overtime overtime rate becomes relevant cost. And if I am diverting them from some other job, like some workers are working on, I have got a new project. I have got a new project. I have a few employees working on job XYZ already. I have some job XYZ which is already going on. Yeah, I have 100 employees working with me. Some employees, all employees are occupied. Some employees are working on XYZ. Now, since I don't have idle time, some employees will be shifted from XYZ to new proposal. In that case, number of hours to be worked on job XYZ will be reduced. In that case, suppose I would have produced 2000 units additionally, those 2000 units will not be produced. And if 2000 units are not going to get produced, can I say the contribution of 2000 units will be lost? That contribution lost becomes an opportunity cost. Opportunity cost means opportunity lost is opportunity cost. Opportunity lost is opportunity cost. Since I shifted a few workers from somewhere to the new project, I did not have sufficient time on that project. And because of that, there was a shortage of 2000 units there. So the contribution lost of those 2000 units, the contribution lost to the extent of 2000 units will be considered as relevant cost here. And how will you calculate it? Simple, take your labor cost, 8 rupees, 10 rupees, 15 rupees per unit. Suppose your labor cost is 8 rupees per unit, 8 rupees per unit will be charged. You will also charge contribution per unit. You will also charge contribution per unit, which is an opportunity cost. Because if I wouldn't have gone for the new project, I would have earned this contribution on those 2000 units. Since I accepted the new proposal, 8 per unit I have to spend, piece rate it is, that has to be recovered, plus I have to recover even the contribution lost by not working on XYZ, the previous job. You can also calculate this by using sales minus variable cost excluding labor. Like for example, you have selling price 50, in variable cost you have labor 10, other variable cost 20. So your total variable cost is 30. Please concentrate. Your total labor cost is 10, your other variable cost, material, variable overhead, variable selling, everything is 20. So 30 is your variable cost, 50 is your selling price, 20 will be your contribution per unit. So when you don't produce one unit, 20 per unit is lost, plus 10 rupees per unit will now be incurred not on job XYZ but on the new proposal. So 30 per unit will be charged as a labor cost to the customer, 10 the actual labor cost, 20 my sacrifice of 20 units which I have lost just because of this acceptance. This will also be recovered. And if you really want to know the shortcut, it is selling price minus other variable cost. 50 minus 20, if you do, you will directly get 30 as an answer. Both the methods you can follow, you will still be getting the same answer. Have you understood this part? ₹10 you have to charge because your labor is employed there for the new proposal. Plus 20 rupees I was earning by producing one unit there, that 20 rupees will be lost. If that 20 rupees will be lost, I want that 20 rupees back as my opportunity cost. So 10 actual labor cost, 20 opportunity cost, 30 will be charged to the project as labor cost, which can be directly calculated by way of selling price minus other variable cost. You are still getting answer as 30 only. That was about labor. Even for variable overheads, guys, you just need to understand one thing. Even for variable overheads, if the cost is incurred exclusively deliberately for the project, it will be charged, otherwise it won't. And for fixed overheads, Absorption and all that won't matter to us. Absorption of fixed overhead is just a recovery of fixed overhead, which is followed in absorption costing, not in marginal costing. Okay, so fixed overheads in terms of rupees will be considered as relevant cost if and only if it is getting incurred for exclusively execution of this project, new project. So if you're already any which way, even if you don't accept the proposal, if the fixed cost is getting incurred, like I'm paying rent of this studio, I'm paying rent of this studio, whether I get a new batch, whether I don't get a new batch, the studio rent will be paid anyhow. Then for next batch, rent of this studio will never be considered as a relevant fixed cost. But all my studios are packed and there is one more batch to be run. For that one batch, I had to somewhere arrange another studio which is costing me additional fixed cost of 50,000 per month. That becomes relevant cost for the new batch because I'm spending 50,000 just because I'm accepting the new batch. So anything that is incurred, any revenue which is sacrificed because of acceptance of the new proposal is relevant. Anything which is earned or any expenditure which is saved will be considered as relevant revenue. And relevant revenue minus relevant cost, if you get gain, it is to be accepted. If you get loss, it is not to be accepted. We'll solve a few questions based on this. Your concept will be revised here. Now, question number 25, we'll quickly revise this question. A company has been making a machine to order for customer, but the customer has since gone into liquidation and there is no prospect that the money will be obtained from the winding up of the company. Cost incurred to date in manufacturing the machine is 50,000. This is already incurred. So this is sunk cost for us. Cost incurred to date for manufacturing the machine is 50,000. You have already incurred the cost, so it doesn't matter now. Progress payment has been made 15,000. That also doesn't matter to us. Sales department has found another company willing to buy the machine for 34,000 once it is completed. So this is revenue for me. As is where is basis pays, there is someone who is buying the machine for 34,000. That means I have first option to sell the machine for 34,000. Now, if I decide to complete the work, these are the costs to be incurred. I have to incur on material, which is already bought at 6,000. It is there in the stock. It has got no other use, and if the machine is not finished, that material would be sold for 2,000. Guys, the material has got no other use. I'm going to sell it. So if I use it, if I use the material for completing the machine, that revenue of 2,000 will be lost. Revenue loss becomes opportunity cost for us. Is this clear? If I don't complete the machine, I can earn 2,000 by selling the material which is in stock. If I use that material for production purpose, I will be sacrificing that revenue of 2,000. So that becomes a relevant cost for me. Further labor cost would be 8,000. Labor is in short supply. And if the machine is not finished, the workforce will be switched to another job that would earn 30,000 in revenue. And other direct expenses, not including direct labor, are 12,000. That means 30,000 revenue and other variable cost is 12. So 18,000 is the relevant labor cost. 18,000 is the relevant labor cost for us. Since it is absorption of fixed overheads, it is not to be taken into consideration. Consultancy fees 4,000. If the work is not completed, the contract will be cancelled at 1,500. That means one thing is very clear, that if you complete, you pay 6,000, you pay 4,000. You don't complete, still you have to pay to 1,500. That means 1,500 any which way getting incurred. So 1,500 is any which way getting incurred. If I complete the machine, I have to pay 4,000. So 2,500 becomes relevant cost of completing the machine. General overheads of 8,000 would be added to the cost of additional work. This is allocation. The cost is not incurred just because I am completing the asset, it is allocation. That means 2,000 I'll be spending, 2,000 I'm sacrificing, 18,000, 20,000, 20,000 and 2,500. 20 to 500. 20 to 500 is my relevant cost. 20 to 500 is my relevant cost. 34,000 is the relevant revenue. Once it is completed, 34,000 will be paid to me. So that is my first option. 34,000 will be paid to me if I complete it. So 34,000 I'll be getting. Against that, 20 to 500 is my relevant cost. So 11,500 is the profit involved. I think we can think of going for the proposal because still there is a profit. That's how the relevant costing concept works. I want to solve a very important sum, very good question. Question number 26. Question number 26. RST Herbals Private Limited, which manufactures and sells highly successful line of herbal home care and herbal personal care products, has decided to diversify in order to stabilize sales throughout the year. The company is considering venturing into manufacture of natural healthcare products. After considerable research, the natural healthcare product line has been developed. However, the CEO of the company has decided to introduce only one of the new products during the next month. If the product is a success, further expansion in the future year will be initiated. The product selected is an immunity booster drink, IM9, that will be sold in small glass bottles. The product will be sold to wholesalers in the boxes of 24 glass bottles. So it's like batch. One crate is of 24 bottles for 250 per box. If it is 240 per box, 240 per box is a selling price. Because of excess capacity, no additional fixed manufacturing overhead cost will be incurred to produce the product. So there is no relevant fixed cost. However, 27 lakhs charge for fixed manufacturing overheads will be absorbed by the product under the company's absorption costing system with an estimated sales and production of 1 lakh bottles. So 27 per unit. 27 lakhs is a fixed cost, 1 lakh bottles we are planning to sell, budgeted quantity 1 lakh, budgeted fixed cost 27 lakhs, 27 per unit is my fixed overhead absorption rate. They have given me material 108, labor 60, manufacturing overheads are given to be 42. Now I already know that 27 per unit has to be a fixed portion and 15 per unit is variable portion. So 108, 60, 168 plus 15, 183 per unit is my variable cost. Overhead per unit 42. We already know that 27 per unit is fixed. That means balance 15 per unit has to be variable. Selling price per box is 240, cost per box is 183. So we can easily find out the contribution later on. The cost above includes cost of producing both booster drink as well as small bottles. As an alternative to make the small bottles, RST has approached a supplier to discuss the possibility of purchasing the bottles of IM9. The purchase price of empty bottles from the supplier would be 40.5 per box of 24 bottles. So instead of, see, they have said that we are going to buy bottles, empty bottles from the supplier at 40.5. If RST accepts the proposal, direct labor and variable overhead cost per box would be reduced by 10% and material cost will be reduced by 25%. Should RST Herbals make or buy the bottles? Show calculations to support your answer. What would be the maximum purchase price acceptable to RST Herbals? Instead of sales of 1 lakh bottles, revised estimates show a sales volume of 1,20,000 boxes. At this new volume, additional equipment must be acquired to manufacture the bottles at an annual rental of 12 lakhs. Assuming that the outside supplier will not accept the order for less than 1 lakh boxes, should RST Herbals make or buy the bottles? Show computations to support your answer. And finally, refer to the data in 3 above and assume that the outside supplier will accept the order of any size for 48 at 48 rupees per box. How, if at all, would this change your answer? And finally, qualitative factors should what qualitative factors should RST consider in determining whether they should make or buy the bottles? See, it is make or buy. So now you just need to understand the relevant calculation here. If I start buying the order, if I start buying the bottles, they have given us savings. 10% of overhead will be saved, 10% of labor will be saved, and 25% of material will be saved. So 108 into 25%, $27. 108 into 25%, 27, then 60. 60 is your labor, 15 is your overheads, into 10% will be saved. So guys, if I start buying the bottle, I will be saving 34.5 per bottle. But the purchase price of the bottle will be 40.5. I am saving 34.5, but I am incurring 40.5. That means there is a clear cut additional cost of 6 rupees. So I would still prefer producing bottles in house. If I buy the bottle, I have to pay 40.5. If I make the bottle, I am paying 6 rupees less. If I buy the bottle, I have to pay 40.5 and I am saving 34.5. So basically, I am incurring 6 rupees more. I don't want to go for it. Very simple calculation. Your second part of the question is asking you what should be the maximum purchase price acceptable for RST Herbals. If I am saving 34.5, 34.5 is the maximum price I am ready to pay. I will not pay 40.5 for saving 34.5. I don't mind paying you 34.5, so there will not be any profit or loss. Third part is very important. Instead of sales of 1 lakh boxes, revised estimates show a sales volume of 1,20,000 boxes. At this new volume, additional equipment must be acquired to manufacture the bottles at an annual rental of 12 lakhs. So now there is a sudden demand of 1,20,000 bottles, and there will be a relevant cost of 12 lakhs if we decide to manufacture 1,20,000 bottles. If we decide to manufacture 1,20,000 bottles, there is an additional fixed cost of 12 lakhs. Assuming that outside supplier will not accept any order less than 1 lakh boxes, should RST make or buy bottles? See guys, there are 3 situations. Try to understand this. There are 3 situations. One is manufacture all 1,20,000 bottles. Manufacture all 1,20,000 bottles. Second scenario, buy 1,20,000 bottles, or else buy 1 lakh bottles and manufacture 20,000 bottles. Why not other way, sir? We cannot place order for less than 1 lakh bottles. So if you decide to produce 1 lakh bottles, you are left with only 20,000 bottles to be purchased, and supplier will not distribute 20,000 bottles to you. So my simple relevant calculation is my variable cost that is getting incurred exclusively here is 34.5 for first option. So 1,20,000 into 34.5. So here it will cost me 41,40,000, but in case of second option it will be at the rate of 40.5. So it will cost me 48,60,000. Are you getting me? If I am manufacturing, it will cost me 34.5. If I am buying it, it will cost me 40.5. Here I am buying 1 lakh. So 40.5 into 1 lakh and 34.5 into 20,000. 47,40,000. 47,40,000 is going to be the variable cost. Fixed cost will be incurred only if I am producing 1,20,000 bottles, which is not going to be the scenario in other cases. So that's my relevant cost calculation. It is 53.40. It is 48.60 and the other one is 47.40. So according to this, we should buy 1 lakh bottles and we should manufacture 20,000 bottles. Simple calculation was required to be done. See the solution if you want. Correct? Next, assume that outsider will accept any order for 48 rupees. Outsider will accept any order for 48 rupees. See, in point number 3 there was a constraint, no? In point number 3 there was a constraint that only 1 lakh bottles will be purchased. You cannot buy less than 1 lakh. Now they are saying any bottle can be purchased for 48. See, the purchase cost is 48, production cost is 34.5. So guys, it is quite obvious that I will prefer producing 1 lakh bottles at 34.5 and only 20 bottles will be purchased at 48. So 34,50,000. 9,60,000. 44,10,000. 44,10,000 is the cost. So I think this option is the most brilliant option, economical option, because your larger part of quantity is saving your money. Early, I would have gone for this only. They were not allowing me to do this. Now, the moment supplier said we can accept any order, then only 20,000 will be purchased at 48. Despite of that, I am saving some money because my total cost is minimized. And the last part is theory, to what extent, qualitative factors and all that. When you are outsourcing, you are just supposed to write the disadvantages of outsourcing: timely delivery, copying the pattern, knowing the technicalities of the product, quality of the product, because the way I can take care of my product, not necessarily the supplier will be keen to maintain the quality of the product for me. So these are the factors to be considered, and that was your separate question. One more question I'll solve and then we'll go to the next part of this chapter. I feel this question is important, so I am discussing it. Question number 27. SM Limited is engaged in the manufacture of plastic bottles of a standard size. The factory has 8 machines, identical 8 machines, each capable of producing 50 bottles per hour. The variable cost per bottle is 0.40 and the selling price is 1 rupee each. So naturally, contribution will be 0.6 per unit. Contribution will be 0.6 per unit for bottle. The company has received an offer from another firm for manufacture of 50,000 units of a plastic molded toy. The price per toy is 6. That's your selling price. Variable cost is 4.80. So contribution for toy, it is 1.2 per unit. So this is contribution for bottle, this is contribution for toys. Bottles can give you 0.6 per unit, toy can give you 1.2 per unit. In case the company takes up the job, it has to meet expenses of making the special mold required for the manufacture of the toy. For toy manufacturing, we need some additional material. It will cost you 20,000, so that becomes a relevant cost for me. If I decide to produce toy, there is an additional cost of 20,000 which needs to be incurred, so it becomes a relevant cost for me. Without incurring 20,000, you cannot produce the final product, toy. The company's time study analysis shows that the machines can produce only 20 toys per hour. Bottles 50 per hour, toys 20 per hour. The company has a total capacity of 10,000 hours during the period in which the toys can be manufactured. Fixed cost excluding cost of construction of the mold is 2 lakhs, which will be incurred anyhow, whether you produce bottle, whether you produce toy. The company has an order to supply 3,75,000 bottles during the period. If you are already having an offer of 3,75,000 bottles, if you are already having an offer of 3,75,000 bottles, 3,75,000 divided by 50, your 7,500 hours will be any which way occupied. Out of 10,000, your 7,500 hours are occupied for bottles. That means you have only 2,500 hours available for toys. And as far as the rate is concerned, 20 toys can be produced in 1 hour. So in 2,500 hours, you can easily produce 50,000 toys. You can easily produce 50,000 units. Do you advise the company to take up the order for manufacturing plastic molded toys? During the time, it has an order for supplying 3,75,000 bottles. Will you accept the offer for toys? 50,000 toys I need. 50,000 toys I can produce. Out of 10,000 hours, 7,500 hours will be used for producing bottles. 7,500 hours will be used for producing bottles. So balance 2,500 hours will be utilized for toys. So 50,000 toys into contribution 1.2. 60,000 will be additional contribution, additional fixed cost of 20,000, 40,000 is your profit. Yes, I will accept the offer. That's my answer here. I will accept the offer. If the order for supply of bottle increases to 5 lakh bottles, will you advise the company to accept the order? Now, you already have offer for 5 lakh bottles divided by 50 bottles per hour. 10,000 hours will be required to produce all 5 lakh bottles. That means ideally you don't have an idle time. Ideally you don't have an idle time. So if you want 2,500 hours to be used for 50,000 bottles, there will be an opportunity cost. The contribution of 0.6 per unit will be lost, because see, I'm currently producing 5 lakh bottles. If I want to make arrangement for producing 50,000 toys, I will have to start producing and selling 3,75,000 bottles. So I'm losing contribution of 1,25,000 units. And my 1,25,000 bottles will not be produced and sold. So I'm sacrificing the contribution at the rate of 0.6. So 75,000 is the opportunity cost for me, guys. So my bottles will give me 1.2 contribution into 50,000 minus 20,000 cost of mold minus 75,000 opportunity cost. Guys, 35,000 loss it is. I will not accept the offer. Are you guys clear with it? You are currently having 5 lakh bottles. You are currently selling 5 lakh bottles. So ideally there is no idle capacity. Still, if you want to sell 50,000 bottles, you need 2,500 hours. You have already utilized all 10,000 hours for bottle production. Out of that, if 2,500 hours are to be given for toys production, only 7,500 hours will be left for bottling production. In 1 hour, 50 units can be produced. So in 7,500 hours, 3,75,000 units. 3,75,000 units can be produced. That means instead of 5 lakhs, I'll be able to produce only 3,75,000. So I'm not going to produce 1,25,000 bottles. There is a demand for 1,25,000 bottles. I cannot produce 1,25,000 bottles because the time is devoted to toys. That means I'm losing contribution of 1,25,000 bottles, which is 0.6 per unit. I'm earning 40,000 by selling toys, but I'm sacrificing 75,000, makes no sense. Relevant loss is 35,000. Then I have next point. Point number 3 says an associate company of SM Limited has idle capacity and it's willing to take up the whole or part of the manufacturing process of the plastic molded toys on subcontract basis. The subcontract price inclusive of cost of construction of mold is 5.60 per toy. Listen, instead of spending 4.80 per unit for producing toys, we will start spending 5.60 for buying the toys. Instead of spending 4.8 on production, we'll start spending 5.60 on purchase. So that means the selling price will remain 6 only. Instead of 4.80, your variable cost will be 5.6. So your contribution will be 0.4. So as far as toys are concerned, if toys are manufactured, 1.2 is the contribution. If toys are manufactured, 1.2 is the contribution. If toys are purchased, then only 0.4 is the contribution. Determine the minimum expected excess machine hours capacity needed to justify producing a portion of toy, which is better than subcontracting. So basically, remember one thing. Instead of buying at 5.6, if I can produce at 4.8, I can save 0.8 per unit. This is my saving in variable cost. But if I decide to produce, there is an additional fixed cost of 20,000 to be incurred on molds. So if I decide to manufacture, I am saving variable cost by 0.8, but I am incurring 20,000 more towards fixed cost. So my saving of 0.8 per unit will be first utilized to recover my excess fixed cost of 20,000. So difference in fixed cost divided by difference in variable cost per unit is cost break-even point here. 25,000 toys is point of indifference. 25,000 toys is point of indifference. So 25,000 divided by 20, you can also call it as 1250 hours is your point of indifference. Now just imagine if your requirement is more than 1250 hours, if your requirement is more than 25,000 toys, level of activity is more, higher fixed cost option can be selected. So start producing toys. But if your level of activity is less than 25,000, your production is less, your sale will be less, your revenue will be less, your level of activity is less, be happy with minimum fixed cost. Go for higher variable cost. So 1250 is your answer. 1250 hours is a break-even point. If it is more than manufacture, because if what I required is more than 1250, quantity is definitely more than 20,000, I can recover my fixed cost. If the level of activity is less, you better buy and minimize your fixed cost. Then the company expected that it would be left with an excess capacity of 1600 machine hours during the period. Now, if you are left with 1600 machine hours, 1600 hours into 20, 32,000 bottles can be easily produced. Bottles can be easily produced. Later, the demand of the bottle increased to 4,50,000. Since the company had accepted the toy order to fill 1600 machine hours, it could meet the demand of 8,400 machine hours only. Work out the loss which the company suffered not being able to predict the demand for the bottles accurately. Now guys, please remember, if you are talking about 32,000 toys, that means definitely you must have, out of 50,000, if 32,000 will be manufactured in that spare time of 1600, balance 18,000 will be toys purchased at 5.8. So, how would you go for profitability? Toys manufactured 32,000. Naturally, contribution will be, or the original one, 1.2. Toys purchased 18,000. 1600 spare hours were used for producing toys, 32,000. 18,000 will be, since the total demand of toys is 50,000, 32,000 will be produced. Balance 18,000 must be purchased. If you purchase 18,000, 5.6 will be the cost, 6 rupees will be the selling price, 0.4 is going to be your revised contribution. So 32 45,600 is your contribution from the toys. Now out of 8,400 hours at the rate of 50 units per hour, 4,20,000 bottles will be produced. 1,600 hours were used for toys, the balance 8,400 hours were used for bottles. So 4,20,000 bottles are produced and the contribution per bottle was, I think, 0.6. 2,52,000 plus 45,600. 297,600 minus 2,20,000 fixed cost. 2 lakhs is your normal fixed cost given and 20,000 is your cost of mold which is required if you are manufacturing toys. So 77,600 is your profit. Got it? Now we made a mistake. question says, in the last part, question says we have made a mistake. There was actual demand of 4,50,000 bottles. So for 4,50,000 bottles at the rate of 50 units per hour, 9,000 hours will be required. Now out of 10,000 hours, if 9,000 hours will be utilized for bottles, you are left with only 1,000 hours. And if your spare capacity is less than 1250, you have already taken a decision of buying assets, buying those toys. So 4,50,000 bottles will be processed, 4,50,000 bottles will be produced at 0.6 per unit. Contribution will also be earned at the rate of 0.6 per. Bottles will be produced at some rate, but contribution per unit will be 0.6 per unit. So 4,50,000 into 0.6, 2,70,000 will be the straight contribution. Your demand was 4,50,000. Your demand was 4,50,000. 4,50,000 into 0.6, 2,70,000 I am easily earning. And I am not going to manufacture toys now because my spare time, my idle time is less than 1250. We discussed that initially. If my time is less than 1250, I would always prefer keeping my fixed cost minimum. And if I manufacture, there is a fixed cost of 20,000. So I don't want to manufacture, I'll buy it. And if I buy it, my contribution will be 0.4. So that will give me another contribution of 20,000. 2,90,000 will be the calculation in that scenario. 2,90,000 will be the total contribution. 2 lakhs will be the fixed cost. I'm not taking 2,20,000 because I'm producing it. No, I'm purchasing it. I'm purchasing toys. So there is no mold cost to be incurred of 20,000. So 90,000 will be your profit. You would have gone for this. You would have earned 90,000. But you settled for 77,600, that's where you have gone wrong. So that is a loss, 12,400 of your wrong estimation. You understood this. If you would have estimated 4,50,000 correctly, you would have realized that spare time is less than 1250, time to buy the asset, buy the toys, not purchase them. So ideally you would have gone for this calculation, your profit would have been 90, but since your calculation went wrong, the spare time was more according to you. You use that for some part of toys to be produced, some toys were purchased, and this is what you have got. That was your calculation. So ideally the loss of estimation, loss due to estimation was 90,000 minus 77,600. 12,400. That was about relevant costing. I hope you guys are clear with it. The next question is question number 33. Tip Top Textiles manufactures a wide range of fashion fabrics, and the company is considering whether to add a further product, Superb, to the range. A market research survey recently undertaken at a cost of 50,000. Survey is already conducted at a cost of 50,000. That means this is my sunk cost. I've already paid for it. It suggests that the demand for Superb will last only for 1 year, during which 50,000 units could be sold for 18 per unit. So 15,000 units will be sold for 18 per unit. So 9 lakhs is going to be your relevant revenue. Look at the information. You need 3 different types of materials: Posh, Flash and Flash. Quantity is required, current stock level and cost is given as follow. Posh is regularly used. Guys, Posh is regularly used. If Posh is regularly used, and if I am using Posh for manufacturing Superb, if Posh is regularly used and if I am using Posh for manufacturing Superb, that means for my routine production, I will have to buy another quantity of Posh. So for me, current replacement, current value is important. So consumption requirement is 1 meter per unit. 50,000 units are planned to be produced. So 50,000 units will be the requirement. Out of 50,000, 1 lakh is already there in the stock. But if I use it, I will have to buy the fresh lot. That means I will have to go for 2.5 as a base. Are you understanding this? Posh is regularly used. So if I'm using Posh for manufacturing Superb, there will be a shortage. The shortage will be adjusted or managed by buying the fresh lot. So it is as good as you are buying that quantity for producing Superb only. No? So that will be charged at current rate. Current stock of flash is a result of overbuying. This is not used regularly. And if it is not used for manufacturing Superb, it will be sold. Guys, flash requirement is 2 meters per unit. So for 50,000, your requirement is going to be 1 lakh. Out of 1 lakh, you already have 60,000. If I'm not producing Superb, this 60,000 will be sold. So if I'm producing Superb, this 60,000 will no longer be sold. That means there is an opportunity loss of resale value of 1.1 per unit, per meter. Are you getting me? This 60,000, if it is not used for Superb, it will be sold. So 60,000 into 1.10 should be my revenue, or rather would have been my revenue. If I'm using it for Superb, that revenue is lost, which is an opportunity cost. For balance 40,000, your need is 1 lakh. Your need is 1 lakh. Out of 1 lakh, 60,000 you already have, which will be valued at 1.10. Balance 40,000 will be purchased at the original price of the current replacement price of 2.80. And as far as splash is concerned, we don't have stock of splash. It will be purchased as and when it is required. So 50,000 is the quantity of finished goods which you need to produce. At the rate of 0.5, 25,000 is your requirement. So 25,000 into 5.5 will be the material cost. This is what we were supposed to know as far as relevant costing is concerned. See, I'm not going to discuss the entire solution and profit and all calculation. I'm discussing only the relevant part of relevant costing. Labor. Production of Superb would require a quarter means 0.25 hours of skilled and 2 hours of unskilled. So for producing 50,000 units, 12,500 hours of skilled workers will be required and 1 lakh hours of unskilled will be required. 12,500 hours of skilled workers and 1 lakh hours of unskilled workers. Current wage rate is 3 per hour of skilled and 2 per hour for unskilled. In addition, one foreman is required to devote all his working time for 1 year in supervision and production of the Superb. He is currently paid annual salary of 15,000. Tip Top Textiles is currently finding it difficult to get a skilled labor. So skilled labor needed to manufacture Superb will be transferred from another job. If your skilled labor is transferred from another job, there will be scarcity on that job. So the quantity which I would have produced there will no longer be produced. So for 12,500 hours, if I'm sacrificing quantity of some other product, there is a loss of contribution and there is an opportunity cost. They have clearly said they were earning contribution of 1.50 per labor hour. Sales revenue was 10, less skilled wages 3, other variable cost 5.5. So 3 rupees is a labor cost, 1.5 is opportunity lost. 3 rupees is a labor cost which I have to incur for Superb, and 1.50 is opportunity cost. The opportunity of earning profit is lost. If you don't want this, you still have this option, selling price minus other. Selling price minus other variable cost. Still it is 4.5. So 12,500 multiplied by 4.5 will give you labor cost of skilled worker. It will give you labor cost of skilled workers. You have 2 lakh surplus hours of unskilled. That means you are not in need of additional time. You need 1 lakh hours of unskilled, you have 2 lakhs surplus time of unskilled workers, so you are not going to incur any extra cost. Because the company intends to expand, they have decided not to terminate services of unskilled worker. That means any which way you are going to pay for 2 lakh hours. If you have already decided that you will not be, retrenching those workers, 2 lakh hours will be any which way paid for. I am just supposed to use 1 lakh out of it, for which I am not going to incur any extra cost, because I am any which way ready to pay for 2 lakh hours. And out of the same 2 lakh hours which are already paid for, I am going to utilize only 1 lakh hours. So there is no additional cost as such to be incurred on unskilled workers. Supervisor was about to retire and I was about to pay him pension of 6,000. Currently, I am paying 15,000 as salary. He is retiring. I'll start paying him 6,000. So I am saving 9,000. Currently, he is getting salary of 15,000. He is planning to retire. I am planning to pay him 6,000. So from 15, it will go down to 6. So I have saved 9,000. But if I decide to produce superb, his retirement will be postponed by 1 year. That means I have to pay him not 6,000 but 15,000 again as salary. So that 9,000 saving will not happen, which will become a relevant cost for you. That's it. This is what the cost structure is. Now, MT4 and MT7 are the two machines. Question says, MT4 is regularly used. If regularly used, that means MT4 will be replaced as soon as the life ends. That means I need to go for replacement cost. Currently, if I try to replace it, I will get 80,000 benefit. But after 1 year, I'll get benefit of only 65,000. So I'm sacrificing 15,000 for using that machine for 1 year. Since it is replaceable, I'm not considering resale value. And machine number MT7 is no longer used and it is to be scrapped. So I'm not going to replace it. If I scrap it today, I will get 11,000. If I use it for producing superb for 1 year, I'll get 8,000. So I'm sacrificing 3,000 here. So that will be taken as depreciation, or that will be taken as relevant cost. That's it. Nothing else is to be considered. Variable overhead says it is 1.2 per unit produced. So even 1.2 is to be charged because it is 1.2 per unit. If you produce 50,000 units of superb, you'll have to incur the cost of 1.2. Have you understood this? Very clear. So this is how you are supposed to decide relevant cost structure. Clear? The next question I want to discuss with you is question number 34. See, I'm revising all those concepts which can be asked in the exam. We are not discussing all the solutions. We are not discussing the final profit figure and all that. But I'm discussing all important adjustments so that if these adjustments come in the examination, you people will be very much comfortable in terms of applying those adjustments. Question number 34. Ranka Builders has been offered a contract by Excel Limited to build for it 5 special guest houses for use by top management. Each guest house will be an independent one. The contract will be for a period of 1 year and the offer price is 1 CR. So 1 CR is going to be your relevant revenue. In addition, Excel Limited will also provide 2 grounds of land free of cost for the purpose of construction. The chief accountant of Ranka Builders has prepared an estimate on the basis of which he has advised that the contract should not be accepted at the price offered. His estimate is as follows. Okay, so your chief accountant is saying the contract is not acceptable. Okay, now you need 3 grounds of land. 60 lakhs is the total cost because 3 grounds you need of 20 lakhs each. Now guys, they have already told you, your customer is already giving you 2 grounds. That means you are not supposed to spend on 2. You need 3 grounds. Out of 3 grounds, 2 grounds will be given by your customer only. So you are just supposed to buy 1 ground. So your relevant cost will no longer be 60 lakhs. It is going to be only 20 lakhs. Am I right? Then you have design and drawing, registration, material information, labor, skilled, unskilled, then supervisor's salary, general overheads, depreciation. Depreciation is non-cash, so any which way we don't need it. Overheads are general overheads. The accountant also provides the following information. Land. The total requirement of land is 3 grounds of 20 lakh per ground. Excel Limited, that means your client is giving you 2 grounds free of cost. That means you are supposed to spend only on 1. So 20 lakhs is your relevant cost. Drawings and designs, they have been already prepared and 50% of the cost is incurred. Listen to me carefully. Drawings and designs are already prepared. 50% cost is already incurred. Now, whether you execute the proposal, you don't execute the proposal, balance 50% has to be paid. Payment of balance 50% does not depend on whether you are executing the project or not. Like for example, you are a chartered accountant, you are a practicing chartered accountant. I come to you for some project report. I tell you that I need some project report to be done because I want to submit it to some listed company so that I can get the tender. I can get some financial benefit. You will prepare the project report. I will submit it. What if my loan is discarded, denied? I will still have to pay you your consultancy charges, no? So in any case, this 7 lakhs will be paid. See, out of 7 lakhs, 3,50,000 is already paid towards drawings and designs. And whether I accept the proposal, I don't accept the proposal, balance 3,50,000 will also be paid, guys. So that won't have any impact on whether the proposal is accepted or declined. So that cost is not relevant for me. It is any which way getting incurred. Material. Cement and sand are already in stock and they are of regular use. If used, so if we are using this cement and sand for the new contract, we will have to replace it with the fresh material. It is as good as you are buying fresh lot from the market for the proposal. So material of rupees 6 lakhs, cement and sand of rupees 6 lakhs will be used for the project. But since you have used it, you will have to replace it by spending 8 lakh rupees. So basically the cost is 8 lakh rupees. Bricks and tiles represent purchases made several months before for a different contract. They could be sold readily for a net 5 lakhs after meeting all expenses. That means that there is no other use for bricks and tiles. If I wouldn't have got this offer, I would have sold it for 5 lakhs. So 5 lakhs is an opportunity cost. If I don't accept the proposal of Excel Limited, I will sell these bricks and tiles in the market for 5 lakh rupees, which is my realizable value. So if I am not selling it in the market, that means if I am not selling it in the market, if I am using it for the project, that means I am losing 5 lakhs. So 5 lakhs is my opportunity cost. 4 lakhs is not to be seen because it is cost. Book value has got no meaning in relevant costing. Other material worth rupees 2 lakhs relating to interior decoration are in stock, which has no other use. If it has no other use, that means it has to be sold. And material of rupees 2 lakhs will be sold for 1 lakh. Other material, if I talk about 2 lakhs is revalued, that means balance 8 lakhs is intact. Out of 10 lakhs, other material, 2 lakhs is revalued to 1 lakh. But balance 8 lakhs will remain same. So here I will take 9 lakhs. 8 lakhs will be intact and 2 lakhs has got no other use, so it will be sold. So if I'm using it for the project, I'm sacrificing 1 lakh rupees which I'm getting from the market. So there is an opportunity cost, just like bricks. Skilled workers will be transferred to this project from the other project. That means there is some work sacrifice there. The project manager claimed that if these men were returned to him, he would have earned additional 2 lakhs in terms of profit. So guys, 12 plus 2, 14 lakhs will be the labor cost for the proposal. 12 lakhs I have to pay for, 12 lakhs I have to pay to my workers for working on the new project, and 2 lakhs is the profit lost because of shift of workers from one work to the existing Excel Limited work. So 2 lakhs is an opportunity cost, 12 lakhs is the amount to be paid, 14 lakhs will be the skilled labor. Supervisor makes various tasks and his pay and continuity is not affected. If the contract was taken, he will devote half of his time. Understand one thing, whether he devotes half time, whether he devotes full time, doesn't matter. Are you paying him anything additionally for this offer? No. You are paying him 5 lakhs, you will any which way pay him 5 lakhs. You are paying him 5 lakhs, you will any which way pay him 5 lakhs. So you are not paying anything extra for the proposal, no? So there is no relevant cost as far as supervisor's salary is concerned. If they say that currently you are paying 5 lakhs, but for handling the new project, there is an additional salary paid of 1 lakh rupees, then 1 lakh will become relevant cost. Overheads. The equipment that would be used on the contract was bought 1 year before for 30 lakhs. Equipment were bought for 30 lakhs and it is expected to last for 5 years. It can also be used on other contracts and the current replacement price will be 32 lakhs. And in a year's time, it will be 25 lakhs. Achha. First of all, your equipment was used 1 year before the proposal is to be executed. And it can be used for other contracts also. That indicates that if I have some issues with the equipment, if I sell the equipment, I will have to buy the new equipment. So I'm not going to sell it without buying a new one. I'm going to sell it and I will have to buy a new one because it is regularly used. So if I sell it today, replacement value is 32 lakhs. If I sell it after 1 year, replacement value will be 25 lakhs. The value is going down by 7 lakhs. The value is going down by 7 lakhs, which is relevant cost. If I don't execute the proposal, I'll be earning 32 lakhs today. But if I accept the proposal, the value will be 25 lakhs. That's the problem. Are you clear with it? General overheads include specific and absorbed. If the contract was not undertaken, 4 lakhs could have been avoided. Oh, out of overheads, 4 lakhs can be avoided. That means 4 lakhs is the only relevant cost, not 12. Ranga Builders has also on hand another project. Oh, so we are already executing one more project, which would not be accepted if the contract of Excel Limited were to be accepted. And the estimated profit on that project is 10 lakhs. So if you are accepting proposal of Excel Limited, you will have to rescind the contract which is already executed, and in that case, you are sacrificing profit of 10 lakhs, which is your relevant cost. Now, there is no information given about steel. That means steel has to be purchased, 10 lakhs is relevant. Unskilled, no information given, that means 8 lakhs will be incurred anyhow. The rest everything is already discussed. So that was your question number 34. So are you understanding, guys? It is just about whether you are incurring the cost because of the proposal, whether you are saving the cost because of the proposal. That makes the cost or the income relevant. Now, similar activity is done in question number 35, 36. So there is no point in wasting time on that. The next question I would like to discuss I will not discuss entire 37, but there were 3 divisions. Remember, there were 3 divisions. One of the division was closed. One of the division was closed down. So the cost of the entire division will be the relevant revenue for us. Apart from that, whatever you are saving in other division will also be a relevant revenue for us. Achha, because of that, whatever extra cost you incur, that will be relevant cost for us. So this can also be done. You already have the solution of all this. So there is no point in wasting time on that. Now I'll come back to some special segment. Which is more than a relevant costing. Question number 38. I feel such questions are expected in this exam. Question number 38. Companies RR, RP, RS and RT are members of a group. So same company, same group but 4 companies. RP wishes to buy an electronic control system for its factory, and in accordance with the group policy, it must obtain quotation from the companies inside as well as outside the group. So you will have to send the requisite to inside companies as well as outside companies. From outside companies, company A has quoted 33,200, company B has quoted 33,500. But company B, if you talk about, company will buy a special unit from RS, which is my group company only, for 13,000. Company B is buying something from RS, that means RS is selling something for 13,000. That means this will have some profitability which we need to eliminate, because that is not the real figure. Your 35,000 is the cost quoted by B. So you will be paying B 35,000. But understand, since B has purchased something from RS for 13,000, suppose RS has transferred something of 10,000 for 13,000. That means this 13,000 includes profit of 3,000. So if I am paying 35,000 to B, ideally I am paying only 32,000, because 35,000 I paid to B, and because of B, my one of the group companies is earning profit of 3,000. That means my cost goes down from 35,000 to 32,000. Now RS also needs to buy the material from RR at 7,500. So RR must have also transferred. Something to RS. RR must have transferred something to RS inclusive of profit. So there are 2 types of profitabilities involved. I will have profit of RS when it sells material to B. I will have profit of RR when it sells material to RS. So both the profits, if both the profits are eliminated, suppose this has 3,000 profit, this has 500 profit. That means ideally when I am paying 35,000, there is an internal profit of 3,500 which is required to be deducted. So 35,000 minus 3,500, the quotation is actually of, it is actually costing me 31,500, which is less than this. Are you getting me? Then there is an inside quotation from RS where the price is 48,000. So if this is a selling price of 48,000, RS must have also included some profit. This would require RS buying part from RR. So 8,000 also includes some profit. RS is buying from RT. This also involves some profit. So basically I just need to remove profit from this and this. RT buys part from RR for 11. So if I have to find out the real outflow from 48,000, I will subtract profit of RS. I am buying from my own sister concern. So ideally there is no actual profit earned. So suppose if the cost is 45,000 for RS, RS is transferring it to me at 48,000. I know that 3,000 is profit earned by my group company only. So for me the cost is actually 45,000. Then I will also reduce profit from 30,000. I will reduce profit from 8,000. I will reduce profit from 11,000 to get the real profit figure, the net cost structure. Now the most important, most vital information. RR is extremely busy with work outside the group and has quoted current market price for all the products. Now, please understand. Your RR is already busy. RR already has enough orders. Now, if in that situation, RR is transferring something to RS, RR is transferring something to RT, naturally, it will have to sacrifice its external sales. They have enough orders from the external market. In this scenario, if RR needs to send the material to RS and RT, definitely there will be some sacrifice of external sales, there will be some sacrifice of contribution. That means there is an opportunity cost involved. So, if there is an opportunity cost involved, then in that case, whatever is transferred by RR will be taken at a selling price only, because if I am reducing profit from this, trust me, in order to execute this, RR will have to sacrifice its external sales and external contribution. Why should I remove it? It is an opportunity loss for me. As a company, it is an opportunity loss for me. So for anything that is transferred, anything which is transferred by RR, anything which is given by RR will be taken at selling price only, market price only. There is no need to reduce the profit. RS cost for RP contract, including purchases of RR and RT, is 42,000. Okay. And for B company, it expects profit of 25% on cost of its own work. Okay. RT prices provided for 20% profit margin on total cost. RT is earning profit of 20%. Variable cost of the group companies in respect of the work under consideration. RR के लिए variable cost is 20% on selling price. RS के लिए 70% of own cost. Own cost is cost excluding material price. For RT, it is 65% of own cost, and that own cost consists of own cost is cost excluding total cost excluding material cost. You are required from the group point of view to recommend with appropriate calculation whether the contract should be placed with RS or A or B, and state briefly assumptions. Now, I have three options. Option number one: buy your material, buy your product from company A, and this is straight away going to cost you. This is straight away going to cost you 33,200. This is straight away going to cost you 33,200. When I talk about option 2, company B, I will have to find out the real cost structure here. I will have to find out the real cost structure here. B is charging 35,000. B is charging 35,000. B has purchased something from RT. Wait, B has purchased something from RS. B has purchased something from RS. That means that profit should be removed. But we will not call it as a profit. We will call it as contribution, because your fixed cost is not getting affected in all these calculations. Your fixed cost is going to be same. If your fixed cost is going to be same, all decisions can be taken based on contribution rather than focusing on profit. So contribution of RS will be subtracted first, and RS has also purchased some material from RR. So that contribution will also be subtracted. But I am not going to do that because RR is supplying material to RS by sacrificing its external sales. So it will not be at cost, it will be at transfer price, it will be at selling price only. So I'm not going to deduct anything from 35,000 as contribution of RR. Otherwise there will be loss only. So opportunity cost needs to be taken into consideration. Then I have option 3. RS is offering me at 48,000. From 48,000 I will deduct contribution of internal sister concern. RS purchased something from RR and RT, and RT has purchased something from RR. So first of all, contribution from RR needs to be subtracted, which I won't, because whenever RR transfers something internally, it is at the cost of external sales. So if not from outside, I want to recover that profit from inside. There is an opportunity cost. RS purchased contribution. RS purchased something from RT. So profit charged by RT should also be removed. And plus contribution of RS will also be removed. Because RS is also has also applied some profit into it. You understood this? Then only I'll be able to get the net figure. Clear? Okay, let us do the calculation of contribution of RS. RS transferred something RS transferred something to company B at 13,000. 13,000 involves purchase from RR where I am not supposed to deduct profit because there is an opportunity cost. So 13,000 minus 7,500. 5,500 must be the sales value of the own work. You understood what I am talking about? 13,000 is a selling price which includes material cost of 7,500. That means balance part is 5,500, which is cost of labor, other expenses plus profit, because profit is not yet separated. How much is the profit given in the question? How much is profit earned by the company RS? 25% on cost. 25% on cost, that means it is 1/4 on cost. 1/4 on cost means cost is 4, profit is 1. So it is profit 1 on selling price of 5. So 1100, because this is a sellable value we have got. 4,400 is your cost of own work for RS. Question says 70% of own cost is variable. Okay. 70% is variable, 30% is fixed. 70% is variable, 30% is fixed. So 3080 variable, 1320 fixed. So in this whole transaction, contribution will be sales minus variable cost. My first variable cost is the material which I purchase from RR and plus my own work 3080. 13,000 minus 7,500 minus 3080. 2420. Selling price minus variable cost. If you don't want to go for this, fixed cost is 1320 plus profit involved is 1100. Profit involved is 1100. My answer is still going to be 2420. It is fixed cost plus profit. So RS has earned 2420 in the transaction. So 35,000 includes 2420 profit, which is earned by my own company. So ultimately for me, the original cost, the net cost is going to be 32,580. Let's go for third option. Acha, for this, I'll be using working note 1. Now I need to know contribution of RR, contribution of RT, contribution of RS. RR cannot have any contribution because there is an opportunity cost. So we'll go for contribution of RS again in its own quotation. Selling price 48,000. Selling price 48,000. Question is saying cost is 42,000. Cost is given in the question. That means 6,000 must be the profit, which is a balancing figure. Now your cost of 42,000 includes material from RR, $8,000, material from RT. Okay, material from RR, 8,000, and material from RT, 30,000. So 8,000 and 30,000 is the material cost. 38,000 is your total material cost out of 42,000. That means 4,000 must be cost of good, cost of own work. Cost of own work. How much is a variable portion given? For RS it is 70%. 70% variable, 30% fixed. So contribution in the transaction, fixed cost plus profit. Fixed cost plus profit is equal to 7,200. If you want to go by sales minus variable cost, take 48,000 minus 38,000 material, 48,000 minus 38,000 total material from RR and RT, 10,000 you are left with, minus variable cost of 2,800. You will still get 7,200 only. So RS has charged 7,200, which needs to be subtracted. I know that it is not my, it is profit earned by RS only, my own company only, so that is not my profit. Let me reduce it. And finally, I'm going for working note 3. Contribution by RT. Now guys, RT has transferred something to RS at 30,000. RS has transferred something at 30,000, correct? That 30,000 includes material from RR. How much is it? 11,000. So sale value of own work will be 19,000. Sale value of the own work will be 19,000. Then the profit will be 20% on total cost. For RS, it was 25% of own work cost. This is 20% of total cost. Profit of RT is 20% of total cost. That means 1/5 on cost. Profit is 1, selling price will be 6th, 1/6 on selling price, and selling price will be this. So I am reducing 5,000 also from this now. I hope you understood the difference. RS was transferring profit on own work. RT is transferring profit on selling price. So I am left with 14,000 as cost of own work. How much is the variable portion of RT? 65% of own cost. So this is 65%, that means this is 35%. 14,000 into 35% will be 4,900. This will be 9,100. So contribution of RT, how much contribution RT has earned? 4,900 fixed cost plus 5,000 profit is equal to 9,900. If you want to go by sales minus variable cost, it is sales 30,000 minus material cost 11,000 minus variable cost 9,100. $9,900 will be the answer only. So that will be taken to this calculation. RT has earned 9,900, RS has earned 7,200. Both are my companies only. That means eventually I have earned 17,100. So instead of 48,000, it is 17,100 less for me. So that comes to 30,900. How much is the ultimate cost for me? 30,900. So that means option number 1. He's an outsider. I did not supply anything, so I have to pay 33,200. B was charging me 35,000, but B has given some profit to one of my companies only, 2420. So for me, the cost is 32,580. RS, my own company, is charging me 48,000, but I know the internal profitability. So my net figure is 30,900. So conclusion will be purchase from RS. Purchase from RS. Is this part clear? So this is what we are supposed to do. See the presentation. You understood? All internal profits were taken care of in this calculation. All internal profits were taken care of in this calculation. Clear? One more question I would like to solve, which is little different, where opportunity cost is considered, and it is an exam question, so you have to be very careful. Please understand the concept. Double Trouble Limited had labor strike in one of its departments recently. A newly recruited trainee accountant prepared the following estimate of the cost of the strike by comparing the budgeted and actual sale quantities for the period of strike. Number of units sold below budgeted 35. Loss on sale of revenue at the rate of 1.25. So ideally it is $35,000. So 35,000 into 1.25. At the rate of that, you have lost 43,750. You have saved material not used for 35,000 units, wages saved since you produced 35,000 units less. So basically 35,000 units you have not produced as compared to your budgeted data. So this is your loss of revenue, this is your saving in material cost. Since you did not produce 35,000, you saved material cost, you saved labor cost. So basically your net loss of revenue is 17,500. Now wages paid during the strike to supervisory staff 500. This could have been avoided had there been no strike. Wages paid to worker in trade union affected by strike. Fixed overheads not recovered. So net cost of strike is 27,750. The department produces only one product and keeps no stock. At the time of the strike, there was a temporary decline in the demand for the product, and it is estimated that actual sales would in any case have been 10,000 units below the budget. So 35,000 I couldn't sell, but 10,000 was anticipated. 10,000 was due to some reason. So this was actually known to me. Sales manager has said that even to reach this volume of sales, he would have to reduce the price of the last 25,000 units sold to 1. So there is a reduction in price. Workers who came in during the strike were used in maintenance work usually undertaken by outside contractor for 3,000 rupees. Material of 1,000 had to be specially bought for the maintenance work. Okay. The company's budgeted overhead absorption rate is based on solely fixed costs that are unaffected by the activity of any one department. Company works on a 5-day-a-week, Monday to Friday. It was agreed as a part of the strike settlement to make up 10,000 of the units lost because of the strike by working on Saturdays at a special wage rate, which will add 25% to budgeted unit labor cost. As a senior cost analyst, prepare a report to the managing director explaining in detail with figures what according to you should be the true cost of the strike. First of all, you need to understand one thing. You have loss of quantity, 35,000 units. Now out of 35,000 units, 10,000 was already expected because it was loss of demand. Correct? Then they have clearly said here, it was agreed as a part of the strike settlement to make 10,000 units loss. So that will be taken care of. that will be adjusted. Correct? So out of 35,000, 10,000 was not due to strike, it was loss of demand. 10,000 will be taken care of. So 20,000 is not an outcome of strike. So 15,000 units we have lost. Lost due to strike. How do you know? Balancing figure. Are you getting me? 35,000 my quantity has gone down. 10,000 was any which way going to happen because there was a loss of demand. 10,000 I'll be able to manage by making my workers work on Saturdays, Sundays or whatever they have mentioned. So balance 15,000 I cannot help it, so that has to be the quantity loss due to strike. So I need to prepare statement of cost and revenue to figure out how much is the loss of profit. First thing first, I'll go for material cost. They clearly told us material and labor 8750 plus 17,500. 8750 plus 17,500, 26,250. $26,250 is a cost of 35,000. I am interested in cost of 15,000. I am concerned with 11,250. No, something went. Yeah, 11,250. Then I have, this is a total of material and labor. Then that additional workers were hired, because of that I saved something in terms of maintenance cost. I would have incurred 3,000. Out of 3,000, 1,000 was towards material. And 1,000 is paid for towards labor. Now that is already covered, no? So only balance 1,000 will be taken into consideration. So this cost is 12,250. This cost is 12,250. You understood this? See, this fellow, the workers who came in during the strike period were used for maintenance, which was outsourced. So now I am not supposed to spend 3,000. I am not supposed to spend 3,000. Material costing 1,000 had to be specially bought for maintenance work. So I saved 3,000, but then I had to incur 1,000 of material and 1,000 towards labor. They have said labor cost you 1,000. Had there been no labor, I would have incurred 3,000. Had there been no strike, I would have incurred 3,000. Had there been no strike, I would have incurred 3,000 if there is a strike, I have incurred 2,000. So the cost of strike is 1,000. Rather, the benefit of strike is 1,000. I saved money. So this is my relevant revenue. I did not incur on material and labor. This money was saved. Had there been no strike, I would have outsourced the maintenance work for 3,000. He would have got material. He would have got everything. I was just supposed to pay him 3,000. He only would have arranged material. He only would have arranged labor and all. I would have simply paid him 3,000. Now, my 3,000 is saved. But against 3,000, I had to get the material of 1,000 and pay 1,000 rupees as a labor charge for strike period to workers. So 2,000 I am spending, 3,000 I am saving. So still there is a saving of 1,000, which is my relevant revenue. Since I did not produce 15,000, my material and labor cost was saved. Since there was a strike, I saved 1,000 as well. So this is my relevant revenue of 12,250. I'll go for relevant cost now. I hope you guys are clear with it. If I'm not producing 15,000 units, I'm not spending on material labor. Plus, instead of paying 3,000, my work was done in 2,000. So there is an additional saving of 1,000. Let's proceed with the relevant cost. Relevant cost means loss of revenue. Relevant cost is loss of revenue. They were planning to sell the product for 1 rupee. They were planning to sell the product for 1 rupee for increasing the demand and all. So I'm not losing 1.25. I'm losing only 15,000. I'm losing only 1 rupee. And then there is some additional wages paid. To additional workers to make up the lost production. See, 17,500 is your actual labor cost of 35,000. 17,500 is your cost of labor for producing 35,000 units. So, to make up on Saturdays, Sundays or on weekdays, you could cover a shortfall of 10,000. So, 17,500 was a cost of 35,000. How much should be the cost of 10,000? It's 5,000. Now, remember, they have paid 25% extra. 5,000 is any which way covered, but they have paid 25% extra, which is due to strike. Which is due to strike. Are you getting me? 17,500 they incurred on 35,000 units. So for 10,000 they would have ideally spent this 5,000 amount. Question says that we have paid 25% more, bacha log. Now, had there been no strike, I wouldn't have paid 25% more. So 5,000 is the labor cost of 10,000, but I have to pay 25% more. So that is because of strike. So that is relevant cost for me. And then finally, we had even this figure to supervisory staff. $500. So you have loss of revenue, 15,000. You have overtime or excess labor cost paid because of strike, and plus you have additional cost paid to supervisor. So 16,750. 16,750 is my relevant cost. This will be marked as B. Relevant revenue will be marked as A. And you have relevant cost or loss, A minus B. You saved 12,250, but you incurred 16,750 more. So 4,500 is your loss due to strike period. You understood this? Simply find out what is incurred due to the instance. See the solution now. Quantity structure first, then statement of cost and revenue. First you get relevant revenue, material labor saved, maintenance cost saved, loss of quantity 15,000 into selling price. They already told us that selling price would be 1. 17,500 was labor cost of 35,000. I found out cost for 10,000. That was a normal cost, but we paid 25% extra. So only the extra part was relevant for me. Any which way, basic 100%, the basic wage rate will be any which way incurred, no? So that is not relevant for you. Something that has happened because of strike is 25%. So 25% is considered, plus salary, additional paid salary paid to supervisory staff, that is 500. So that shows that you saved 12,250, that is fine, but you had to incur 16,750 more. So there is a relevant loss of 4,500 in this calculation. This is what they had asked for. True cost of the strike 4,500. So that was your relevant costing and that was your decision making, guys. Just do what JKC has done, that will be more than enough. Just do what JKC has done, that will be more than enough. Okay, so here we go. We sign off for as far as decision making is concerned. Now we'll be heading towards the next chapter. Yes, the next chapter I'm going to discuss is pricing decision. Of course, we'll be discussing the main part about it. Being a revision, we cannot solve all questions, but then important points will be touched. I'll just first give you overview how pricing is basically decided. For pricing decision, you need to understand the situation first. You need to understand what you're exactly dealing with. If you're dealing with an already established product, your thought process will be different. And if you are dealing with a new product, your strategies will be different. Now, if you are talking about an established product, again there are two scenarios possible. You are not producing anything new, you are not producing anything special, just the routine established product you are producing in a very normal situation. If that is the case, total cost plus profit is the most logical base, ideal base of charging cost to the customer. But then if you have some special offer, then in that case, remember, any which way you are executing your normal production activity, for special order, which is going to be an additional order for you, you are not going to incur any additional fixed cost for that. So in that case, your major calculation will be based on variable cost plus profit, which can also be called as marginal cost plus profit. It's one and the same. Like 1 lakh units I'm producing right now. For basic 1 lakh units, I'll go for total cost plus profit. But after producing 1 lakh units, if I'm getting an additional offer for 1,000 units from someone, I think I've already recovered my fixed cost at the stage of 1 lakh rupees, 1 lakh units. So the only cost which will be incurred on those additional units will be variable cost. So variable cost plus profit can be the base. If you are dealing with a new product, guys, there is a different strategy altogether. First of all, you need to find out whether your product is new for you or it is new for the market. If the product is new for the market, trust me guys, you have to be very careful. If the product is new for the market, you have to be very careful. And ideally, you have 3 different options. If it is new for the market, why would people buy you? So to create an awareness, you may have to go for penetration pricing. Penetration pricing means variable cost plus profit. Your cost will be minimized, your selling price will be minimized. People will notice you and they will come back to you. Because see, if it is new for the market, people are also skeptical about buying it, like electric cars. But for electric cars, penetration policy will not be viable because there is a huge expenditure incurred in terms of research and development and promotion. In that case, you should always go for skimming pricing. Skimming pricing means total cost plus huge profit. Total cost plus huge profit. See what is happening with the electric cars in India. See what is happening with electric cars in India. They are all costly. Why? Because the company needs to recover its huge research and development cost which is incurred on the product. Plus there is a huge marketing required. So all this will cost you a huge amount. Since the product is new for the market, and since you have incurred a huge cost, you better go for skimming pricing. And in some situations, you may also think of going for normal pricing, which is total cost plus your profit. Your total cost plus your profit. Are you guys understanding this? What if the product is new for the company? Ask only one question to yourself. Does it have any special feature? Any positive feature? Something which is not offered by the market? If the answer is yes, you can also think of going for penetration, skimming and normal. But if there is nothing positive, if it is a normal product, then guys, you cannot even forget about skimming. You cannot even recover your total cost because you are competing with the titans which are already there in the market. So you better go for penetration pricing, which is variable cost plus profit. Are you understanding this? So if the product is new for the company, new for the market, like electric cars, the product is new for the market. So in order to recover your huge selling and distribution cost, your huge promotional cost, your huge R&D cost, you may go for skimming. So by the time your competitor enters into the market, you must have recovered major part of your cost structure. So the moment a new competitor enters into the market with a high price, you can bring down your price because you have already recovered major part of your huge cost structure. Since the new competitor has incurred some expenditure on research and development, he will go for skimming policy. His price will be more. You can drop down your price. Again, your product will be highlighted in the market. And you won't be having much problem because you have recovered major part of your research and development costs and promotional costs earlier with a skimming strategy. If it is not possible for you to go for, see, the product is new and but there is no huge response from the people, then make them realize how important the product is, and they will buy your product only if they are finding it cheap, reasonable. So go for variable cost plus profit. If you are going for a new product, which is new product for the company, like for example, if tomorrow Bajaj Auto introduces car, it is not a new product for the market. It is not a new product for the market. There are so many manufacturers who are producing cars. It is a new product for the company. That means whenever you launch your new product, you are actually competing with the existing players in the market who are king of the market. Then you ask only one question to yourself: does your product have any specific feature, any differentiating feature? Does your product have any specific feature? Your product is special? Yes. Then you can go for again these three, because nobody else is offering it. And if it is a normal routine process, then people will not even look at you unless you bring down the price. So variable cost plus profit will be the strategy. So this is what we need when we go for pricing decision. Clear? Now, major questions based on situational analysis can be managed by you, because if you know the chart, you know the sum, you know the answer. Simply see what is the situation given in the question. Accordingly, you decide what is to be done. The problem is when they give you a situation which is different from this and there are some tailor-made adjustments. So I will be solving one question based on that, and that is your question number 12 from JKSC material. It covers pricing strategy, probability concept, also capital budgeting concept. The board of directors of XY Limited are considering new type of handy sewing machines which their R&D department has developed. The expenditure so far on R&D, on research, has been 95,000, and consultants' report have been prepared for 20 to 500. That means the cost is already incurred. That means it cannot be considered for any decision making now. Cost of production per unit, material, labor. You also have fixed overhead absorption rate. Now, if you are going for relevant costing, we don't go for absorption rate, because absorption rate is not a rate at which your cost is incurred. It is a rate at which your cost is recovered, which is used in absorption costing, not in marginal costing decision making, not in the relevant costing method. You are not incurring cost at the rate of 20. The cost is any which way getting incurred, so it is not a relevant for you. You are trying to recover it by charging 20 rupees per unit. Anticipated additional fixed cost, rent is 1,25,000, other additional expenses 70,000. A new machine will be built with the facilities with a cost of 1,10,000. Material 90,000, labor 20,000. Materials are readily available in stores which are regularly used, however, are to be replaced immediately. So machine requires replacement. Scrap value of the machine at the end of the 10th year is estimated at 20,000, and product scraps generated can be disposed of at the end of the 10th year for a price of rupees 1,43,000. So 1,43,000 is what you are going to generate from product scrap. Machine scrap value is 20,000 after 10 years. For first 5 years, your demand is expected to be this, and for next 5 years, your demand is expected to be this. Since there is a probability, we'll have to go for We will have to apply the probability there. It is estimated that the commercial life of the machine will be no longer than 10 years, and after tax cost of capital is 10%. The full cost of the machine will be depreciated on straight line basis, which is allowed by the computing taxable income over a period of 10 years. Tax rate is 30%. Discount factors for first to from first to fifth year 3.79, from 6th to 10th year 2.355, and for 10th year it is 0.386. We are supposed to decide the minimum selling price for the handy sewing machine. You are supposed to determine the selling price for handy sewing machine. Okay, for that you need to first of all find out how many different cost structures we have. We have seen different types of expenses which are directly given: material 45 per unit, labor 75 per unit. We have got some anticipated fixed cost as well. Okay. A new machine will be built with the facilities with a cost of 1,10,000. 1,10,000 consists of material 90,000 and labor of 20,000. Then the question says the price of the material have since been increased by 50%. Material is readily available in stores which are regularly used. Babu, you already have material with you in stock which will be used to constructing the plant. But if you do that, if you use the material in stock for producing an asset, you will have to buy another lot of material to be consumed on a regular basis because it is required to be replaced. And the current value of the material is 50% more. So my value of machine is not going to be, the value of the machine is not going to be 1,10,000, guys. I'll go for depreciation adjustment now. Cost of the machine will no longer be 90,000 plus 20. It will be 90,000 plus 50% and then 20,000. So that comes to 1,55,000. I hope you understood this. You already have material in stock which will be used to completing the machine. If you are using it to complete the machine, the entire stock of 90,000 is used, which needs to be replaced for the regular use. So it is as good as you are buying fresh material for constructing the machine, and the current rate of the material is 50% more. So this will no longer be 90,000 now, it will be 1,35,000, 50% more, plus 20,000, 1,55,000. Then you have your estimated scrap value. Then you have your estimated scrap value to be 20,000. This will be divided by estimated life, 10 years. So depreciation per annum will be 13,500. Depreciation per annum is going to be 13,500. Now, as far as quantity is concerned, you can prepare a working note in the exam, but I am showing a calculation here. 40,000 into 0.15, 6,000, 60% of 20, 12,000 into 25%, 3,000. So 21,000 is the initial quantity, and this will be 24, 72, 16, 85 and 4, 2, 8. So this will be 16,000. So your quantity is expected to be 21,000 for first 5 years, and it is expected to be 16,000 for next 5 years. Now, since we do not have selling price, I'm assuming selling price to be X. Let the selling price be X. Let the selling price be X. So, we can actually prepare a statement of profit now. Yes, so I am going for statement of profit for first 5 years, next 5 years. Here I am producing 21,000 units, and here I am producing 16,000 units. We did this in the textbook. Sales X is the selling price. So 21,000x and 16,000x will be the selling price. Then I have material cost to be recorded at the rate of 45. They have clearly given us material cost as 45, labor cost as 75. So you can get the total. 45 plus 75, 120. So, material and labor at the rate of 120. 25 lakh 20,000. lakh 20,000. Got it? Apart from this, there is an additional fixed cost of 1,95,000 which will be incurred. So, since this is getting incurred because of the scenario, it is a relevant fixed cost for us. Absorption rate I cannot take. Relevant fixed cost 1,95,000. Depreciation also becomes relevant because it is getting incurred, because it is happening just because we are accepting the proposal. So, guys, sales will be marked as 1. Sales will be marked as 1. Cost will be marked as 2. 2520. 195, 13,500, 27, 28, 500, 27, 28, 500, and 19,20,000, 1,95,000, 13,500, 21, 28, 500. So, I will be getting profit before tax here. 21,000x minus 27,28,000, and this will be 16,000x minus 21,28,000. Tax rate is 30%. So, 70% will be the answer. Yeah, this is your profit. Since there was a tax involved, there was tax adjustment involved, we consider depreciation. But if you want to talk about cash flows, guys, if you want to talk about cash flows, I will have to add back 13,500. So 19,09,600 plus 13,500. This profit 19,09,600 is after depreciation, no? We'll have to add back 13,500 to this. So 18,96,100 and 11,200 x 14,89,600, 14,76,000. It should be 28,500. This should be 550. This should be 1489,950. $1489,950 minus 13,500, 1476,450. This is my cash flow for first 5 years and next 5 years. If you are going for present value factor, we'll simply apply and in the last year we will get a scrap value of asset which is 20,000. So 20,000 into 0.386, 20,000 into 0.386 plus last year your product will be scrapped and the product scrap will generate a revenue of 1,43,000. If it is 1,43,000 on 1,43,000, if it is a revenue generated, you will have to reduce 30% tax. You will have to reduce 30% tax. So that will be 1,100,000. So you can always take 1,20,100. 1,20,100, which includes 20,000 machine scrap and post tax product scrap, because that is going to increase the tax liability, being an income. Now, if you solve this, you will get two equations, and when you add these two, equate it to 0, because ultimately your net present value has to be 0, no? And you will get value of x, that will be your selling price. This was completely on the basis of relevant costing concept. If you don't want to go for relevant costing concept, what you can do is, you can take this profit, plus you can also deduct some additional fixed cost. 21,000 into 20 rupees is the absorption rate, no? So 21,000 into 20, 4,20,000 will be the additional cost to be deducted, and here 3,20,000 will be the additional cost to be deducted. Then you also have research and development cost, 1,17,500 incurred for 10 years. So you can also take it 11,750 here, 11,750 here. You understood this? You will get some revenue post tax, use it in the equation. The scrap value of last year will remain same, equate that, the value will be little high because you have added fixed cost. So if you talk about minimum selling price, guys, minimum selling price is something that stops you from getting loss. Minimum selling price is something that stops you from getting loss. You understood what I've said? My first calculation which I showed you, it was based on only relevant concept. If I'm going to spend, I will consider the cost. My second calculation was based on total cost. So naturally, my second calculation will give you a little higher fixed cost. So if you really want to go for a minimum selling price, it has to be a selling price without profit, without loss. It is not going to give you profit, that's fine, but it is not going to give you loss as well. That is your minimum selling price. So ideally, we should always go for relevant costing concept for determining minimum selling price. So that was about pricing. In pricing, there is one more concept called as profit maximization pricing. In case of profit maximization pricing, you need to understand your price is an outcome of A minus BQ. The price is an outcome of A minus BQ. Now you already know what is it. Now A stands for the maximum selling price at which the demand is 0. B stands for price slope. Price slope means change in price upon change in quantity. And Q stands for the routine quantity. So let me solve that question first, then we'll go for the next one. In pricing, either they will give you a scenario consisting of these situations. You will have to select the best strategy. 99% questions will be of this type. Still, we solved one question based on capital budgeting where minimum selling price was asked. Minimum selling price is the one which does not give you a loss, but the price is minimum. So I did not go for total fixed cost calculation. I went for relevant fixed cost calculation. If you go for total fixed cost, some additional fixed cost was also getting considered. So it is better to go for relevant fixed cost calculation. And now I am going for profit maximization model. Question number 13. Bethway India Limited is an ISO certified company. The company manufactures diverse range of products. To manufacture wagons, BIL undertakes structural fabrication jobs and manufacturing and retrofitting the EOT crane. It is presently the flagship company of the Bethway Group, comprising of renowned companies such as Krishna Agriculture, Chirag Phosphate and all. I have just given you some redundant information. Look at this one. We have two departments, two divisions. One is bogie division and the other one is wagon division. Naturally, bogie division produces bogies and wagon division produces wagons. Bogie division manufactures bogies and wagon division manufactures wagon. To manufacture a wagon, we need 4 bogies. Bogie division is the only manufacturer of bogies and supplies both to wagon division and other customers. Fixed cost, variable cost, capacity. Market research has indicated that the demand in market is different. Dekho, for bogies, quotation price is 3,20,000. No tender will be awarded. So if we place an order, if we place the selling price, if we quote the selling price to be 3,20,000, demand will be nil. So this is my A. The maximum selling price at which the demand is 0. But the demand will increase by 30 bogies for every 10,000 reduction in the price. So change in the price 10,000, change in the quantity 30. So this is your B. For wagon, quotation price is 17 lakh 10 and slope is for every 50,000 fall in the price, 2 bogies will be affected. Rise in the price, bogies will be affected. Fall in the price, bogies will increase, but 2 bogies. Further, bogie division is the only manufacturer of bogies, but due to increased demand, competitors are entering into the market and they are planning to go for quotation price at which the wagon will maximize profit. We are supposed to find out at which price wagon will maximize its profit. Okay. Now the concept is P is equal to, the price should be A minus BQ. Okay. Now we know A is 3,20,000, but then slope also we know, but we don't know the quantity. Okay, we'll first decide selling price for wagon. We'll first decide selling price for wagon. See guys, wagon cost you 4,80,000 in terms of variable cost. Wagon cost you 4,80,000 in terms of variable cost, plus you also need 4 bogies. Now, 1 bogie eventually cost you 2,20,000. 1 bogie actually cost you 2,20,000. You need 4 bogies, plus there is some additional variable cost as well. So 8,80,000. 13,60,000 per unit is your variable portion. Now, since we do not have quantity structure, we will go for another concept, which is marginal revenue is equal to A minus 2BQ. You already know why are we using it. I am not wasting time in that. Since I don't have quantity structure, I'll have to first find out quantity structure. Now, marginal revenue is equal to marginal cost. So, your marginal cost will be 13,60,000. Your marginal cost will be 13,60,000. Your price for the wagon is 17,10,000. Price for the wagon at which the demand will be 0 is 17,10,000. Slope for wagon is 50,000 upon 2. BQ, Q we don't know. Now, if you solve this, (1710) minus 1360 divided by, your answer is 7. 7 wagons you would need. Okay. So, now this is what you have calculated under an assumption that bogie division will transfer its material at, bogie division will transfer bogies at 2,20,000. But please remember, bogie division also exists for profitability. So, bogie division will never agree. Bogie division will never agree to transfer bogies at cost. So, bogies will be transferred at selling price, which will be of course called as transfer price. So, with that I need to first find out selling price for a bogie. Selling price for a bogie. So, again P is equal to A minus BX is or BQ is required to be done. Again we need to know the variable cost of bogie. Variable cost of bogie is going to be 2,20,000. Variable cost is going to be 2,20,000. Okay. So now maximum price for bogie is going to be 3,20,000. Slope for bogie is 10,000 upon 3, and quantity, well, we don't know. Quantity structure we don't know. Okay, then if this formula cannot be used, we will go for marginal revenue formula A minus 2BQ. So 2BQ, and this will be equal to 2,20,000, which is your variable cost. So 20,000 divided by 30, 150 is the answer. When you don't have information about quantity, you apply the formula of marginal revenue is equal to marginal cost. You already know variable cost of producing bogies. It is 2,20,000. So 2,20,000 is a variable cost. 3,20,000 is the highest selling price at which the demand is 0. 2. So instead of this, we are using this formula, which gives me quantity. And the moment you get quantity, you can decide price. 3,20,000 minus 1,000 upon 3 into 150. So that comes to 2,70,000. Oh my God! So transfer price will now be 2,70,000. So I cannot take 2,20,000 there. You understood this? Ideally, bogie division should transfer at cost because we are forming part of the same company, but then bogie and wagon both are maximizing their profit. So bogie division will always try to sell the product at a selling price, at a maximum profit maximizing selling price. So we found out that bogie division would prefer transferring bogies at 2,70,000. Bogie division will prefer transferring bogies at 2,70,000. So each bogie will cost you 2,70,000. So variable cost of wagon division will be 2,70,000 into 4, because we need 4 bogies, plus 4,80,000. So now it is not going to be 13,60,000, it is going to be 15,60,000. So 15 lakh, again A minus, A is 1710 minus 2, 50,000 upon 2, and how much is Q? Q we'll have to find it out. So 1710 minus 1560 divided by 50. So the answer is Q now. So 3 wagons you need. Okay. 3 wagons you need. So 3 wagons is Q. B is 50,000 upon 2, 25,000. 75,000 should be reduced from 17,10,000, and the selling price is going to be 16,35,000. You understood this? Bogie division, wagon division. Bogie division transfers to wagon. Ideally, the transfer should have been at variable cost because we are within the same organization. But since bogie division wants to maximize its profit, it is transferring at transfer price, which is the selling price. We need to first find out, we had to first find out selling price of bogie. That came to 2,70,000. So instead of 220 variable cost, bogies will be transferred at 270. So naturally, instead of 220, we'll have to take cost for wagon division 270. So instead of 4 bogies at 220, 4 bogies will be received at 270. That will change the cost, that will change the quantity structure, which is used later on to know the revised selling price to be 16,35,000. On calculate, we calculated that. You understood this? So A minus BQ will give you P. What if you don't have quantity about Q? Your marginal revenue and marginal cost are same when your profit is maximized, and your marginal revenue, marginal cost is A minus 2BQ. So you take variable cost of the product, then take the selling price at which the demand is 0, the maximum selling price, minus 2 into B. Q will not be available. So, but this formula will give you Q, which can be later on applied in this formula. It is that simple. That is all about pricing, guys. So first of all, you be very clear about the chart. 90% chances are there that question will be based on the chart only. They will tell you this should be the profit, that should be the profit, profit should be 5% of capital employed. They will give you capital employed, apply 5%, add to cost structure, get the profit figure and add to cost structure. So they will give you chart wise situation. Then you have to decide whether it is skimming, penetration or normal. They may give you existing established product, but special offer. Special offer, that means your existing quantity will be there. So special offer will require only variable cost to be incurred. So it is variable cost plus profit. So either situational or some probability wise calculation was also done. And they may give you this also, profit maximization theory. That's all, guys. In pricing, there is nothing much to be discussed. Now we'll be starting with the next chapter, divisional transfer price. Yes, the next chapter which I was talking about is divisional transfer pricing. See, there are two types of pricing. One is external pricing and one is internal pricing. External pricing is something that you where your outsider is connected to the concept. Whenever you sell your product to an outsider, it is external pricing. Whenever you transfer your product to another department of the same company within the same organization, it is transfer, and transfer can be at selling price. Of course, we don't call it as a selling price, we call it as a transfer price. The calculation is pretty simple, the format is pretty simple. They may ask you statement of profit of both. They may ask you statement of profit to be prepared for transferor company and transferee company. Transferor company is the one which transfers the output, transferee is the one which receives it. So there can be sales. There can be two types of sales, external sales and internal sales. External sales is when both these companies sell their product to an outsider, and internal sales means whenever a transferor company, transferor division transfers goods to transferee company. Ideally, there won't be such thing here in transferee company. So this is total revenue of transferor. From this, you are supposed to subtract the cost structure in the form of variable cost, fixed cost, and then there is transfer price to be recorded. Whatever is revenue for a transferor company will be considered as cost for transferee company. Whatever is the revenue for transferor company will be considered as cost for transferee company. So this is your total cost. 1 minus 2 gives you either profit or loss. So, cost of the price at which it is transferred to transferee company is the cost for transferee company. This is a structure we need to follow. Now, how do we decide transfer price? See, if your product doesn't have external market, if your product doesn't have external market, that means your division is set not to sell your product outside, but to transfer the product to the other department of the same company. Then in that case you can take total cost and add some reasonable profit. If there is no external market, that means the transferor department is set to produce output to be transferred to transferee department. So, total cost of the department plus profit can be considered as a base. What if there is external market? External market exists. External market exists. If your external market exists, that means transferor department has an option of selling output to the external customer. Plus, he can also transfer its output to the other department of the same, organization. Then the question arises, is there any idle capacity? Is there any idle capacity? If there is no idle capacity, capacity of transferor department is 10,000, you are also producing 10,000, you are also producing 10,000 and 10,000 are getting sold to the external customer. Then in that case, if there is no idle capacity, that means in order to fulfill the requirement of your existing, your sister concern within the same organization, you will have to sacrifice your outside sales. And if you are sacrificing your outside sales, your transfer price is equal to market price. You are department A, I am department B. You can sell entire lot of 10,000 in the market and earn profit. If you are giving those suppose 500 units to me, why would you do it at loss? You have a market for all 10,000 units, you can earn profit on all 10,000 units, the same profit figure, the same selling price you will charge to me, because you don't want to be at loss. Are you getting me? So, if there is no idle capacity, that means the transfer has to be at market price, otherwise you will be at loss. What if there is idle capacity? Now, if there is an idle capacity, situation will keep on changing the price. You can go for marginal cost plus profit, total cost plus profit. You can also take a decision of transferring it at total cost. You can also apply some percentage of profit. Choice is yours. All these factors will be specified in the question. This you should know. There is no idle capacity. That means I will have to sacrifice my external sales, and if I am sacrificing my external sales, whatever selling price I would have earned from outside market, the same selling price will become transfer price for me, because I don't want to be at loss. But other things will always be specified for you. Okay, now we'll solve only important questions quickly, so that even this chapter will be revised. I am anticipating some questions from this chapter. Here we go. Let's go for the first one. Question number 10. A company is organized into two divisions. Division X produces a component which is used by Division Y in making of a final product. The final product is sold for 540 each. The final product is sold for 540 each, and Division X has a spare capacity to produce 2500 units. Division X produces a component which is used in Y. So, X will transfer its component to Y. Final price, that means output of Y, will be sold for 540. Division X has a capacity to produce 2500 units, and Division Y can purchase the entire production. The variable cost of Division X is 256.50. This is selling price of Y, and this is variable cost of output of X. Please don't get mixed up. Division X informed that due to installation of new machines, its depreciation cost has gone up, and hence wanted to increase the price of components to be supplied to Division Y to 297. So, this is my proposed transfer price. However, Division Y can buy the component from outside at 270 each. This is market price. X wants to transfer at 297. Y says it is available in the market for 270. The variable cost of Y is 202.50. Present a statement indicating the position of each division and the company as a whole, taking each of the following situations separately. Each of the following situations separately. Okay, let's go for the first one. There is no alternative use of production facility of X. Will the company benefit if the division Y buys from outside at 270? Guys, there is no alternative use of production facility of X. So, if Y starts buying the material from outside, X will no longer be required. So, we will have to show the profitability now. Division X, Division Y, total. This is as per point number 1. I need to go for sales, external, transfer. Then I need to subtract. Variable cost, fixed cost, and even transfer price. So that we will get profit or loss on the last line. Okay. So, 2500 units are to be transferred. So, there is no external sales. as per the first requirement in the question. So 2500 into 297 is the proposed figure. 2500 will be transferred at 297, 7 lakh 42 500. Naturally, here the cost will be 7 lakh 42 500. Revenue of X is cost of Y. 2500 into variable cost per unit is required to be done in both the cases. It is 256.5 in case of X, it is 202.5 in case of Y. 2500 remains constant, 256.5. 641, 250. 506, 250. This is what we are incurring. So, $11 lakh 47,500 is total variable cost. There is no fixed cost separately given, so we will not write anything. And 2500 units of Y will be sold at 540. $13,50,000 will be the revenue of transferee. It doesn't transfer anywhere else. So 13,50,000 is going to be the total revenue of the company, because this cannot be considered as revenue, because revenue of one department is cost of the other department. So 742,500, 13,50,000, 641,250, 1248,750 will be the total cost. So currently 1,01,250 is the profit of the first department. Then you have 1,01,250 profit of the second department. 2,02,500 is a total profit. You can see this. 13,50,000, 11,47,500 will also give you the same answer. So this is your existing profit. Correct? Right? Now situation number 1 says, okay, this is your existing profit. Now situation number 1 says that we are buying material from outside. If we are buying material from outside, then this transfer won't take place. This department will not exist. This profit will be vanished. And cost here will be 2,500 into 270, 675. 2,400 into 270, 675. So 270 will be the buying cost and 202.5 will be the variable cost. To 472.5 will be the total cost of Y on 2,500. So 11,81,250 will be profit, which will be deducted from 13,50,000, which will be sales. So 1,68,750 will be your profit if we 1,68,750 will be the profit if we buy it from outside. But how is it possible? Earlier it was buying at 297. Understand, we were transferring it at 297. It was received at 297. But if you see from the company's perspective, the transfer was within the organization. That means from company's perspective, item of 256.5 was getting transferred at 297. That means ultimately whatever you produced at 256.5 was transferred. So now if you are paying 270, earlier for company the cost was 256.5, the company is paying 13.5 extra. 13.5 extra into 2,500 is 33,500, which is the difference of these two. 33,750, which is the difference of these two. You can check your answer. 168,750 if you add, you will get 202,500. You understood this. For department Y, 1,68,750 is the profit. Department Y is happy, but not the company. Earlier, material or product of 256.5 was getting transferred at any value, but ultimately from company's perspective, it was a transfer of 256.5 material. For the same product, company has started paying 270 to an outsider. So company has started paying 13.5 more. So the proposal is not to be accepted. You understood the second part, or rather the first part. Second part. If internal facilities of X are not otherwise idle, an alternative use of facilities will bring annual cash flow of 50,625. Should division Y purchase the component? Now the question is saying, division Y is buying material at 270. Division Y is buying material at 270. So naturally the cost will be this, the profit will be this 168,750, and the idle capacity here of department X will be utilized and some profit will be generated. So 168,750 any which way I am going to earn, plus how much is the profit generated from rental? 50,625. My overall profit will be 2,19,375. I don't mind accepting the proposal. You understood this? My profit was reduced by 33,750 due to point number 1. Now 55, someone is ready to pay me 50,000 for by renting this infrastructure of department X. There was a loss of 33,750. That loss of 33,750 is recovered. Since I am not using department X for department Y, there was a loss. Item of 256.5 was purchased from outside at 270. That is why my profit went down by 33,750. But now if someone is giving me rent of 50,625, loss of 33,750 and profit of 50,625 will give me more profit. Net effect will be profit. I don't mind accepting the proposal. Then I have third one. There is no alternative use of X and the selling price drops by 20.25. Should division Y purchase from outside supplier? Market price is 270. If it is dropping down by 20.25, it is going to be 249.75. If it is 249.75, I would definitely interested in buying the material from outside, because if I produce it If I produce it in department X, it is going to cost me 256.50. Instead of that, if it is available at 249.75, I think it's going to be a fair deal. So I would always be interested in buying it from the market. So if I do that, see, if I do that, instead of this, you will pay 249.75 into 2,500 plus your 5,06,250 variable cost. 11,30,000 will be your cost minus 13,50,000. Still your profit is 3,19,375, which is more than 2,02,000. Common sense it is. Reduction in selling price from the external market is taking your price for the external product below the variable cost. The product which was available for 270 per unit will now be made available at 249.75. If I decide to produce it in-house in department X, it will start costing me 250, it will cost me 256.5. Might as well I'll buy it at 249.75. Still it is increasing my profit. And the last part is theory that we discussed in the form of chart. So that was your transfer pricing question based on relevant costing. You can do it orally. See, of course, you will be required to prepare 3 statements of profit apart from whatever we have done in the solution. I just wanted to revise things, so I'm solving them. I'm taking up this question, whereas all different types of situations are getting covered. Now let me go to the next question. Question number 12, where there is a foreign exchange transaction to be taken care of. ABC miners operate 2 divisions, one in Japan and the other in United Kingdom. A mining division is operated in Japan, which is rich in raw emerald. The other division in United Kingdom, which is a processing division, it processes the raw emerald into polished stone fit for human wearing. The cost details of these divisions are as follows. Variable cost for Japan and United Kingdom per carat, and fixed cost is also available. Several polishing companies in Japan buy raw emerald from the local mining companies at 9,000 yen per carat. Current foreign exchange rate is 50 yen per pound. Income tax rates are 20% and 30% in Japan and United Kingdom respectively. It takes 2 carat of raw yellow emerald to yield 1 carat of polished stone. Polished emerald sells for 3,000 pounds per carat. Compute the transfer price for 1 carat of raw emerald transferred from mining division under 2 methods. One is 200% of full cost. 200% of full cost. Now, emerald cost you 2,500 in terms of variable cost, 5,000 in terms of fixed cost. So, total is 7,500 yen. They are talking about 200%. They are talking about 200% to be the transfer price. So, basically double. So, it will be Japanese yen. It will be Japanese yen of 15,000. Or after considering the exchange ratio, you can also say it is 300 pounds. The transfer price as per the first answer. And market price, well, market price is already given 9,000 Japanese yen. or if you divide it by 50, you will come to know it is 180 British pound. That's not important. The next part is important. 1,000 carats of raw emerald are mined by Japan Mining Division and then processed and sold to UK Processing Division. Compute the after-tax operating income of each division under both transfer pricing methods. Will this simply solve one to make you understand the concept? Second one will be the replica of the first one. Will not waste time in that. So we'll go for the first only. The transfer price is either 300 pounds or 15,000 Japanese yen. So let's go for the table. See, we'll solve only by one method. Only the amount will change. That part we can discuss orally later on, but we will not waste time in solving it once again. So statement of profit, Japan, UK. The transferor is Japan, transferee is UK. We will have to start with sales. External तो है नहीं. Your transfer will be at 15,000 Japanese yen. Japanese yen less variable cost, fixed cost and transfer price, rather transfer cost. So we can have profit calculation on the last line. This is A, this is B, profit will be A minus B. Now your variable cost is given 2,500 per carat. We are going for per carat only. The entire calculation is done for 1 carat only. So we can take variable cost to be 2,500. Your fixed cost is given to be 5,000. We are not getting any transfer done. But then 15,000 yen will be recorded as 300 pounds. So cost will be 300 pounds. And each emerald is, each product is sold by UK for 3,000 pounds and the cost is 150 pound and 350 pound. So 15,000 is the revenue in yen, 7,500 is cost in yen. So 7,500 is your profit per carat. And here 3,000 is revenue, 800 is cost. Now if you take this, this is the biggest blunder that you are making. Reason. If you are transferring 1 unit, you can take 300. But remember, this is fine, but this can't be taken as 300. Now I'll tell you the reason. We are dealing with each and every division individually. So 1 unit was transferred, so we consider transfer price of 1 unit only. 1 unit was transferred, so we consider transfer price for 1 unit only. But 1 unit of final emerald will need 2 units of raw emerald. So, it will not be taken as 300, it should be taken as 600. It will be 300 pounds into 2. So, 1100 will be the cost here. Have you understood this? These are separate calculations. They have asked you to find out profit of 1 unit. 1 unit of transferer gives me this 7,500. 1 unit of transferee requires 2 units. So, this will be an individual calculation. This comes to 1900. Multiplied by quantity. If you do, how much is the quantity given? Thousand carats is transferred. So, this is on 1000 carats, but this will be 1000 carats will generate only 500 carats of final product. So, this comes to 75 lakhs and this comes to 9.5 lakhs minus tax. Japanese tax rate is 20%. So, 15 lakhs and this is 30%. So, profit after tax will be 60 lakhs and 6,65,000. If you take the other transfer price, which we decided to be 9,000 or 180 pounds, then you will take 9,000 here. Here it will be 9,000 and instead of 180 pounds, this will be 2 carats, no? So, 360 pounds. Accordingly, your profit will change and answer will change. Rest everything will remain same. So, it wasn't a big deal. You just remember one thing, 1 unit of output of Japanese subsidiary will generate 2 units of finished goods in terms of UK output, UK subsidiary. This is what we were supposed to do. Is this clear? Next question is question number 20. Department X is a profit center manufacturing product VX, X1 and XT. Each of the products can be sold in the outside market to the extent of the following. VX 900 units, X1 300 units, XT 600 units. Market price per unit is 24, 23 and 20 for VX, X1 and XT respectively, and they have given us variable structure and labor hours required for each type of product. Product VX can be transferred to department Y, but the maximum quantity that must be required to be transferred is 400 units of VX. Manager of department Y has powers to buy VX from the external market at a cheaper rate of 22. What should be the transfer price of each unit for 400 units of VX if total labor hours are available only to the extent of 4800 and 6200? First of all, how many units we are planning to produce? 900, 300 and 600. 900, 300 and 600 will take 3 hours, 2 hours, 4 hours respectively. So that comes to 2700, 600, 2400. So 5700 is my existing requirement, whereas my available hours are 4800. That means there is a key factor. That means there is a key factor. Now, if 24 is the contribution, 17 is the variable cost, contribution per unit, 24 is the selling price and 17 is the variable cost, 7 will be the contribution. In case of the second product X1, 23 is the selling price, 12 is the variable cost, so 11 will be the contribution, and in the third case contribution will be 6 rupees. 3 hours you work, you get 1 unit, that 1 unit gives you 7. So contribution per hour, which is required whenever there is a key factor, will be 2.3333 recurring. This will be 5.5 because you are working for 2 hours, you are getting 1 unit, that 1 unit is earning contribution of 11, 5.5, and this will be 1.5. So ranking wise, first, second and third. Ranking wise, first, second and third activity rank will be the priority. So if I talk about type of product, it is X1, Vx and then X2, correct? Chalo, let's get started then. I need 300 units of X1. 300 units of X1. Each unit takes 2 hours, so total hours will be 600 out of 4800. Now I'll go for the existing. Now I'll go for Vx. 900 is the requirement. 900 is the requirement. 3 hours I have to work for 1. Now the question has said another 400 units are required to be produced. So Vx will be produced, this time it will be produced for transferring it. Still 1 unit will take 3 hours, 1200 is further time utilized. So 600 and 3900. So you guys are left with only 300. You guys are left with only 300. That will be given to XT. That will be given to XT. Now in 300 hours, at the rate of 4 per hour, at the rate of 4 hours per unit, 75 units can be produced. Are you getting me? So now it is very clear that in order to produce additional quantity of Vx, quantity of XT has to be reduced. Quantity of XT has to be reduced. That means there is an opportunity cost. That means there is an opportunity cost. See, your contribution per unit is 6. Your contribution per unit is 6. Correct? That means you are sacrificing something. Now, if I don't go for this, please remember, if I do not go for this, you can show that calculation earlier. If I don't go for this, 2700 plus 600, 3300 hours will be utilized for X1 and Vx out of 4800. and out 1500 hours will be left, which will be utilized for XT. 4 hours are required for 1 unit of XT. So in 1500 hours, 375 units were getting manufactured. The day I decided to go for VX to be produced, instead of 375, the quantity has gone down to 75. You understood? I've done it directly. Now it is the last day, so you know all these things. As per my original calculation, ideally, whatever time is left after producing 300 units of X1 and 900 units of VX, I am left with time in such a manner that I will be able to produce 375 units. 3,300 hours are utilized out of 4,800, 1,500 hours are still pending, which will be utilized for producing XT. So 375 units were any which way possible to be produced. But because of that additional quantity now, I will be able to produce only 75. So at the rate of 6 rupees, I am losing contribution on 300 units. So my opportunity loss is 1800 rupees. My opportunity loss is 1800 rupees. Earlier I could have produced 375 units of XT. Now I am producing only 75 units of XT. That means 300 units are no longer produced, and I am not earning 6 rupees per unit based on that. So 1800 if it's what I am losing. So 1800 I want back from these 400 units, because additional quantity of VX is 400. So my 1800 must be given back by those 400 units. This burden will be borne by those additional units only. So 4.5 is my opportunity cost. In that case, 17 is a variable cost of VX. 17 is a variable cost of VX. We will charge 4.5 extra. So 21.5 will be the value. Why so? 17 I will incur to produce 400 units, 17 per unit, and 4.5 I am losing. So I want that opportunity cost back. I want that cost back. So $17, the actual variable cost, relevant variable cost, plus 4.5 my opportunity cost, 1,800 I am supposed to recover on the basis of 400 units. So 21.25 should be the transfer price. Second one says 6,200 hours. Second calculation says 6,200 hours, same activity is to be done. Instead of this, we'll take 6,200 hours. If you are going for 6,200 hours, that means you had ample time. You could have easily produced 600 units of XT. Out of 600 units of XT, we will have to find out now how much you are actually producing. $600 will be used for X1, 2,700 will be used for VX, 1,200 will be used for additional quantity of VX. So 5,700 gone, 5,600, 2,700 and 1,200. 4,500 hours are utilized out of 6,200. 1,700 hours will now be utilized exclusively for producing XT. So I can clearly see around 425 units getting produced. If I wouldn't have gone for this, if I wouldn't have gone for VX additionally, I would have been left with 600 plus 2,700 minus 6,200. 2,900 hours divided by 4. 725. That means all 725 demand doesn't exist. So 600 units you could have easily produced. Or your demand is more than 5,700 hours requirement, no? So ideally, I could have, since the number of hours are so much, I could have easily produced 600 units of XT. But instead of 600 units, I have to settle for 425. So 600 minus 425, I am losing 175 units. I have to sacrifice 175 units of XT. 175 units of XT will now be multiplied by 6 per unit. 1050 is my profit, loss of contribution. This is my profit loss, which is a loss of contribution, which needs to be added to transfer price, to variable cost. 17 rupees is a variable cost of Vx plus 2.625. So 19.625 will be charged as a transfer price as per the second calculation. This is your transfer pricing all about. So this was a combination of key factor and transfer pricing. So I feel this is important. I hope you understood this. Initially, see, my requirement was 5,700 hours. If you give me 5,700 hours, entire quantity can be produced. In first case, there was a key factor and I was capable of producing only 375 units of XT, being a last ranker. Since I introduced additional production of 400, that number 375 units of XT was reduced to 75 units. So 300 units were sacrificed. Each unit gives me contribution of 6. 1800 was my contribution lost, which was supposed to be recovered as opportunity cost from 400 units, additional units of XT. So I added that to 17 rupees variable cost. In my second example, since my requirement was 5,700 and time was 6,200, all 600 units of XT were possible to be produced. But because of those additional units of Vx, I could produce only 425 instead of 600. So I lost 175 units multiplied by 6 per unit contribution. 1050 is the opportunity cost. It's a contribution lost, which was supposed to be recovered based on 400 units. 2.625 must be added to the variable cost and 19.625 will be the cost, the transfer price to be charged. I really feel this question important because it's a combination of key factor as well as transfer pricing. Don't ignore this. Question number 14 is the next question. Great Vision manufactures a wide range of optical products, including lenses and surveillance cameras. Division A manufactures lenses while Division B manufactures surveillance cameras. The lenses that Division A manufactures are of standard quantity that has a number of applications. Due to huge demand in the market for product of Division A, it is operating at a full capacity. So Division A is operating at a full capacity, which is manufacturing lenses. That means there is no idle capacity. It sells its lenses in the open market for 140 per lens and variable cost is 110. While the total cost of production is 125, we don't need total cost of production. We are happy with variable cost and selling price. The total production cost of a camera by Division B is 400 each. So finished product of Division B is produced at 400. Currently Division B is procuring lens from foreign vendors at 170 each. So the lens which is getting sold by Division A at 140, similar lens is purchased from a foreign supplier at 170. That means company is currently producing lens in 110 rupees in Division A. Company is selling it to the external market, to the external customer at 140. But for Division B, company has to buy it from the foreign vendor at 170. That means it is clear cut wastage of cost structure. The management has a great vision that has proposed that to take advantage of in-house production capabilities, and consequently the procurement cost of lens would reduce. It is proposed that Division B should buy an average of 5,000 lenses each month from Division A at 120 per lens. It is proposed that Division B would buy on an average 5,000 lenses at 120. The estimate of surveillance camera is as follows. Other components 150, cost of lens 120, variable overheads 30, fixed overhead 50 per unit. 50 per unit has got nothing to do with us. It's a absorption rate, not the rate at which the cost is incurred, so we will ignore it. Each surveillance camera is sold for 410. So you are producing it at 400, you are selling it at 410, and since the price of the material is 170, the cost is high. Any increase in price in camera would reduce the market share. Therefore, Division B cannot pay Division A beyond 120 per lens procured. Great Vision's management has uses return on investment as a scale to measure the divisional performance and marginal costing approach in decision making. Analyze the behavioral consequences of each division when Division A supplies lenses to Division B at 120 per lens. Substantiate your answer based on the information given in the problem. Okay. Analyze, second part, analyze if it would be beneficial for the company as a whole for Division A to supply lenses to Division B at 120 per lens. Okay. Third one, do you feel that divisional manager should accept the internal division transfer principles? If yes, calculate the range of transfer price. And fourth one is advise alternate transfer pricing models that a chief executive of the company can consider in order to change the attitude of divisional heads if they are against the transfer policy. So, first thing first, analyze the behavioral consequences of each division when Division A supplies lenses at 120. Analyze if it would be beneficial for the company as a whole. That means from company's perspective also we are supposed to find out. Okay. So, we will first go for individual calculation. We will first go for individual calculation. We will talk about Division A. There are two scenarios. Division A sells, right now it sells the product to an outside customer at 140. Variable cost is 125. Variable cost is 125. So, outsider is giving me profit of 15 per unit. But when I transfer it at 120, there is a straight loss. So, ROI, return on investment, if you want to calculate, when they say return on investment, that means it is return on cost. So, it is 12% ROI. There is no ROI here. And if you talk about Division B, selling price is 410, 400 is what the company is incurring, 10 is the profit. So, 10 divided by cost of investment of 400. $2.5. Selling price will remain same. Selling price will remain same, but the cost will be different now. Total cost of the camera is taken to be 350. Even if you consider fixed cost, it's going to be 350. Since they are interested in total investment, we are going for this. So, 60 on 350. 17.14. See, we are not taking any decision here. If you are taking any decision, you are using relevant costing, then your fixed cost will be skipped. We are calculating profit. For profit, you need to consider fixed cost. For decision making, it will be ignored. So this is as per the current scenario. Second part says, if the transfer price is accepted, is it going to be beneficial? Instead of 140 by selling it in the market, division A will be getting only 120, so there is a loss of 20. Division B, if I talk about, instead of spending 170, the lens will be available for 20. There is a profit of 50. So net profit for the company is 30 on those 5,000 units. $1,50,000 is the profit. Array, your A is losing 20 rupees, or instead of selling at 140, you are making it transfer at 120. That is fine, but you are saving 50 rupees. No, now you will not be required. You would have earned 140. You would have incurred 170. You would have earned 140 by selling lens in the open market. But since entire lot is sold to the external customer, for internal customer for transfer, there is no material, there is no idle capacity left. So you would have purchased lens at 170. So here you have sacrificed 20 rupees. By selling lens at 120, you have sacrificed 20 rupees, but you have saved 50. You are not paying 170 anymore, you are paying only 120. So the net saving is 30. You understood this? Okay. Now point number 3 also asked you something. What is asked in point number 3? Do you feel that divisional manager should accept the transfers, and what should be the transfer price? Now see, since variable cost of A is 125 and selling price is 140, we need to think about it. Is there any idle capacity? No. So if there is no idle capacity, if division A is forced to transfer those lenses to division B, division A will have to sacrifice some of its external sales. So division A would have easily earned 140 by selling that lens in the market. Now since it is getting transferred, since the lenses are getting transferred, there is an opportunity loss. A will be of the opinion, boss, I am selling it in the market, I am getting 140 from the market, why should I give it to you at 120? You pay me 140. And B will not be ready to pay you more than 170, because 170 is the cost which is incurred by B currently. B is currently spending 170, B will never be ready to pay you more than 170. A is currently earning 140 by selling the lens in the open market. So A will not be ready to sell it or transfer it below 140. So the ideally range will be 140 to 170. What if there is an idle capacity? If there is an idle capacity, after selling lenses in the open market by division A still has some idle capacity which can be utilized for producing lenses for division B. In that case, variable cost of A will be considered as a bare minimum price to be recovered. So in that case, the range will be 110 to 170. Are you getting me? If there is idle capacity, if there is no idle capacity, I am sacrificing 140, give me 140. If there is an idle capacity, I have utilized my capacity for the external market, still I am left with some capacity. I will be using it for B. I will produce lenses at 110. That will be that is my variable cost. So I will not transfer it for less than 110, and B will not accept it at more than 170. So the revised, if there is an idle capacity, range is 110 to 170. If there is no idle capacity, the range is 140 is to 170, where I am covering the opportunity cost as well. So that was your last question, previous question. Now there is something called as goal congruence. Goal congruence means, the concept says that you as a manager and your company should have the same goal. Both should work in the same manner. If the company is if the company is focusing on cost reduction, you should also go for cost reduction. If the company is focusing on increasing the sales, you should also do the same thing. Company's goal should be your goal. If company wants to maximize its profit, you can't simply focus on your profit by increasing the transfer price. Then it will be a conflict of interest. That is called as again going against goal congruence. Goal congruence means your company as well as each divisional manager will have to go in the same direction. If he chooses to go in the different direction, then naturally it will create hindrance, obstacle in the growth of the company. Now, how do we settle it? There are two things which can be asked in the theory. I'll show you. One is dual rate transfer system. With a dual rate transfer system, your receiving department will record. Input at marginal cost. See, the problem is, transferor says, don't force me to transfer at a lower price, that affects my profit. Transferee says, don't impose me high cost just because I don't have an option, because that hampers my profit. Okay. The solution is go for dual rate transfer pricing system. The company will tell receiving department, you record at variable cost only, because I as a company already know that A is transferring something to B, no matter what the selling price is, no matter what the transfer price is, ultimately only variable cost is incurred. So I'll tell receiving department, you record everything at variable cost only, and I will tell the transferor to record it at selling price. So supplying division is credited with full cost plus profit. That means selling price. You are transferor. I am transferee. You want to transfer at a high price. I don't want to take it at a high price. Problem is solved, no? Company tells both of us. Company tells you, you charge your selling price. No problem. Your profit will be evaluated. You are happy. Then company comes to me and said, don't worry. Even if they are transferring it at transfer selling price, you record it at variable cost only, because somewhere we know, company says, somewhere company knows that ultimately it is a quantity which is getting transferred by incurring variable cost only. There is no actual profit realized as such. So let the transferor record at selling price, let the transferee record it at variable cost, dual rate system. And if not this, then there is one more concept called as two-part transfer pricing system. Two-part transfer pricing system means you charge your, see, the transfer will be made at marginal cost, variable cost, plus some percentage of fixed cost. And receiving department will have to bear both. Variable cost plus some burden of fixed cost as well. Two-part pricing. See, the two-part transfer system is when you transfer, the transfers are being made at marginal cost plus lump sum fixed fee charged to supplying division to the receiving division. Transfer by the supplying division to the receiving division for the use of capacity allocated to the intermediate product. You are using my capacity, okay, take my product at variable cost because I have incurred variable cost. But wait, I had to utilize capacity for you. You better pay me some percentage of fixed cost. So you're also happy. I'm not charging you market price. I'm charging you variable cost plus some percent of fixed cost. I'm not charging you total fixed cost as well. So you're still getting it lesser than what market price is. So there is a dual system, there is a two price transfer system, which is basically used to avoid the problem going against goal congruence. So this was your divisional transfer pricing, guys. I have covered questions also and I have covered the theory also, which is most important one, goal congruence. I hope this was of some use. See you in the next chapter now. Have a nice time. Bye-bye. Now the most awaited chapter. Generally students tend to run away from this chapter, and that's your standard costing. Now guys, in standard costing there is nothing much to revise, but still I will revise two questions where major concepts will be discussed, because there is no end to this chapter, you know that already. So guys, standard costing is about cost control, where you basically compare your actual data with the standard data. You compare your actual data with the standard data and you find out variances and you analyze variances. Why there is a difference between two cost structures. So for understanding this chapter, I would like to solve question number 26, which will cover almost everything. Trident Toys Limited manufactures a single product and standard cost system is followed. Material requirement is 10 kgs. Material requirement is 10 kgs. Price is 4 rupees per kg. Labor requirement is 8 hours per unit. This is definitely for 1 unit. Then you have variable overhead rate 3 rupees. Time is 8. Naturally, time will remain same. And standard profit. Your estimated profit is 56 per unit. Overheads are allocated on the basis of direct labor hours, and in the month of April 20-9, there was no difference between the budgeted and actual selling price, and there were no opening and closing stock during the period. Other details for the month of April 20-9 are as under. Budgeted data 2000, actual data 1800. Budgeted is 2000, actual is 1800 units. Material consumption is different. Material price is same. Consumption looks same, but it is not same actually. You should have consumed 20,000 for 2000. You have consumed 20,000 for 1800. So ideally you have consumed more. I hope you know this. There is a variation in number of hours. There is a variation in variable overheads as well as fixed overheads. Reconcile budgeted profit and actual profit. We need to find out the reasons for the difference between budgeted and actual profit with the help of variances according to each of the following method. First is conventional method and the second one is relevant cost method. In case of relevant cost method, they have asked three scenarios. One is when material is scarce, when labor is limited. So key factor concept will also be discussed along with marginal costing concept in standard costing, and when there is no scarcity, so no key factor. So basically by solving this question, we will be revising standard costing. We will also be revising combination of standard as well as marginal. We will not stop there. We will also revise standard as well as relevant cost, where key factors will also be considered. So let's go to the first part. If you want to reconcile two profit figures, if you want to reconcile your budgeted profit and actual profit, first of all, you should have two different profit figures with you. So our first job will be to know, the budgeted profit figure. Your budgeted profit per unit was 56 rupees and your budgeted output was 2000 units. 2000 into 56, rupees 1,12,000. Rupees 1,12,000 is your budgeted profit figure. Correct? Now, my budgeted profit is available. I need to find out actual profit. Now, actual profit is an outcome of actual cost structure. So, profit is like sales minus cost. In reality, you have actually sold 1800 units at selling price of 208 per unit. So, 1800 into 208, 374, 400 less. You are supposed to subtract material cost first, then labor, and so on. If you look at the material cost structure, let me tell you, it is 20,000 kgs actually consumed at 4 rupees. So that comes to 80,000. Labor, they have clearly told us 14,800 hours. They have told us 14,800 hours is the actual time taken. 8 rupees per hour is the rate. So 14,800 into 8, 118, 400. We also have information about variable overheads and fixed overheads. $44,400 and 48,000. 44,400 and 48,000 is my overhead structure. I'll just take the total of cost structure now. $2,90,800. Sales will be marked as A, cost will be marked as B, and actual profit will be A minus B. $83,600. Is this clear? 83,600 is your profit. Your budgeted profit was 1,12,000. Your budgeted profit is 1,12,000. Your actual profit is 83,600. So we can easily find out profit variance. $1,12,000 should have been your profit figure. 1,12,000 should have been your profit figure, but your profit figure is 83,600. Your profit has gone down by 28,400, so that's your adverse variance. Adverse favorable will not be decided on the basis of plus minus. I hope you are aware of it. This topic cannot be studied on the basis of formulas. There is no need to buy hard formulas. Apply your logic, apply your mind, you will get all the answers. I was expecting my profit to be 1,12,000. I got my profit to be 83,600. That means my profit has gone down. My profit is reduced by, I'm earning 28,400 less than what I was expecting. That has to be an adverse variance for me. So that is my first part. Now since I have realized that there is a profit variation, I need to find out reason for that profit variation. So if I talk about profit variance, let me explain this part to you. Profit is an outcome of sales and cost. Profit is an outcome of sales and cost. Then profit variance will also be an outcome of change in sales and change in cost. So my first category will be due to sales, my second category will be due to cost. My first category will be due to sales, my second category will be due to cost. When I talk about sales, sales can be different because of change in the selling price as well as because of change in the volume. You sell your product at a higher selling price, there is a favorable variance. You sell your product at a lower selling price, there is an adverse variance. You sell more quantity than what you had thought of. You sell more quantity, it's a favorable variance. You sell less quantity, it is adverse variance. And as far as cost is concerned, you know the whole story. We can have variances due to material, labor, variable overheads and fixed overheads. Material may have material price, material usage. Usage may be due to material mix and material yield. Accordingly, labor will have sub-variances, variable overhead has expenditure and efficiency, and fixed overhead also has sub-variances. So, together all these reasons will give me profit variance. So, now I will have to find out reasons for profit variance. So, I am going for first part, and that is due to sales. And that is due to sales. Now, sales can be affected due to selling price. So, first variance is margin price variance. Now, margin price variance means analysis of the variation and the impact of selling price variation on profit. Impact of selling price variation on profit. So, ideally, if you look at the question, this is a cost as well as profit structure. If you get the total of all these 40, 64, 24, 24 and 56. You will get 208 as selling price. Guys, estimated cost, estimated profit, estimated cost and estimated profit, 208. So, you anticipated your selling price to be You anticipated your selling price to be 208. Your actual selling price is 208. 1,800 units were sold. That doesn't matter now because there is no variation in selling price. So, selling price is not the reason for affecting profit. So, my second variance will be margin volume variance. My second variance will be margin volume variance. I thought of selling 2,000 units. I managed to sell only 1,800. I thought of selling 2,000 units. I managed to sell only 1,800. That means I couldn't sell 200 units. Each unit was expected to give me profit of 56. So, 200 units less, that means I lost an opportunity of earning profit to the extent of 11,200. So, margin volume variance is calculated to analyze the impact of quantity change on profit. If you observe, if you recollect, your sales volume variance is also similar here. But then as far as multiplier is concerned, we always apply budgeted selling price because we want to know the impact on sales then. Currently, we are not interested in knowing the impact on sales. Currently, we are interested in knowing impact on profit. So, budgeted profit will be applied here. So, basically it is your budgeted quantity minus actual quantity into budgeted profit per unit. Basically, it is budgeted quantity minus actual quantity into budgeted profit per unit, because you want to know the impact on profit. This was due to sales. Now, I need to find out the second category, due to cost. Now, I want to find out the second category, which is due to cost. Now, when it comes to cost, I have 4 different types of elements: material, labor, variable overheads and fixed overheads. Out of these 4, first 3 are of variable nature. Material, labor and variable overheads are of variable nature. You increase quantity, all 3 cost structures will go up. You decrease quantity, all 3 cost structures will go down. So, the calculation of all 3 is similar. Calculation of all 3 is quite similar. But your last cost structure, fixed overhead, which is totally different, it has got nothing to do with the quantity structure. It is incurred on the basis of time, because fixed cost is a time cost, period cost. So, calculation of fixed cost variances is different. So, what we can do is we will first complete variance calculation of material, labor and variable overheads, and then we will go for fixed overheads. Now, since we are talking about variable cost structure, let me remind you that your actual data, your standard data is given for producing 1 unit. Your standard data is given for producing 1 unit. You need 10 kgs of material, 8 hours of work is to be done. That means your standard data is made available for 1 unit, but in reality, you have actually produced 1800 units. So, your actual data and standard data are not at par. Your actual data and standard data are not at par. So, to bring them at par, we will have to prepare a small table. This is the table that we need. Guys, this is your standard table for actual output. This is your standard table for actual output. Your actual output is 1800 units. Your standard table is prepared mainly because your actual output is 1800. That means your actual data is given for 1800 units. Your standard table is 1800. That means your actual output is also given for 1800. Your actual output is 1800 units. That means your actual data is also for 1800 units. But your standard is given for producing 1 unit. So, we will have to compare. We will have to convert standard given for 1 unit into standard of 1800, so that actual data and standard data both will be compared. Because comparison has to be done at par. So, standard is given for 1 unit, actual output is 1800. That means my actual data is 1800. I cannot compare actual data of 1800 with the standard of 1 unit. So, I am converting the standard. Now, since I am going for all three types of cost, material, labor, variable overheads, all 3 are variable in nature, so their calculation remains same. For material, I need a quantity and price. For labor and variable overhead, I need hours and rate. My question says that my material requirement is 10 kgs, hours requirement is 8 hours. That's for 1 unit. So naturally for 1800 units, my consumption should have been 18,000 kgs and my hours should have been 14,400. For 1 unit, I am supposed to do this. For 1800, I am supposed to do this. As far as the price and the rate is concerned, 4, 8 and 3 are the 3 rates. 4, 8 and 3 are the 3 rates. So 72,000 115,200 and 43,200 should have been your cost. Got my point? This should have been your cost, but as per the actual data, scenario is different. 20,000 is actually consumed at 4. 20,000 is actually consumed at 4. 14,800 are actually 14,800 hours are actually been paid for at the rate of 8. And my variable overhead is actually 44,400. So 14,800 into 8, 118,400, and this has to be 80,000. Now 44,400. Yeah. Now they have not given me information about number of hours and actual rate. Now naturally rate can't be same for variable overheads and labor, but number of hours will be same. If my team is working for 10 hours, electricity is also used for 10 hours. So generally if nothing is mentioned, you can always rely on labor hours as far as variable overhead hours are concerned. Are you getting me? If there is no information given about variable overhead hours, your labor hours and variable overhead hours are assumed to be the same. In fact, that is the reason why they have not specified it separately. Got it? Now, what if there was idle time, actual idle time of 800 hours? Then in that case, I wouldn't have taken this as 14,800. I would have taken that as 14,000 because idle time is unproductive. Idle time is unproductive. Unproductive means no quantity manufactured, and if there is no quantity manufactured, there is no variable cost incurred because variable cost is a product cost. Labor still will have 14,800 because even if idle time is unproductive, it is paid for. So it is included in the table for labor, and later on after you calculate time variance, you split idle time from efficiency and you calculate further variances. You have already done that. So had there been idle time of 800 hours, this would have been 14,800, but this would have been 14,000. 44,400 divided by 14,800, the rate is 3, and we are all set to calculate variances related to cost. Correct? Okay. So my first variance is material cost variance. I was supposed to spend 72,000 to produce something that got manufactured in 80,000. 8,000 adverse is my cost variance. Material cost variance is an outcome of two things. One is variation in price and the second one is variation in usage. I should have spent 4 rupees. I have spent 4 rupees. And we always multiply this with actual quantity because you get affected because of variation in the rate. Only if you get affected because of variation in the rate, only if you actually consume something. Here the rates are same, so no variance. And your third variance is material usage variance, which says that you should have consumed 18,000 kgs, but you consumed 20,000 kgs for producing the same thing. You should have consumed 18,000 kgs, but you have consumed 20,000 kgs for producing the same output. That means you have consumed more, but couldn't get it converted into, finished goods. Since you couldn't get it converted into finished goods, it's a loss. Usage variance is the responsibility of production manager who is not responsible for price. So we always apply standard price here. So 2,000 extra quantity will cost you 8,000, which is your cost variance. Now, since there is no variation in material quantity or types, you can't have mix variance. Since you are dealing with only one type of material, there is no mix variance, there is no combination. So mix and yield will not be calculated here. Our next variances are going to be labor variances, where you have labor cost variance. 115,200 should have been your labor cost, and 118,400 is your labor cost. 115,200, 118,400, 3,200, you incurred more, so adverse variance. This is due to two reasons. One, when you don't follow the rate. Well, here it seems you have followed the rate instead of, you were supposed to pay workers at the rate of 8, you have paid them at the rate of 8. And since you get affected because of actual hours, you consider actual hours as a multiplier. And the second reason is efficiency. Whatever they were supposed to complete in 14,400 hours, they completed that in 14,800 hours. Efficiency variance is a responsibility of workers. They are not responsible for actual rate, so we have to apply standard rate. Of course, in this question, standard and actual rate both are same, but since I just wanted to revise the concept. 400 hours extra is definitely adverse, which is giving me 3,200 as variance. Variable overhead cost variance. Instead of 43,200, I am spending 44,800. Instead of 43,200, I am spending 44,400. I am spending 1,200 more, which is an adverse variance. Just like labor, I need to evaluate rate. Rate should have been 3. Actually, also it is 3. So there is no variation due to rate. That means definitely inefficiency has cost you some amount. 14,400 hours should have been taken to complete the work. 14,800 hours were taken to complete the work. Multiplied by 3. So 400 hours extra at the rate of 3. 1,200 is your 1,200 is your variance. Now, if you observe carefully, all your variances are because of volume. Since you have consumed 2000 kgs more, there is a variance which is getting reflected as cost variance. There is no problem with the price or rate whatsoever. The major issue is with the consumption of 2000 kgs extra and extra time taken of 400 hours. This is what we got to know when we analyzed variable expenses, variable cost structures. As far as fixed overhead variances are concerned, we need 8 items if you recollect. We need 8 items, 4 budgeted, 4 actual. My budgeted fixed cost is 48,000. My actual fixed cost is also 48,000. My budgeted output is 2000. My actual output is 1800. If I am planning to produce 2000 units, if I am expected to work for 8 hours for 1 unit, that means 16,000 hours was my budgeted requirement of number of hours. I have actually completed work in 14,800 hours. And we need one more information about days. How many days we had decided to work and how many days we have worked for. Since they have not given us any information about number of days, that means the clear indication is there is no variation in number of days. Now we must extract these items for safe calculation of fixed overhead variances, and then we go for fixed overhead absorption rate, So my first one will be based on per unit. 48,000 is the cost to be recovered. 2000 units is what I have. 24 per unit is my absorption rate. Or I would say 48,000 is the cost to be recovered. $16,000 hours I am planning to work. So each hour contributes 3 rupees towards fixed cost. But we generally consider per unit rate for absorption. Fixed overhead absorption rate per unit. We decided to recover 24 per unit. And we actually managed to sell 1800 units. We managed to rather produce and sell 1800 units. So 1800 units into 24, 43,200 is what you have absorbed so far. This is my starting point for any fixed overhead variance calculation. Are you getting me? Then now we can start with fixed overhead variances. Fixed overhead cost variance is, I have incurred 48,000, I should have consumed 48,000. I should have absorbed 48,000. But unfortunately, I could absorb only 43,200 against 48,000. I have absorbed 43,200, but I should have absorbed 48,000. That means I couldn't absorb 4,800, and that is a case of under absorption. Hence, it is adverse variance. Reasons are two. One is my budget went wrong. I thought of spending 48,000. I incurred 48,000. Oh my God. That means in reality, my budget has not gone wrong. See, under absorption is an outcome of absorption rate. Absorption rate was determined based on budgeted overheads upon budgeted output. Now, there is no problem in budgeted overheads, but guys, there is a problem with the output. We thought of producing 2000, we actually managed to produce 1800. We thought of producing 2000, we managed to produce only 1800, 200 units we couldn't produce. If you would have produced 200 units extra at the rate of 24, we could have easily recovered 4,800 from the market towards fixed cost. So, we lost an opportunity. We lost an opportunity of recovering 4,800 from the market just because we couldn't produce 200 units. Now, your volume variance is an outcome of two more things, rather four. First one is calendar. Calendar variance focuses on variation in days. Now, since there is no variation in days given, we will directly go for capacity. Ideally, capacity variance says that, okay, suppose you were supposed to work for 25 days, you have worked for 27 days. Your calendar variance is favorable because you plan to work for 25 days, but you actually work for 27 days. So, you consume 2 more days extra without paying anything extra towards fixed cost. Your landlord will not come unless the month is over. So, you decided to work for 25, you work for 27. What landlord has to do with that? He will not he will not come and ask for the extra amount of rent. So, it is excess utilization without incurring any additional fixed cost. So, it will be considered as favorable variance. Then you go for capacity utilization analysis. That means in 25 days, I was supposed to work for 16,000 hours. In 27 days, how many hours I should have utilized? In 25 days, I was supposed to utilize 16,000 hours. In 27 days, how much I should have utilized? The answer is 17,280. I should have utilized 17,280, but I utilized only 14,800. That indicates that there is an underutilization of capacity. You are paying for the full amount, but you are utilizing less number of hours. That means your capacity failed. There was underutilization, and we can see the impact of underutilization. We did not produce 200 units. Now, since we do not have variation in days given, they did not give us different days. That means, if I thought of working for 25 days, I must have worked for 25 days only. If I was supposed to work for 25 days, I must have worked for 25 days only. And now my capacity calculation says, in 25 days, I was supposed to work for 1600 hours. In 25 days, how much? It is going to be 16,000 only, no? So, guys, whenever there is no variation in terms of days, your budgeted hours will be taken into consideration. And the calculation says 16,000 hours should have been utilized. You utilized only 14,800. That means you couldn't utilize 1,200 hours. If you would have used 1,200 hours at the rate of 3,600, you could have easily recovered from the market. So, you lost an opportunity of recovering 3,600 towards fixed cost, that is adverse variance. And your last calculation is efficiency variance, and efficiency variance will remain same. See, your efficiency variance for labor and overheads, variable overheads, is the same. Your efficiency variance for labor and efficiency variance for variable overhead is the same. Same bracket will be used. Ideally, the work should have been done in 14,400 hours. Ideally, the work should have been done in 14,400 hours, but the work was actually done in 14,800 hours. 400 hours were taken extra. At the rate of 3, extra time cost you 1,200. You are taking more time to complete the production. You are taking more time. This was about utilization. You are paying for the month. You should have utilized 16,000. You utilize only 14,800. That means there is underutilization, but there is no discount in fixed cost. Fixed cost will be intact. Same amount will be paid. Lesser is the infrastructure utilized. So it's an adverse variance. But in case of efficiency variance, whatever you were supposed to do in 14,400 hours, same thing was done by taking 400 hours extra. So at the rate of 3,200 will be the adverse variance. So this total gives you 4,800, which tallies with cost variance because there is no variation in budget. So you understood this. Okay. Now, if you ask about reconciliation, this is what we need. So this is your reconciliation of budgeted profit with actual profit as per your traditional system, where you have used absorption costing as a base. So it starts with budgeted profit, which is 1,12,000. Budgeted profit, which is 1,12,000, it is an outcome of two things. One is due to sales. One is due to sales. Margin price variance, margin usage, margin volume variance. I think price variance was nil and your margin volume variance was 11,200 adverse. After this, you have second part due to cost. And in the second part, I am going to write only the base level reasons. So I am not going to start with material cost because material cost is an outcome of material price and material usage. Material cost is an outcome of material price and material usage variance, where price variance is nil and my usage variance is 8,000 adverse. Are you getting me? Had there been mix and yield, then I wouldn't have taken usage, I would have taken material price variance, material mix variance and material usage, material yield variance. I want to know the root level costs. As far as labor is concerned, let's not go for cost variance, let's go for the root level cause, labor rate and labor efficiency. Rate is again nil. Efficiency is 3,200. Variable overhead expenditure variance, variable overhead efficiency variance. No expenditure variance because there is no variation in the rate. But efficiency variance is 1,200 adverse. Fixed overheads, budget variance. Now I am not going for fixed overhead volume variance because volume variance is an outcome of two things. So fixed overhead capacity variance and fixed overhead efficiency variance. See, I have to give root level reason. Ultimate reason is capacity and efficiency. So 3600 adverse and 1200 adverse. After doing all these calculations, we realize that actual profit is different from budgeted profit, and these are the reasons. So I did not go for fixed overhead volume variance because that is not ultimate reason. Your ultimate reason is volume variance is an outcome of two things, capacity and efficiency. So I wrote that. Now see, your profit was expected to be 1,12,000. Because of margin volume, it went down by 11,200. Again, it went down due to material excess consumption of 8,000 rupees. Labor efficiency cost me 3,200. Variable overhead cost me 1,200. Fixed efficiency cost me 1,200 and capacity underutilization cost me 36,000. So 83,600 is what I need, what I am getting here, which is my actual profit. So everything tallied. See, my actual profit was 83,600. So why there is a variation of 28,400? These are the reasons. These are the reasons. This is reconciliation. This is reconciliation as per traditional method where absorption costing is considered as a base. But now if you want to go for variance calculation as per marginal costing, if you want to go for variance calculation for marginal costing, remember all those things which define absorption costing will be skipped. When you apply marginal costing, your basic change in the calculation is, stop focusing on fixed cost. So if I stop focusing on fixed cost, my calculation will be totally different. My margin price variance will remain same, but in case of volume variance, I will have to now consider budgeted contribution here than budgeted profit. That will be the first change. That will be my first change. Okay. Then my second change is going to be, see, material, labor and variable overheads are going to be same because there is no absorption technique used. But in case of fixed cost, wherever we use these absorption rates, those variances will be cut off. So my cost variance is based on absorbed figure. I don't need this. Budget variance is the only variance where I'm not using absorption rate. All other variances, if you consider, I have used absorption rate. So your budget variance itself will be your cost variance. So for you, only change variances I'm calculating here. Margin, volume, variance. Now if I talk about margin volume variance, guys, if I talk about margin volume variance, let me remind you something. Instead of 2,000, you managed to produce and sell only 1,800, you sold 200 less. I want contribution per unit. So my budgeted contribution per unit will be budgeted selling price of 208. Budgeted contribution per unit will be my budgeted selling price of 208. And 40, 60, 24 are my variable cost structures. 40, 60, 24 are my variable cost structures. 40, 60 and 24 will be my variable cost structure 40, 60, 40, 64, 24. 40, 64, 24. 40, 64, 24. 128 is my variable cost, mine which will be subtracted from selling price, and my contribution per unit will be 80. So instead of focusing on profit of 56 per unit, I am focusing on contribution of 80 per unit. I am focusing on 80 per unit. So 200 units less, 200 units less would have cost me, 200 units less have cost me 16,000 contribution. 1 unit gives me contribution of 80, so 200 units less. If I am selling less, I am losing contribution of 16,000. That is a first change. And all your absorption based fixed overheads will be skipped. All your other variances will remain same. So guys, this is just for your reference. It's not needed, it is not mandatory, but it is budgeted quantity minus actual quantity multiplied by budgeted contribution per unit. Budgeted contribution per unit. Are you getting me? Since we are dealing with marginal costing instead of profit, we'll start considering contribution. Guys, that means if I am considering marginal costing as a base here, if I am considering marginal costing as a base here, 11,12,000 will remain same, 83,600 should remain same. Price variance will not be affected. This volume variance will be 16,000 adverse now. Your volume variance will be 16,000 adverse now. No change in price usage, no change in labor rate, labor efficiency, no change in variable overhead expenditure and efficiency. As far as budget variance is concerned, fixed overhead variances is concerned, only budget variance will be considered. That itself will be called as cost variance. All those variances where absorption rates were applied are not to be taken into consideration. So 1,12,000 minus 16 minus 8,000 minus 3,200 minus 1,200. 83,600 tallied. You understood the basic difference between absorption costing and marginal costing when it comes to variances. Margin volume variance will not be multiplied by budgeted profit per unit, it will be multiplied by budgeted contribution per unit, and all your fixed overhead variances which are based on absorption rate will be skipped. So the only variance that you will consider from fixed overhead is fixed overhead budget variance. This was as per marginal costing. Now in the next part they have asked something. So we have just now answered conventional method and the last part when there is no scarcity, but marginal costing technique is used. So this is A, this is B, C, B subpart C. Okay. Now let's go for scarcity. BA, BB. In first case, your key factor is material and in your second case, your key factor is labor. Your key factor is material and your key factor is labor. Why are we discussing this? In the same part of question, they have asked us to evaluate variances by considering two key factors. One, your material cost. Second, your labor cost, labor hours. Now, the simple calculation here is, if material is a key factor, if material is a key factor, 1800 units of finished goods should have got actually completed in 18,000 kgs. 1800 units of finished goods should have got actually completed in 18,000 kgs, but you have consumed 20,000 kgs. That indicates that there is an excess quantity consumed, 2000 kgs. There is an excess quantity consumed, 2000 kgs. If I wouldn't have consumed this 2000 kgs at the rate of 10 kgs per unit, I would have easily produced 200 units. And you should have produced, no, who stopped you? Key factor. I have only 20,000 kgs of material with me. I have only 20,000 kgs of material with me. Now, please understand this. Excess usage is a responsibility of production manager. Excess usage is a responsibility of production manager. Excess usage is a responsibility of production manager. That means when I am losing contribution of 80 per unit on those 200 units, this entire loss of contribution of 16,000 is actually due to production manager. You are saying your sales manager, marketing manager, your marketing manager has sold 200 units less. Did you even think of knowing the reason? He sold 200 units less because you couldn't produce 200 units more. And you couldn't produce 200 units more because your material was exhausted. Something that should have got completed in 18,000 kgs was actually completed in 20,000 kgs. 2,000 kgs were incurred, consumed more, but no extra output was produced. And since you had only 20,000 kgs, you couldn't produce more. So, your marketing manager couldn't sell 200 units because your production manager utilized additional material, wasted material, and he did not produce 200 units. So, actually speaking, this is not a responsibility of marketing manager. It should be added to the responsibility of production manager. It is a usage variance that you need to consider here. Variance calculation is done to know the exact reason for excess cost. So, my reason is not a marketing manager. He is not responsible for loss of contribution. He did not sell 200 units because production manager did not produce 200 units, and production manager did not produce 200 units extra because he was not left with the material. So if he would have used the material in the right quantity, he would have easily produced 2000 units instead of 1800. This guy would have sold 2000 units instead of 1800. So the real responsibility of not selling 200 units is not your marketing manager, it is your production manager. Rest all expenses, rest all responsibilities will remain same. Since I am still stuck with relevant costing is a concept of marginal costing, since I am still stuck with marginal concept, rest everything will remain same. You can verify your answer. 1,12,000 straight away minus 24,000 minus 3,200 minus 1,200, 83,600 is your answer. Have you understood this? See this. I cannot book marketing manager for 16,000 adverse. No, that's wrong. Is that part clear? Okay. Now the next calculation I'm doing, and it is related to part B. Let's see, where labor is a key factor. Now please understand, at the rate of 8 hours, (1800) units should have got produced in 14,400 hours. Your team has taken your team has taken 400 hours extra. In those 400 hours, at the rate of 8 hours per unit, you would have easily produced 50 units extra. You would have easily produced 50 units extra. Since you didn't produce these 50 units extra, you couldn't earn the contribution of 4,000. So out of 200 units which were not produced, for 50 units, you can't hold marketing manager responsible. Since workers took 50, time related to 50 units extra, there was no time left because there was a key factor. Time was a key factor for you. Are you getting me? So for 4,000, marketing manager is not responsible. So from his 16,000, I will reduce 4,000 and I will book him for only 12,000. And that balance 4,000 will be added to labor inefficiency, which will now become 7,200 adverse. Are you getting me? Rest everything will remain same. Rest everything will remain same. This will be back to 8,000. Check your answer. 112 minus 12,000 minus 8,000 minus 7,200 and 1,200, 83,600. You can check your answer. You understood this? So this is how the responsibility can be fixed up in the most productive manner, in the most accurate manner. So that was about your fixation of responsibility. When material was a limiting factor, production manager wasted 2000 kgs. So the real culprit behind not selling 200 units was production manager, not marketing manager. In case of labor, when labor was a key factor, since 400 hours were wasted, by workers, we could have easily produced 50 units in those 400 hours. So at the rate of 80, on 50 units, I have lost a contribution of 4,000. So my marketing manager is not responsible for 200. Out of 250 units was a responsibility of workers because they worked slow. They completed production slowly, inefficiently. So out of 200 units, for 50 units, since workers' inefficiency is responsible, labor efficiency variance was increased by 4,000 rupees, 50 units into 80 per unit contribution. And why are we applying contribution in all cases? Because this is relevant costing, that means it is a part of marginal costing. I am not supposed to go for profit per unit as a base, I am supposed to go for contribution per unit as a base. And finally, responsibility was reduced to 12,000. Yes, for 150 units they are responsible, they couldn't sell. So that's their responsibility. But then for others, respective manager is booked for the variance. So that was question number 26 for you guys, where we revised entire standard costing, major part of standard costing, almost 90% standard costing is done here only. Plus we also discussed what if marginal costing is applied as a base. Plus we also discussed key factors. Now after this, we will be heading towards one more important task, one more important type of marginal costing, which is quite frequently asked these days. One more huge question will solve, which will cover all petty questions. So let's go for that. The next concept is about change in variance calculation. See, your traditional variances were based on standard data minus actual data, correct? Now many times it happens that your organization, your management only realizes that there are a few changes which are supposed to take place because of a change in the market conditions, change in the environment, change business environment. So they revise variances which are known as planning variances or revision variances. So like I decide the standard that product material should be purchased for 10 rupees per kg, but then I only realize no, it is not possible to buy material at 10 rupees per kg, the prices have gone up. So I change the standard, I revise the standard from 10 to 12. I change the standard, I revise the standard from 10 to 12. Now if I change the standard from 10 to 12, it is no longer a responsibility of the manager, I have only changed the standard. So this is management variance, this is planning variance, revision variance, which has got nothing to do with the final manager as such. Manager actually managed to purchase it for 11 rupees per kg. This is known as operational variances. Operational variances is the direct responsibility of the manager. So if I talk about traditional variances, I should have purchased material for 10, I have purchased material for 11, 1 adverse. But then there was a old technique where standards were set long back in the beginning of the year, and throughout the year actual data was compared. Despite of changes in the business strategy, despite of changes in the market conditions, standards were not revised, and the entire burden was put on the head of manager. Instead of 10, you spend 11, you are adverse, you are inefficient. But then the concept here says, okay, he's not that inefficient, guys. Your company already knew. The company itself changed the standard by 2 rupees. Instead of 10, company allowed managers to buy material at 12. So company changed it. So company knew that cost is going to be more by 2 rupees. Manager has saved 1 rupee. So how can you say he's inefficient? He's actually efficient, because you were supposed to, you thought of buying it for 12, somehow he managed to buy it for 11. He is actually efficient and not inefficient. That is the advantage of planning variance and operational variances. You understood this? So I can simply tell you in simple words. If they ask for traditional, you go for standard minus actual. If they ask for planning, that means standard minus revised standard. Standard minus revised standard. And if they ask about operational, it will be revised standard minus actual, and your manager will be held responsible for this. So you understood now how the twist and turn takes place. Initially, company thought material should have been purchased for 10, but then they realized that it can be purchased for 12. Actually, the prices have gone up. Still, your manager managed to purchase it at 11. So according to traditional system, it's a wrong information. Your manager is inefficient. That's wrong. It's not inefficient, because you only felt that it will go up by 2 rupees. It did not go up by 2 rupees. It went up by 1 rupee. That means somewhere this man played a favorable role in the calculation. So these days they have started asking questions based on planning variance and operational variances. So we'll just revise this concept once, and that will be the end of standard costing. Question number 28. Managing Director of Petro KL Limited thinks that standard costing has little to offer in the reporting of material variances due to frequently change in the price of materials. PTKLL can utilize one of the two equally suitable raw materials and always plan to utilize the raw material which will lead to cheapest total production cost. However, PTKLL is frequently trapped by price changes, and the material actually used often provides after the event to have been more expensive than the alternative which was originally rejected. During last accounting period, to produce 1 unit of P, the company could either use 2.5 kgs of PG or 2.5 kgs of PD. Company planned to use PG and it appeared to be cheaper than the two, and the price was expected to be 1.5. This was my standard price initially. Now suddenly the price has gone up. PG has gone up from 1.5. PG has gone up from 1.5 to 2.25. So this is your revised standard price. Production was of 1000 units. This is actual output along with actual quantity and actual price. Calculate traditional variances, and the approach is asked, which we have already discussed. Now, I'll simply revise the concept since we are going for material variances. My standard is given for producing 1 unit. My standard is given for producing 1 unit, but my actual output is 1000 units. So, I need a table. I do need a table, but the table will be little different. See, I'll first go for standard, then I'll go for revised standard, and then I'll go for actual. Format will be little different because you're dealing with latest update in standard costing. So, this is my standard table for actual output, and my actual output is 1000 units. This is standard, this is revised standard, and this is actual. In question, standard is given for 1 unit, but since I have produced 1000 units, I need to convert my standard and take it to the level of actual output. Material requirement for 1 unit is 2.5 kgs if I am not wrong. So, for 1000 it is going to be 2500. There is no revision in the quantity as such, so even for revised it is going to be same. You anticipated price to be 1.5, which is expected to be 2.25. But in reality, you have incurred 6480. In reality, you have incurred 6480 on 2700. On 2700 kgs. So, 6480 divided by 2700 kgs. So, that comes to 2.4. So, I thought of consuming 2500 at 1.5. So, my company thought that ideally the production should have been done in 3750. Company only realized that 2500 into 2.25, it should be revised to 5625. You understood what I said? Company initially thought of buying the material at 1.5. Company only later on realized that ideally 1.5 will not be the right price. It should be 2.25. So, company only revised the standard, and in reality something else has happened. So, this is responsibility of company, which is planning variance. This is responsibility of manager, which is operational variance. And if you are stuck to traditional, it is actual with the original standard. So, if at all I need to calculate 3 variances, I can split this page into 3 parts. So, traditional variances. Traditional variances, that means standard minus actual. Cost should have been 3750, cost is 6480. 3750, 6480, 27 3750 minus 6480, 2730, 2730 adverse. Material cost variance is done. Now the first reason for cost variance is price. I should have paid 1.5, I have paid 2.4, and I will pay more, I will pay less only if I pay for the actual quantity. No? I will pay more, I will be paying less only because of actual quantity. So 2700 will be applied. 1.5 minus 2.4 into 2700. 2430. Adverse is your price variance. And instead of 2500 kgs, you manage to consume you actually consume 2700 kgs. Since it is a responsibility of the production manager, I cannot go for actual price, I have to stick to standard price. So 300 adverse is my usage variance. This is what I do when I go for traditional variances. Is this part clear? Now I am going for planning variances, or which is also known as revision variances. This is standard minus revised standard. So cost variance will be 3750 should have been the cost, 5625 is expected to be the cost. Instead of 3750, if you are anticipating 5625 to be the cost, you are anticipating 1875 to be your rise in the cost structure. Now it's all due to pricing. 1.5 was expected. Then I only realized that it will go up to 2.25. So 1.5 minus 2.25, 1875 adverse will be your price variance. Usage variance is not there because there is no variation in quantity. So management already knew that because of price, cost would go up. And what the manager has done, it is revised standard minus actual. So the cost variance will be 5625 minus 6480. Company knew that cost will go up to 5625. This manager took it further above. 855 adverse is exclusively because of manager. See, we already knew that cost would go up. You took it even beyond that. The reason is, instead of buying material for 2.25, you purchase it at a further higher rate. Plus your quantity consumption is also more. So 2.25 you were supposed to pay, you paid 2.4, you paid, instead of 2.25 you paid 2.4, so you paid 0.15 extra, but then you consumed also 2700. So that was a loss to the extent of 405 adverse. You will pay more, you will pay less only if you actually pay, and you will actually pay for something which is actually purchased and consumed. Even in terms of quantity, there is a variance. Instead of 2500, you actually consume 2700. 200 kgs you are consuming more. 200 kgs you are consuming more at the rate of 2.25. 450 adverse is your variance. See, it tallies. That's your planning variance. See, that means originally company is incurring loss of 2730. Company says my manager has not done the work properly. See, your manager is not responsible for 2730. You already knew that your cost would go up by 1875. Manager is responsible only for 855. You understood this. Your cost as per traditional approach has gone up by 2730. But actually for entire 2730, manager is not responsible because you only revised your standard because you knew that well in advance that your cost would go up by 1875. He took up furthermore by 855. That was a problem. So he will not be held responsible for 2730 adverse. Manager will be held responsible for 855 adverse because even company anticipated some rise in the cost. That is your traditional planning and operational variances. Practice hard. These questions will only be asked. Lengthy questions I don't expect, but then these are all conceptual questions. Thank you so much guys for watching this. See you soon. Now the next chapter which I want to discuss with you is profitability analysis. Now in this chapter they somehow ask you to calculate profit. It can be a customer wise profit, it can be a segment wise profit, it can be a divisional profit, it can be overall profit of the company. Doesn't matter. In all calculations, it is basically sales minus total cost. And when you talk about total cost, you take variable cost first and then you subtract even fixed cost. While fixed cost calculation is going on, they may ask you to go for they may ask you to apply activity based costing concept. They will give you total cost of one activity, they will give you cost drivers, they will give you breakup of cost driver product wise. You find out rate of the cost driver, apply that rate on various products, and profitability can be calculated. Profitability means they may ask you percentage of profit, they may ask you only amount of profit. And then they may ask you to take certain decisions, they may ask you to provide some suggestions. So sometimes it may so happen that despite of huge volume, the profit is less in one of the products. Then you analyze discount policy, you analyze a speedy delivery, you may analyze, you may realize that there are some extra amount of expenditure incurred at a high rate, so you can suggest accordingly. That part is very simple. I want to revise something special, which is strategic evaluation of profit. I want to revise strategic evaluation of profit. Now, what do you mean by strategic evaluation? Whenever there is a change in the profitability, you need to find out the reason behind it, the way we did in standard costing. Whenever your profit goes up or whenever it goes down, you simply try to figure out, you simply try to find out the reasons for that. And that is called as strategic evaluation. For that, I'll solve one question. You'll understand the whole system and the entire concept here. Question number 12 of Profitability Analysis chapter, page number 269. Aditya Decors Limited is a leading manufacturer of luxury sanitary products and has divided its whole business into different product segments. At the last year, the management of ADL has decided to make some changes in its one of the product line Adi. The improved version was made available for sale from 1st of April 20-something-4. At the end of the financial years 20-something-4-something-5, the Finance and Accounts Department has extracted some relevant data for the product line Adi to analyze the decision taken last year. The data related to Adi is as follows: number of units sold. We can clearly see the rise in the quantity. We can see the change in the selling price. We can see the material consumption. We can see the price at which the material was purchased and fixed cost and all. ADL has a capacity to produce 5,000 units of Adi in a year. So we are well within the capacity limits. Analyze the change in the operating income for both the years with respect to growth, price and productivity components. We'll discuss that later. And then they have asked us to reconcile profit from both the years. Now, if you really want to reconcile two profit figures, first of all, you need to have two profit figures with you. If you want to reconcile two profit figures, you should have two profit figures with you. Now, for that, we need to prepare a statement of profit for the year 20 something 3, 4 and 20 something 4, 5. We will have to start with sales. If you see the quantity structure, in the first year 4 lakh units were sold and the selling price was 4175, and in the second year 4,30,000. See, I am having textbook in front of me, so I am not changing the screen so that you can see the solution properly. And how much is the selling price given? 4325. So 4 lakhs into 4175, 16,700 lakhs. $18,597.5 lakhs is going to be the sales. This is going to be the sales. From sales, we will deduct material cost. My material cost is 24 lakhs into expected price 470, whereas 25.10 lakh kgs is consumed more. 25.10 lakh kgs are consumed in reality at 485. So that comes to 11,280 lakhs as material cost, and 25.10 multiplied by 485, 12,173.5. This is what my first cost structure is. My second cost structure is labor. They have clearly said 32 lakh hours are to be worked for at the rate of 30. But the team has actually worked for 34 lakh 80,000 hours into the actual rate was given to be 30 lakhs, 31 rupees. So 32 into 30, 960 lakhs, 34.80 into 31, 1078.8 lakhs. Then we have variable overheads. Dekho, see, no, we don't have variable now, we directly have fixed overheads. Okay, 1.6 and 176. Okay, so we have fixed cost here, 160 lakhs and 176 lakhs. So I'll simply take the total of the cost, 11,280, 960, 160. $12,400. So my profit for the first year is 4,300 lakhs, because total cost will be marked as B, sales is marked as A, and my profit here will be A minus B. My profit will be A minus B. In the next year, 12,173.5, 1078.8, 176, 13,428.3, 13,428.3 lakhs minus 18,597.5, 5169.2. So ideally we have got to know profit figures of 2 years. So this is your profitability as asked in the first part of the question. This is your profitability as per the first part in the question, and now we'll have to analyze this. We need to find out why there is a change in the profit. What exactly has happened? What exactly has happened? Okay. Now I can clearly see the rise in the quantity structure. From 4 lakh, it has gone up to 4,30,000. So there is a growth that we can see in terms of volume. Now if your quantity increases, if your quantity is more than the previous year, naturally your revenue will also be more than previous year. And not only your revenue, but even your material cost and labor cost will also be more in the current year as compared to the previous year. So that will be the growth factor. Plus I can also see change in pricing. My material price, my labor rate, everything is different. My material price, my labor rate, everything is different. So accordingly, I'll have to slice out the rise in the profit structure. So for that, look at the consumption pattern. Originally, I need 6 kgs of raw material and 8 hours of labor hours. 6 kgs of raw material I generally need, I used last year, and 8 hours I have worked for producing 1 unit. Now let us go for the analysis. When we talk about growth, the first thing that you need to understand is you are talking about quantity rise. And if your quantity increases, it will have first impact on the revenue. If your quantity increases, it will have the first impact on the revenue. And revenue impact is quantity of 4 lakhs in the first year, quantity of 4,30,000 in the second year. But I'm applying selling price of the first year. Guys, you're not finding out usage variance. You're not doing standard costing. You're simply analyzing the profit rise. Okay, so please concentrate here. 4 lakh units I was supposed to sell, but I managed to sell 4,30,000 units. So my sales has gone up by 30,000 units. Why am I applying the old selling price? I'm applying the old selling price because I want to know impact of quantity on the revenue. If I apply the revised selling price of the second year, that means quantity and price both will be analyzed in this part of the calculation, which we don't want. So 4 minus 4.3 into 4175, 1252. 0.5 lakhs and certainly a favorable variance. You understood why we did not consider actual selling price or latest selling price? I want to know the impact of quantity. Since my quantity has gone up by 30,000, even if there wouldn't have been any change in the selling price, I would have earned more revenue because of rise in the quantity. Then your quantity rise will have impact on cost also. Like for material, if I talk about 24 lakhs was your consumption in the first year. In the second year, since your quantity went up by 30,000 at the rate of 6 kgs per unit, your consumption would have been different, no? Your consumption would have been different, and naturally I am supposed to consider original price. I am not supposed to go for change in the price. So guys, 4,30,000 into 6 instead of 24 lakhs. Because of the rise in the quantity, there was a need to consume 25,80,000 kgs of material. You understood what I am saying? Additional quantity of finished goods will require additional quantity of material to be consumed, bachcha log. Now that means $30,000 extra units will demand 1,80,000 kgs of 1,80,000 kgs of raw material more. So this has created an adverse impact on material cost because of rise in the quantity. Even the material requirement went up. So if you are going to earn more, naturally you are going to spend more on material. In simple words, you can also find out this way. 4 lakhs is what I did in the first year, 4,30,000 is what I have done in the second year. 4 lakhs minus 4,30,000, 30,000 units were produced extra at the rate of 6 kgs per unit. 30,000 extra units will need 1,80,000 kgs of raw material extra. Again, I am not considering price of the current year because I don't want to show the impact of price in this calculation. I want to restrict myself to this calculation. Secondly, I am not considering 25,10,000 because instead of 25,80,000, you have completed work in 25,10,000. That means it is a matter of efficiency or productivity, which I am not considering here. See, my profit evaluation will now be split into 3 parts. One is impact of quantity structure, impact of price, and impact of skill. So instead of 25,80,000, if you have completed work in 25,10,000, that is evaluated when you evaluate skill of the worker, not now. This is pure calculation which says 30,000 extra units will demand 1,80,000 additional quantity of material. This will cost you 846. Secondly, even in terms of labor, currently you might have consumed, in the first year you might have worked for 32 lakhs. In the second year, since you have produced 4,30,000 units at the rate of 8 hours per unit, you would have consumed more. You would have worked for more number of hours. So instead of 32 lakhs, ideally, your team should have worked for 34.4 hours. Again, I am going for the original rate because I know that I am not supposed to consider impact of price in this whole calculation. So instead of 32 lakh hours, you are supposed to work for 34.4 lakh hours. So 2.4 lakh to 2,40,000 hours will be required extra into 30. So it will be 72 lakhs adverse. It will be 72 lakhs adverse. Have you understood this? 30,000 extra units of finished goods would demand 8 hours per unit. That means if my quantity grows by 30,000, my requirement for hours will also increase by 2,40,000 hours. And since I'm going for only quantity as a base, I'm not considering the revised rate. 72 lakhs is the additional loss which I have to bear. 72 lakhs is a rise in the cost which I have to bear just because my quantity went up. My third cost structure is fixed cost, and trust me, your fixed cost has got nothing to do with the quantity rise. So your quantity rise will affect you in terms of sales, in terms of material cost, in terms of labor cost. Sales will go up, material cost and labor cost will also go up because the requirement increases. So that was a growth factor. My second evaluation or second category of evaluation is price. My second category of evaluation is price. When I talk about price, again there are two types of segments. One is the segment of revenue. Selling price in the first year was 4175. Selling price in the second year was 4325. Now price has gone up against 4,30,000 units. 4175 minus 4325 multiplied by 4.3. 645 lakhs, but favorable. Why favorable? Because your selling price is increased. Secondly, when I talk about cost, I have material cost first, where instead of 470, we paid 485. Instead of 470, we paid 485. And quantity to be applied will be actual quantity. But listen, I am not considering 25.10. Please try to understand. I was supposed to use 25.80 lakh kgs of raw material. If I have actually used 25 lakh 10,000, that will be evaluated, that will be taken into consideration only at the time of consumption and the efficiency and the productivity evaluation, not at the time of price evaluation. So 15 rupees you are paying more on 25.80 lakhs. That comes to 387 lakhs, but variance is adverse because material is purchased at a high rate. Even in terms of labor, instead of paying worker at the rate of 30, you paid your worker at the rate of 31. And ideally, you should have taken 34.4 lakh hours. See, you have taken more, but that is an outcome, that is an evaluation of efficiency. We will not consider it here. So, 34.4 lakhs adverse is your labor. And guys, even your fixed cost will be affected. Instead of 1,60,000, if it has gone up to 1,76 lakhs. Instead of 160 lakhs, it has gone up to 176 lakh. That is also rise in the price only. The rate of rent, if changes, it is also considered to be the effect of pricing. So, if quantity goes up, my revenue goes up, but my material quantity and my labor hours requirement also goes up. So, I have a favorable variance in terms of revenue, but I have two adverse variances in terms of cost. I have not considered actual quantity and actual hours because that will be taken care of only when we analyze the efficiency. When we started talking about pricing is directly to be picked up. But the quantity that you apply, that should be your ideal quantity for producing, the standard quantity for producing your output of the second year. I'm not considering 2510, I'm not considering 38 odd, because that will be taken care of at the time of efficiency and productivity. So that was about pricing. Point number 3, evaluation of productivity and efficiency. Evaluation of productivity and efficiency. Now, productivity and efficiency can be observed in terms of material. My calculation is pretty simple. Instead of consuming 25,80,000, my work was done in 25,10,000. Since I saved more in the second year, during the second year, since I have saved more, the rate prevailing in the second year was 485. So, at the rate of 485, there is a saving of 339.5, and that's favorable. Are you getting me? Instead of 25,80,000 kgs, I consumed 25,10,000 kgs. So, I saved 70,000 kgs there. I saved 70,000 kgs in the second year. And during the second year, the rate prevailing was 485. So, you have not saved 70,000 in the first year that you are applying 470. You have saved 70,000 in the second year, where you have applied, you have purchased material at the rate of 485. Same thing is about labor. Instead of 34,40,000, you have actually taken 34,80,000. Please do not consider rate of the first year. If you have taken 40,000 hours extra, you have taken 40,000 hours extra in the second year. And in the second year, if you are taking 40,000 hours extra, it would cost you it will cost you 12.4 lakhs extra. Array, have you understood this? Are you clear with it? In material, productivity was awesome. In labor, there was inefficiency, and both happened in the second year. So, rate of the second year needs to be considered. So, after this, we will have to go for reconciliation. So, now we are supposed to go for reconciliation. Inner column, outer column. First thing first, profit of 20 something 3 4 4,300 lakhs. 4,300 lakhs. First thing first, growth effect. To what extent your quantity has affected you? In that, the first thing is revenue, 1252.5 lakhs favorable. In terms of cost, we have material and labor, 846 lakhs and 72 lakhs. 846 lakhs adverse and 72 lakhs adverse. collectively it says 1252.5 favorable minus 846 minus 72. 334.5 lakhs, but favorable is the impact of growth. If you talk about price, again there will be a twofold effect. One with the revenue, 645 lakhs favorable because you increase the selling price. 645 lakhs favorable because you increase the selling price. Cost has threefold effect: material, labor, prices have gone up, rates is increased. So since the rate is increased, even there we have adverse variance. 387 plus 34.4 plus 16, 437.4, and favorable is 645. So 207.6, 207.6 lakhs favorable. And finally you have productivity or efficiency. Finally you have productivity and efficiency, and that is in the form of material and labor. That is in the form of material and labor. Which collectively gives me the revised profit figure. 339.5, 12.4. 339.5 lakhs but favorable, and 12.4 lakhs adverse. 339.5. 327.1, 327.1 lakhs favorable. Now if you see the impact, you must get profit for 20 something 4 something 5. You started with 3.4, you must get the other one. 4,300 growth. Due to growth there is a favorable variance 334.5. Due to cost, due to price also there is a favorable variance 207.6 and 327.1. 5169.2. 5169.2 is my answer. Have you understood this? That's your reconciliation. This is a big thing which you must revise on the last day. So I'm picking up only this. Other things are going to be very simple. Sales minus revenue, sales minus cost. And even in cost, they may, to make it more descriptive, they may ask you to apply activity-based costing. So they can ask you ABC. They'll give you cost, you find out cost driver, find out the rate of the cost driver, simply multiply by the individual cost driver for each and every product, and you will be getting the answer. Is that part clear? So that was profitability analysis, guys. Thank you so much. Now the next chapter which I want to discuss with you is profitability analysis. Now in this chapter they somehow ask you to calculate profit. It can be a customer wise profit, it can be a segment wise profit, it can be a divisional profit, it can be overall profit of the company. Doesn't matter. In all calculations, it is basically sales minus total cost. And when you talk about total cost, you take variable cost first and then you subtract even fixed cost. While fixed cost calculation is going on, they may ask you to go for they may ask you to apply activity based costing concept. They will give you total cost of one activity, they will give you cost drivers, they will give you breakup of cost driver product wise. You find out rate of the cost driver, apply that rate on various products, and profitability can be calculated. Profitability means they may ask you percentage of profit, they may ask you only amount of profit. And then they may ask you to take certain decisions, they may ask you to provide some suggestions. So sometimes it may so happen that despite of huge volume, the profit is less in one of the products. Then you analyze discount policy, you analyze a speedy delivery, you may analyze, you may realize that there are some extra amount of expenditure incurred at a high rate, so you can suggest accordingly. That part is very simple. I want to revise something special, which is strategic evaluation of profit. I want to revise strategic evaluation of profit. Now, what do you mean by strategic evaluation? Whenever there is a change in the profitability, you need to find out the reason behind it, the way we did in standard costing. Whenever your profit goes up or whenever it goes down, you simply try to figure out, you simply try to find out the reasons for that. And that is called as strategic evaluation. For that, I'll solve one question. You'll understand the whole system and the entire concept here. Question number 12 of Profitability Analysis chapter, page number 269. Aditya Decors Limited is a leading manufacturer of luxury sanitary products and has divided its whole business into different product segments. At the last year, the management of ADL has decided to make some changes in its one of the product line Adi. The improved version was made available for sale from 1st of April 20-something-4. At the end of the financial years 20-something-4-something-5, the Finance and Accounts Department has extracted some relevant data for the product line Adi to analyze the decision taken last year. The data related to Adi is as follows: number of units sold. We can clearly see the rise in the quantity. We can see the change in the selling price. We can see the material consumption. We can see the price at which the material was purchased and fixed cost and all. ADL has a capacity to produce 5,000 units of Adi in a year. So we are well within the capacity limits. Analyze the change in the operating income for both the years with respect to growth, price and productivity components. We'll discuss that later. And then they have asked us to reconcile profit from both the years. Now, if you really want to reconcile two profit figures, first of all, you need to have two profit figures with you. If you want to reconcile two profit figures, you should have two profit figures with you. Now, for that, we need to prepare a statement of profit for the year 20-something-3, 4 and 20-something-4, 5. We will have to start with sales. If you see the quantity structure, in the first year 4 lakh units were 4 lakh units were sold and the selling price was 4175, and in the second year 4,30,000. See, I'm having textbook in front of me, so I'm not changing the screen so that you can see the solution properly. And how much is the selling price given? 4325. So 4 lakhs into 4175, 16,700 lakhs. 18,597.5 lakhs is going to be the sales. This is going to be the sales. From sales, we will deduct material cost. My material cost is 24 lakhs into expected price 470, whereas 25.10 lakh kgs is consumed more. 25.10 lakh kgs are consumed in reality at 485. So that comes to 11,280 lakhs as material cost, and 25.10 multiplied by 485, 12,173.5. This is what my first cost structure is. My second cost structure is labor. They have clearly said 32 lakh hours are to be worked for at the rate of 30. But the team has actually worked for 34 lakh 80,000 hours into the actual rate was given to be 30 lakhs, 31 rupees. So 32 into 30, 960 lakhs, 34.80 into 31, 1078.8 lakhs. Then we have variable overheads. Dekho, see, no, we don't have variable now, we directly have fixed overheads. Okay, 1.6 and 176. Okay, so we have fixed cost here, 160 lakhs and 176 lakhs. So I'll simply take the total of the cost, 11,280, 960, 160. $12,400. So my profit for the first year is 4,300 lakhs, because total cost will be marked as B, sales is marked as A, and my profit here will be A minus B. My profit will be A minus B. In the next year, 12,173.5, 1078.8, 176, 13,428.3, 13,428.3 lakhs minus 18,597.5. 5169.2. So ideally we have got to know profit figures of 2 years. So this is your profitability as asked in the first part of the question. This is your profitability as per the first part in the question, and now we'll have to analyze this. We need to find out why there is a change in the profit. What exactly has happened? What exactly has happened? Okay. Now I can clearly see the rise in the quantity structure. From 4 lakh, it has gone up to 4,30,000. So there is a growth that we can see in terms of volume. Now, if your quantity increases, if your quantity is more than the previous year, naturally your revenue will also be more than previous year. And not only your revenue, but even your material cost and labor cost will also be more in the current year as compared to the previous year. So that will be the growth factor. Plus I can also see change in pricing. My material price, my labor rate, everything is different. My material price, my labor rate, everything is different. So accordingly, I'll have to slice out the rise in the profit structure. So for that, look at the consumption pattern. Originally, I need 6 kgs of raw material and 8 hours of labor hours. 6 kgs of raw material I generally need, I used last year, and 8 hours I have worked for producing 1 unit. Now let us go for the analysis. When we talk about growth, the first thing that you need to understand is you are talking about quantity rise. And if your quantity increases, it will have first impact on the revenue. If your quantity increases, it will have the first impact on the revenue. And revenue impact is quantity of 4 lakhs in the first year, quantity of 4,30,000 in the second year. But I'm applying selling price of the first year. Guys, you're not finding out usage variance. You're not doing standard costing. You're simply analyzing the profit rise. Okay, so please concentrate here. 4 lakh units I was supposed to sell, but I managed to sell 4,30,000 units. So my sales has gone up by 30,000 units. Why am I applying the old selling price? I'm applying the old selling price because I want to know impact of quantity on the revenue. If I apply the revised selling price of the second year, that means quantity and price both will be analyzed in this part of the calculation, which we don't want. So 4 minus 4.3 into 4175, 1252.5 lakhs, and certainly a favorable variance. You understood why we did not consider actual selling price or latest selling price? I want to know the impact of quantity. Since my quantity has gone up by 30,000, even if there wouldn't have been any change in the selling price, I would have earned more revenue because of rise in the quantity. Then your quantity rise will have impact on cost also. Like for material, if I talk about 24 lakhs was your consumption in the first year. In the second year, since your quantity went up by 30,000 at the rate of 6 kgs per unit, your consumption would have been different, no? Your consumption would have been different, and naturally I am supposed to consider original price. I am not supposed to go for change in the price. So guys, 4,30,000 into 6 instead of 24 lakhs. Because of the rise in the quantity, there was a need to consume 25,80,000 kgs of material. You understood what I am saying? Additional quantity of finished goods will require additional quantity of material to be consumed, bachcha log. Now that means $30,000 extra units will demand 1,80,000 kgs of 1,80,000 kgs of raw material more. So this has created an adverse impact on material cost because of rise in the quantity. Because of rise in the quantity, even the material requirement went up. So if you are going to earn more, naturally you are going to spend more on material. In simple words, you can also find out this way. 4 lakhs is what I did in the first year, 4,30,000 is what I have done in the second year. 4 lakhs minus 4,30,000, 30,000 units were produced extra at the rate of 6 kgs per unit. 30,000 extra units will need 1,80,000 kgs of raw material extra. Again, I am not considering price of the current year because I don't want to show the impact of price in this calculation. I want to restrict myself to this calculation. Secondly, I am not considering 25,10,000 because instead of 25,80,000, you have completed work in 25,10,000. That means it is a matter of efficiency or productivity, which I am not considering here. See, my profit evaluation will now be split into 3 parts. One is impact of quantity structure, impact of price, and impact of skill. So instead of 25,80,000, if you have completed work in 25,10,000, that is evaluated when you evaluate skill of the worker, not now. This is pure calculation which says 30,000 extra units will demand 1,80,000 additional quantity of material. This will cost you 846. Secondly, even in terms of labor, currently you might have consumed, in the first year you might have worked for 32 lakhs. In the second year, since you have produced 4,30,000 units at the rate of 8 hours per unit, you would have consumed more. You would have worked for more number of hours. So instead of 32 lakhs, ideally, your team should have worked for 34.4 hours. Again, I am going for the original rate because I know that I am not supposed to consider impact of price in this whole calculation. So instead of 32 lakh hours, you are supposed to work for 34.4 lakh hours. So 2.4 lakh to 2,40,000 hours will be required extra into 30. So it will be 72 lakhs adverse. It will be 72 lakhs adverse. Have you understood this? 30,000 extra units of finished goods would demand 8 hours per unit. That means if my quantity grows by 30,000, my requirement for hours will also increase by 2,40,000 hours. And since I am going for only quantity as a base, I am not considering the revised rate. 72 lakhs is the additional loss which I have to bear. 72 lakhs is a rise in the cost which I have to bear just because my quantity went up. My third cost structure is fixed cost, and trust me, your fixed cost has got nothing to do with the quantity rise. So your quantity rise will affect you in terms of sales, in terms of material cost, in terms of labor cost. Sales will go up, material cost and labor cost will also go up because the requirement increases. So that was a growth factor. My second evaluation or second category of evaluation is price. My second category of evaluation is price. When I talk about price, again there are two types of segments. One is the segment of revenue. Selling price in the first year was 4175. Selling price in the second year was 4325. Now price has gone up against 4,30,000 units. 4175 minus 4325 multiplied by 4.3. 645 lakhs, but favorable. Why favorable? Because your selling price is increased. Secondly, when I talk about cost, I have material cost first, where instead of 470, we paid 485. Instead of 470, we paid 485. And quantity to be applied will be actual quantity. But listen, I am not considering 25.10. Please try to understand. I was supposed to use 25.80 lakh kgs of raw material. If I have actually used 25 lakh 10,000, that will be evaluated, that will be taken into consideration only at the time of consumption and the efficiency and the productivity evaluation, not at the time of price evaluation. So 15 rupees you are paying more on 25.80 lakhs. That comes to 387 lakhs, but variance is adverse because material is purchased at a high rate. Even in terms of labor, instead of paying worker at the rate of 30, you paid your worker at the rate of 31. And ideally, you should have taken 34.4 lakh hours. See, you have taken more, but that is an outcome, that is an evaluation of efficiency. We will not consider it here. So, 34.4 lakhs adverse is your labor. And guys, even your fixed cost will be affected. Instead of 1,60,000, if it has gone up to 1,76 lakhs. Instead of 160 lakhs, it has gone up to 176 lakh. That is also rise in the price only. The rate of rent, if changes, it is also considered to be the effect of pricing. So, if quantity goes up, my revenue goes up, but my material quantity and my labor hours requirement also goes up. So, I have a favorable variance in terms of revenue, but I have two adverse variances in terms of cost. I have not considered actual quantity and actual hours because that will be taken care of only when we analyze the efficiency. When we started talking about pricing is directly to be picked up. But the quantity that you apply, that should be your ideal quantity for producing, the standard quantity for producing your output of the second year. I am not considering 2510, I am not considering 38 odd because that will be taken care of at the time of efficiency and productivity. So that was about pricing. Point number 3. Evaluation of productivity and efficiency. Evaluation of productivity and efficiency. Now, productivity and efficiency can be observed in terms of material. My calculation is pretty simple. Instead of consuming 25,80,000, my work was done in 25,10,000. Since I saved more in the second year, during the second year, since I have saved more, the rate prevailing in the second year was 485. So, at the rate of 485, there is a saving of 339.5, and that's favorable. Are you getting me? Instead of 25,80,000 kgs, I consumed 25,10,000 kgs. So, I saved 70,000 kgs there. I saved 70,000 kgs in the second year. And during the second year, the rate prevailing was 485. So, you have not saved 70,000 in the first year that you are applying 470. You have saved 70,000 in the second year where you have applied, you have purchased material at the rate of 485. Same thing is about labor. Instead of 34,40,000, you have actually taken 34,80,000. Please do not consider rate of the first year. If you have taken 40,000 hours extra, you have taken 40,000 hours extra in the second year. And in the second year, if you are taking 40,000 hours extra, it would cost you it will cost you 12.4 lakhs extra. Array, have you understood this? Are you clear with it? In material, productivity was awesome. In labor, there was inefficiency, and both happened in the second year. So, rate of the second year needs to be considered. So, after this, we will have to go for reconciliation. So, now we are supposed to go for reconciliation. Inner column, outer column. First thing first, profit of 20 something 3 4 4,300 lakhs. 4,300 lakhs. First thing first, growth effect. To what extent your quantity has affected you? In that, the first thing is revenue, 1252.5 lakhs favorable. In terms of cost, we have material and labor, 846 lakhs and 72 lakhs. 846 lakhs adverse and 72 lakhs adverse. Collectively, it says 1252.5 favorable minus 846 minus 72. 334.5 lakhs, but favorable is the impact of growth. If you talk about price, again there will be a twofold effect. One with the revenue, 645 lakhs favorable because you increase the selling price. 645 lakhs favorable because you increase the selling price. Cost has threefold effect: material, labor, prices have gone up, rates is increased. So since the rate is increased, even there we have adverse variance. 387 plus 34.4 plus 16, 437.4, and favorable is 645. So 207.6, 207.6 lakhs favorable. And finally you have productivity or efficiency. Finally you have productivity and efficiency, and that is in the form of material and labor. That is in the form of material and labor. Which collectively gives me the revised profit figure. 339.5, 12.4. 339.5 lakhs but favorable, and 12.4 lakhs adverse. 339.5. 327.1, 327.1 lakhs favorable. Now if you see the impact, you must get profit for 20 something 4 something 5. You started with 3-4, you must get the other one. 4,300 growth. Due to growth there is a favorable variance 334.5. Due to cost, due to price also there is a favorable variance 207.6 and 327.1. 5169.2. 5169.2 is my answer. Have you understood this? That's your reconciliation. This is a big thing which you must revise on the last day. So I'm picking up only this. Other things are going to be very simple. Sales minus revenue, sales minus cost. And even in cost, they may, to make it more descriptive, they may ask you to apply activity-based costing. So they can ask you ABC. They'll give you cost, you find out cost driver, find out the rate of the cost driver, simply multiply by the individual cost driver for each and every product, and you will be getting the answer. Is that part clear? So that was profitability analysis, guys. Thank you so much. Now we are heading towards the theory part. And I'm going to speak about budgetary control now. Budgetary control at interlevel was majorly the practical chapter, and it is theory now at final CA level. So guys, I'll briefly discuss all important aspects related to budgetary control. The first thing they can ask you is feedback and feed forward control. Now feedback control means when you take action or when you decide your plan once the incident takes place. Once the incidence takes place and you take an action, you change the budget, you change the plan, you improve the target, that is feedback budget. And feed forward control means when you anticipate some changes in the future and you try to change the budget. So feedback is a restorative process and feed forward is a protective process. So they may ask you a few theory points based on that. Feedback control, if they talk about, see, feedback, we already discussed. Feed forward is before the event actually takes place, you change the plan. So what are the limitations of advantages of feed forward control? As I said, it is protective. As it is protective, you avoid losses, and you avoid losses, plus you can evaluate the resources very well, like what we did in planning variance and operational variance. Planning variance means feed forward control. Planning variance is feed forward control. Okay, more or less. So you're already ready for, you're prepared for the change, so you change the budget. The prerequisite of feed forward control is you should have a clear discrimination about your resources and input variables. It should be a dynamic system. Whenever there is a change, the change needs to be informed to you, or you should come to know about the change, and you can change it, or you can apply it, implement it. Then your input variables, collection and assessment of them is important. Wrong data will always give you wrong information, and immediate action on the plan, because you won't have much time to get adjusted. You will have to take a quick action and change the plan accordingly. Now, as far as the second part of this chapter is concerned, see, questions we have already solved, so there is no point in focusing on questions now. We will be focusing only on theory parts. Questions you can answer, because it's going to be a very simple chapter as far as practicality is concerned. What are the behavioral aspects? Like, see, when you work as a team, okay, when you work as a team, there are so many people working with you, so their behavior also affects the work culture. Some people tend to discuss more, which prolongs the immediate action to be taken. I mean, the immediate action cannot be taken because of that. So all these things are required to be understood. So you need to evaluate the performance of the managers. You better make them as a part of your planning team. Otherwise, they will never accept the responsibility in terms of failure of the budget. Like, they will always have an argument that I was not forming. When you didn't ask me at the time of planning, why are you asking me about implementation? You are telling me to complete something in 5 hours, which is not possible. You should have asked me first before setting up the standard. Now it is not possible, I can't help it. But that will come to you once the failure happens. So that is a concern. Then you should be all the more focused about the quality aspects, and then they may, if you make them participate, they may give you slack target. Like, if they can complete the work in 5 hours, they may tell you 6 hours. So we have to find a golden mean out of all this, and accordingly we'll have to implement a strong budgetary control system. Now, when you talk about participation, there are two types of participation. One is top down and one is bottom up. Top down approach means that budget is prepared, everything is prepared, everything is planned by the management, and it will be simply given to the lower level management for the purpose of implementation. Their views will not be taken into consideration, their performance will not be, their expertise will not be taken into consideration, their opinion will not be taken into consideration. Budget will be prepared by the top management, it will be simply followed and implemented by the lower level management. But when it comes to bottom up approach, the budget is prepared by the lower level management with by using their expertise, by using their experience about the work field, because they are the real people who are working, you are handling your problems. So they will set the budget will be sent for the approval to the top management. That is why it is bottom up. Bottom up is better because customers or other your managers cannot run from the responsibilities because they were forming part of the team. They themselves have set the standard, they themselves have planned everything, so they can't run away. Like for example, if my company forces me to complete the syllabus in 80 hours, I'm not going to accept it. But if they tell me to decide how many hours I will take, and if I tell them, okay, I'll be able to complete it in 120 hours, and then when I don't complete in 120 hours, they can directly hold me responsible for that because I am the one who told them that I will be taking 120 hours. Are you getting me? So, bottom up approach will safeguard your results. What can affect your budget and what can affect your budgeting activity? Personality of the managers, some are outspoken, some are not, some may not reveal the information to you. The work situation, urgency, routine. If it is a routine job, your thought process is different. If it is a urgency, your work process is different. You can't involve many people in that. If at all there is a new issue coming up, nobody knows how to handle it, then it will all be trial and error method. Then the control strategy. Who has the control and to what extent they are enjoying the control. And finally, difficulty level of the job, low, high. Accordingly, employees' participation will make a difference. And lastly, where the organization structure is centralized, the participation will be less effective. If the decisions are taken by the top level management only, then it will not help you out. The participation won't help you out. And the most important concept in this chapter after feedback and feed forward control is beyond budgeting. It is beyond budgeting. Your traditional budgeting is having some drawback. Traditional budgeting means budget is prepared well in advance, say 1 month in advance, 1 week in advance, 1 year in advance, and same thing is implemented without registering any change. Without registering any change. So, in that case, the problem is situation keeps on changing, market size, market forces keep on changing, market conditions keep on changing. You can't have a stagnant budget for at all the levels. So, there was a different budget system which was introduced to avoid problems of being time consuming, rigidity, no change is required, no change is done, so that is rigidity. All these problems were taken care of by introducing beyond budgeting system. Beyond budgeting system works on rolling forecast. Rolling forecast means as and when you feel the need, as and when you feel the change in the market forces, you change the budget. Now that means if you keep on revising the budget, that keeps on working as a better benchmark for the purpose of implementation. Like if I give you a budget and I'm expecting it even after 9 months down the line it is going to be the same, that is absolutely wrong on my part. Because situation keeps on changing, situation keeps on worsening, anything can happen. Accordingly, your requirement will be different, accordingly your cost structure will be different, accordingly your need will be different. Like if you are anticipating some fall in the demand, some epidemic coming up or pandemic coming up, probably your sales will be minimized. And in that case, if you have already prepared a budget of producing 50,000 units, then it will be of no use, you will have to carry the stock at home. So, you need to have a rolling forecast, and Plus, the rolling forecast can be decided by market related targets. Market related targets according to the market. Now, suddenly if there is a, you are manufacturing sanitizer and suddenly there is a scope, there is a fear of some pandemic or epidemic. You may think of doubling the production because your market may respond in that manner. You may realize, you may sense that your market will demand more output, more quantity. You may think of doubling your production, and for that you will have to keep on changing your budget on a regular basis. That is beyond budgeting. The advantage is it is more adaptive process. According to the change, you are changing the budget, and plus it is decentralized process. Decentralized means your ground level reality will decide the budgeting. The one who is associated with the market, the one who is connected with the market will let you know what is happening in the market. Accordingly, you will change your budget. So it is a lower level budget, lower level management, which is telling you, okay, this may happen in the market. Then you are taking the decision. That means it is a participative budget and not autocratic one. It is a decentralized process, not a centralized one. How would you recognize? Rolling budgets may incorporate KPIs, key performance indicator. By looking at those actions, by looking at those results, you will realize in which direction you are going. Like if you are appearing for the exam, you must have appeared for test series first. Test series was key performance indicator. If in some subject, if you have scored less, you must have worked hard to cover that subject. If some subject you have scored very minimum, or in some part of some subject you have scored pathetic, then you would have worked hard towards that. So that is key performance indicator, and your rolling budget will work according to the key performance indicator. Suddenly the sales is going down. Okay, that is a sign that my quantity will be reduced now. Accordingly, I will change the quantity structure for the future. Then benchmarking can be incorporated in budgets. Some base can be taken, and that base will be considered as the basis of decision making. Some base can be taken into consideration, and on the basis of those benchmarks, you can take the decision. You need to focus on improving future results. So naturally, you'll have to keep on changing the budget. Allow operational managers to react to the environment. I told you, the one who's actually working at a root level will have better idea of the market, better idea of the environment than you. So rather than going for forcefully implemented centralized budgeting system, it is always better. Then you encourage culture of innovation. You keep on finding out different techniques, different techniques of recognizing performance indication. You should have, if you can realize the market fall 2 months in advance, do something whereby you will come to know about market fall probably 3 or 4 months in advance. Accordingly, you will have more time to be prepared for it. And finally, timely allocation of resources is the most important part, because wastage of resources will cost you a bomb. Benefits: you can beat the competition. Internal rivalry between managers can be reduced, because I will keep on, my competitor will keep on changing, my targets will keep on changing. So not two people will be working on the same project all the way, all the time. Some people will be given different tasks, another group of people will be given another task. So the internal rivalry can be taken care of. It motivates individual because their opinions are taken seriously while preparing the budget. Then you have team-based rewards and proper delegation of operational managers who are close to the concerned action and can react quickly. So quicker reaction is one of the advantages. Operational managers do not restrict themselves to budget limits and focus on achieving key ratios. Since you are focusing on operational manager, they are not going to simply work on documents, on paper. They will be actually into the field. They will be actually contributing towards the result. Then you can have a customer oriented team which can let you know what customer needs, to what extent customer is satisfied, or to what extent he is not. And it creates an information system which provides fast and open information, as all your input, entire input is given by the lower level management who are on the field work. the information is fast and open. So that was your beyond budgeting. You should revise this to distinguish between traditional budgeting, beyond budgeting. Beyond budgeting theory is also important for you. And the most important thing is, apart from questions, the most important thing is feedback control, feed forward control. So these are the three major aspects which you work for. Generally, if the questions are asked in this, they will always ask question based on feedback and feed forward. They will give you the scenario. If you anticipate the change and trying to change the budget, it is feed forward control. If you have already, if something has happened and now you are trying to change the budget, that means it is feedback control. So that was your budgetary control, guys. Majorly, I am expecting only theory questions on this, and even if they ask you a practical question, it will be more of a case study nature. Okay, for that you can watch that case study video also, which you must have already done. I have put it on the YouTube JKSC channel. It's about our case studies and case scenarios. Chapter wise case studies I have put, so whenever you get time, just have a glance on it. So thank you guys, that was budgetary control for you. Next chapter, Introduction to Strategic Cost Management. See, basically there are three things to be understood in this chapter. One is, what is strategic, what is cost, and what is management. You know what is management, you know what is cost, you know what is strategic also. But then we will have to understand it in a manner related to cost accounting. See, in the traditional system of accounting, you are majorly focusing on cost control and cost reduction. There was no other focus given, like the propriety of the cost, whether the cost is needed or not. All these factors were not checked. So the limitation of traditional cost management was, we were focusing only on cost reduction. Cost reduction was always considered to be the only objective. We were not focusing on competition. We were not focusing on the change in the market business dynamics. Limited focus, since we were not focusing, since our focus was on a limited criteria, we always lack in terms of improvisation, and then more of a reactive approach was followed. Something goes wrong, then you take the action. Something goes wrong, you know that something is wrong on the basis of variances. Variances tell you that okay, something has gone wrong, and then you start taking the action. Then that means you are focusing on short-term things. So we decided to change the strategy, and we started implementing different things. When you talk about strategy, basically it was a combination of strategic positioning analysis, cost driver analysis, and value chain analysis. So strategic positioning analysis means what your organization has, what is the culture your organization is followed, what systems are you following. If there is any change required to be implemented, you need to know what exactly are you doing. Then you should also know the external environment, because external environment will keep on giving you opportunities, threats. So you should know that, and plus you should know your strength and weaknesses, that is your internal environment in terms of competencies and resources, what you have, what you don't have, where you lack. That is your strategic evaluation of your business. Then cost driver analysis. You find out the factors which will minimize or maximize the cost structure, focus on that, and then finally you have a value chain analysis. Value chain analysis means it is a process, it is an internal process to design, produce, market, deliver, support the product. Right from A to Z, whatever you do is value chain. So, designing the product, manufacturing the product, marketing the product, distributing the product, rather delivering the product, and after sales service given to the customer. Everything will be included in value chain analysis. So, you need to have a focus on all these 5-6 segments. Your cost is required in terms of designing, cost is required for production, cost is required for marketing, cost is required for delivery, and definitely some cost is required for after sales services. So, you have 5 different segments: design, production, marketing, delivery, and after sales. So, you should know the core area of all these 5 segments. Now, when you talk about value chain, you are supposed to deal with 2 types of activities. One is primary activity and the other one is support activity. Primary activities means inbound logistics. Inbound logistics means input of raw material which is required, input of any sort which is required to carry on the operations. Then the second phase is operations, which is all the more important. How the processing is going on, what are the techniques which are used, what are the machines required for using, what is the strength, what is a requirement of machining hours, what is a requirement of packing, packaging, all these things have to be very clear. Then you have outbound logistic. Outbound logistic means everything about the output, how it is collected, how it is stored, how it is warehoused, how it is delivered, how it is transported, everything will be covered in outbound logistic. Then you have marketing and sales. You will try to sell it. What are the strategies? What is the distribution network that is required? What is the market? How the market is, how the market can be, how can we reach to the market if there is no commutation available? And then finally, after sales service, what exactly can you do to satisfy the customer even after buying the product? For that, you need to understand your support activities. Support activity, when we talk about, you are supposed to be very careful at the time of procurement material. Then at the time of technological development, you should not implement a system which is difficult for the people to understand. Whenever you go for technological development, you have to take your staff into confidence, you have to speak to them, you'll have to provide training facility to them, and then you have to be very clear about your human resource management, appraisal, placements, then you have rewards, then you can even think of bonus and all that, and then the infrastructure that you set. The next concept that can be asked in the question, this can be asked as a theory, this can be asked as a case study: core competency analysis. Now, core competency is something that keeps you, that makes you different. Core competency is something that makes you different from others. Like you have iPhone, because of security is different from others. You have Suzuki cars, because of the mileage they are different from others. You have BMW, Mercedes, because of the features you can distinguish them. So, core competency is a distinctive or a unique skill or a technological know-how that creates a distinctive customer value. How will you identify the core competency? What are your end product benefits? What are your end product benefits? How wide you can sell your product? And how difficult are you to be copied by your competitors? Because lesser is the copy, lesser is the imitation, larger will be the period for which you will prolong. Because if your substitute is available at a cheaper rate, people will always go for the first copy. So, ideally you should be completely different from your competitors, and secondly, that uniqueness must be unbeatable, unmatchable, uncopyable. Like Maggi, there are so many noodles brand available in India, but why Maggi is surviving? There is some core competency, correct? Now, core competency can be through resources and through capabilities. Like iPhone is all successful because of the resources. iPhone is all because of the resources, but you can also be successful due to different processes, different characteristics of the machine or capability of the machine. So, the company's ability to coordinate resources and use them productively. Sometimes you might be little less in terms of experience, sometimes you might be little less in terms of technology, but the discipline approach given by you always takes you ahead. Then segment analysis. Segment analysis is basically, when you talk about a business, business is always a collection of several systems. So, and when you talk about a system, so one system will be formed by several subsystems. Like when you talk about a motor car industry or automobile industry, not only cars will be taken into consideration, you also have the companies who manufacture headlights, who manufacture tail lights, who manufacture wiring, who manufacture wipers, who manufacture different accessories needed for a car. They will also be considered as a part of segment. So, you identify the segment based on the nature and complexity. Like you feel that sale is a complex, then you just construct a matrix and give analysis product wise, region wise, division wise, department wise, and then you analyze everything on performance basis or profitability basis. So, identify the key success factors from the, identify all your key success factors. What are the important factors which we are looking out for, and then analyze the attractiveness of broad versus narrow segment scope, since narrow segments could be riskier. So, more than segment analysis, I feel core competency analysis is important. You can give those examples of Google, iPhone, Maggi, Suzuki. You can give these examples, doesn't matter. Competitive advantage. Now, competitive advantage consists of two things. One is your product differentiation, how your product is, to what extent your product is different from others. And second one is cost leadership. Cost leadership means your cost, the minimization of cost. You can be successful because of two things. Either your product should be totally different from others, which others are not capable of giving to the customer. So, customer will be stick to you. That the simple example is Maggi, simple example is Suzuki. And the second one is cost leadership. You can also take example of iPhone when it comes to product differentiation. But when it comes to cost leadership, it is Suzuki. The cost is minimum. So, that is why the cars are cheaper as compared to any other brand. So, product differentiation and cost leadership are two different things. Product differentiation will always have advantage due to superior quality, super innovation, customer responsiveness, packaging, and expanding the product range, like what Samsung has done, what Apple has done. Low cost advantage means you keep low profile, keep your cost less, either by using cheaper material or by using substitutes, and then you don't earn on the basis of premium profit, you earn on the basis of volume. Then you have high volume purchasing to get discount on bulk purchase. You keep on buying more, so that if you buy more, you will get discount. Gaining and learning experience, learning curve benefit is also to be given, is also to be considered. Like after every batch is processed, there will be some learning. So, my next batch will be completed in lesser number of hours. Prolong this, someday it will be stagnant. Now, right now I'm completing one task in 10 hours, second time I did it, I could complete in 9 hours, third time I did it, I could do it in 8 hours, fourth time I did it in 7 hours. Now, somewhere there has to be stop. No, I can, if there is a 10th task which is performed by me, it will not be performed in 1 hour. Somewhere it will stop. So, if it is stopping at 7, I will try to do something whereby it goes down further to the level of 6, so that at least one more unit can be purchased or can be produced at a lesser time. So, overall time gets reduced. So, this chapter is basically about all theory parts. At the most, they can ask you a case study. Practical question with amounts and all cannot be expected here. So, basically, it is about your overall analysis, which does not take place in case of traditional costing system, traditional cost accounting system. So, that is why we are introducing strategic cost management system. So, that was your second chapter, guys. It was more of a theory. So, we have covered almost all points. Now, we will be heading towards the next one. Now, the next chapter is modern business environment. Trust me, I would rate it as the most important chapter from this theory section. A few things need to be discussed in this. The most important is cost of quality. I'll briefly revise all concepts. See, when you talk about quality, you already know that for any manufacturer these days, traditionally people were focusing more on profitability, but then as and when things have changed with a lot of competition around you, people have started realizing that maintaining quality is the most important task, because you cannot survive by impairing the quality of the product. Okay, so when you talk about quality, you just need to understand one very simple thing, that there can be two types of cost. One is cost of poor quality and cost of good quality. Cost of poor quality is what you suffer because of poor quality, and cost of good quality is what you do to prevent loss of quality impairment. So, when you talk about cost of pure quality, cost of poor quality, it is basically the cost which is incurred to restore things, and which has two types of cost structures. One is internal failure, the other one is external failure. Internal failure is something where you as a manufacturer realize that there is a fault in the product or the quality is impaired. External failure means when the customer realizes that there is a quality lapse. Now, if there is an internal failure, things can still be better as compared to external failure. See, external failure means you produce the product, it is distributed, it is transported to the market, customer buys it, there is a fault, customer returns the product, the same distribution channel will be used to get the material back, the same material will be distributed back, right? You will do the rework and resend it to the customer, or else you will have to replace the product and give a new product to the customer. That means your distribution cost is 3x, 3 times. Internal failure means rather than spending on two distribution rounds, what you can do is you can apply an inspection team, you can appoint an inspection team which after every batch, which after every production slot will randomly pick up some quantity, they will verify the product. If all products are tested okay, then quantity will be dispatched. If not, if there is a fault, from factory only it will be sent back to the production team and the rework will be done. So, first of all, instead of 3 times distribution cost, you are spending only once. And secondly, your brand is secured because customer will never come to know that there was a fault in the product. Good quality, cost of good quality is appraisal cost and prevention cost. Now, appraisal cost means audit inspection, everything that you do basically to safeguard that there is no quality lapse. And prevention cost means the same thing that you implement. We can clearly discuss this here. See, prevention cost. We are preventing poor quality. They are planned and incurred before the actual operation. Higher is the prevention cost, lower will be the detection and failure cost. So, you are stopping quality lapse. So, naturally it is implemented before the production starts. Quality planning, maintenance of quality systems, supplier evaluation. You make sure that the material distributed to you by your supplier will be of the best quality. If it is of the best quality raw material will deliver best quality finished goods only. Keep on doing product review. If there is a change required, you can change the product. Now see what is happening in automobile sector. You see Tata products. Tata Motors is coming out with so many facelifts. Nexon facelift, Safari facelift, Harrier facelift. It's been 2 years since 3 years Harriers is launched. Still there is a facelift. They add a few new features to the car, to the product, so that customer will be all the more happy. So product review is required. So if you keep on reviewing the product, you realize that there can be a quality lapse in this section or that section, and accordingly things can be taken care of. Quality improvement, team meetings, quality education and training will be preventive. Appraisal means verification, quality audits, supplier rating, supplier audits, inspection, field testing. All these things will prevent loss of quality lapse. Internal failure means when you realize that there is a wastage, like wastage, scrap, delays in the work, redesigning, it takes more time, shortage of material, shortage of finished goods, retesting and downtime. Downtime is idle time. External failure means distribution cost, repairs and servicing, warranty claim, complaints, returns, loss due to sales reduction. So you are eventually losing the customer also in the future. So that is all about cost of quality. If you can see these questions, they're simply telling you the same thing. The next concept you should know. You see, I am revising only concepts with the example so that you will come to know the question, you will come to know the concept. Questions can be done on your own because we already have solved all these questions in the class. This is again the most important part of this chapter, total quality management. Total quality management, basically there are 3 words to be understood. Total means overall. It is not restricted to one particular segment. Second one is quality. You know what is quality? Assurance of the expectation of the customer. And management is how you manage all these functions which can together safeguard the quality of the product. What exactly are you supposed to do? So it is an integrated and comprehensive system of planning and controlling all business functions so that we meet customer expectation. We meet customer expectations. Essential features of TQM. How do you do this? The most important part is continuous improvement. You will have to keep on checking the process. You will have to keep on checking the product or keep on checking operations. Then participation of employees, because employees are the one who will realize whether there is a quality lapse or not. Then you have a focus, customer focus, control and teamwork. TQM is completely based on continuous improvement, employee involvement, customer focus, proper control and teamwork. 6 C's stand for commitment. You should give what your customer needs. Culture, like what Tata have been doing in terms of after sales service, like Maruti have, what Maruti have been doing in terms of after sales service and all. Continuous improvement. You'll have to keep on changing your product. More you change your product, more will be people interested in buying your product, because nobody likes the same product. You don't sell Wagoner and buy Wagoner again unless there is some additional feature into it. So cooperation of C, since your entire organization is involved and it is overall quality management, all your functions are involved. That means cooperation among different departments also plays a vital role. Then you have a customer focus and control. Now Deming, this is again an important part which you must be prepared for. Deming is basically considered as father of quality control. He set a few norms, 14 points. Your improvement must be constant. Your improvement must be constant. You should be dynamic enough to adopt the new philosophy. So improvement must be constant. You should be dynamic. That means you must accept the new philosophy if there is a need. C is dependence on inspection. If you maintain the quality, you will be able to produce defect-free units. So your inspection cost will also be saved. Rather than verifying the work after the production takes place, you can safeguard quality norms before the production takes place. Like for example, if I have to appoint a good faculty, I can take demo lecture, I can ask several questions to the faculty, I will grill that faculty in the demo session. Once I am satisfied, I don't mind putting that faculty on the platform. The simple reason is, I know his knowledge, I have seen his delivery, I have seen his board presentation, I can easily expect that okay, this faculty will do well. This is total quality management's basic requirement. Otherwise, when I put that faculty on the platform and students complain, then it is going to be a restorative process, which is harmful for the faculty's career also and for my brand also. So C is dependence on inspection. You make sure that your input is quality, so nothing can stop you from getting the best quality output. Then focus on the single supplier. Focus on the single supplier. If you don't focus on the simple supplier, if you do not focus on the simple supplier, guys, remember, you will never come to know exactly who has supplied you the wrong part of the material. Like for example, if I'm buying material, I'm manufacturing cloth, I'm manufacturing shirts, I'm using cloth. I'm buying cloth from 3 different suppliers. One of them, out of the total lot supplied by all 3, one of them supplies 10% inferior material. Now, first of all, it will be very difficult for me. Once the material is input, how would I know exactly who has supplied the wrong material? So, multiplicity of supplier will also be a problem. Too many cooks spoil the soup. You have heard that. So single supplier is important. Improve constantly, same thing. Then you have institute training on the job. Then you have training has to be provided. Institute leadership, drive out fear from employee. Now see, generally people are skeptical about giving them ideas, giving you ideas. People are skeptical about informing about something wrong which is happening in the organization. Make them feel fearless. Give them comfort. Assure them that their position will not be at stake if they reveal things. You will come to know the best thing. And any wrong thing that is happening in the organization, you will come to know about it. Break down the barriers between departments so that they will function in a coordinated manner. Eliminate slogan, harassing workforce without improving the processes they use is counterproductive. You can't harass, keep on demotivating employees. And secondly, eliminate management by objectives. Volume focused targets may lead to poorer quality. If you completely focus on profit, or early completion of syllabus, naturally quality will be lapsed. So all these are factors which are supposed to maintain the quality. And then finally, remove barriers to the pride of workmen, institute education and self-improvement, and then transformation of everyone's job. So if you put the same pressure on each and every department of yours, you don't need a separate quality control department to verify your work. If every department or division is identified, that means the lapse of quality, the reason for lapse of quality can also be identified. PDCA cycle. PDCL cycle means, see, it's called Deming wheel. Okay. It says plan, implement. So plan, implement, check. If everything is good, fine. Otherwise, take remedial action. So basically, it is PDCA: plan, do, check, act. Plan, do, check, act. So keep on repeating this. Your continuous development, continuous improvement can be implemented successfully. What is a criticism? Too much of documentation. Since you are involving the entire organization, there is a too much of documentation. Inability to measure the outcome, since the quality has got no measure. You can't say no 50%, 50 kgs of wastage. You can say that, but 50 kgs of quality has gone down. You can't measure that in terms. There is no parameter. The emphasis on quality assurance rather than improvement. The focus is on maintaining the quality rather than improving the quality. I am teaching, students are understanding, okay, I am maintaining the quality, that's fine. But you should go one step ahead. If ICI solutions are difficult, you should give simple solutions to the customer, systematize your subject, systematize your lecture. That is improvement of quality. But then total quality management focuses only on quality assurance. Students are understanding, that's it. It won't focus on giving the better services to students or completing syllabus in a better manner. Internal focus is at odds with the alleged customer orientation and not suitable for service industries. Why it is not suitable for service industries? Service industries, when you talk about service industries, the requirement of customer may change for each and every service. It doesn't happen in case of product, right? If you want to buy a shirt, you will go and you will buy a shirt. You don't have a choice there. Otherwise, you don't go for it. But if it is a service industry, every customer will need different service, and every customer will ask for a different service, and that has to be rendered in a different manner. So you can't set the parameter, since the outcome is changing, you can't set a parameter for quality. That is a criticism of TQM. Now, business excellence model. Basically, it is a philosophy towards development and strengthening the management, or rather management systems and processes within the organization. What for? Improving performance and creating value for stakeholders. Creating value for stakeholder. Now, who the hell is stakeholder? Stakeholder is not shareholders only. Stakeholder means all those people who are associated with the company. It will include of course, investors, shareholders, but it will also include employees, it will also include customers, it will also include suppliers, and plus it is also extended to a society. So basically your focus is to satisfy all these people, your customer, your employees, your society, your supplier, everyone should be happy. So there are 5 basic different business model. Out of that, Australian is required mainly for service industry. Generally they ask questions on European foundation of for quality management, EFQM model. EFQM model. It is European foundation for quality management. The model provides an all-round view of the organization, and it can be used to determine how different methods fit together and complement each other. It can help the company understand the cause and effect relationship between what their organization does and the result that they occur. So basically you are looking out for the nexus between input and output. Three things. One is fundamental. In case of fundamental, your thought process is very clear, adding value to the customer, creating sustainable future. So customers' happiness, future. When you secure your future, your employees, your supplier, everyone who is dependent on your company is safeguarded. Like Tata and Reliance must survive in India because they are creating so much of job opportunities. Developing organizational capability. Harnessing, basically it is about creativity and innovation, leading with vision, inspiration and integrity, managing with agility. Agility means your capacity to identify. Agility means your capacity to identify and respond to opportunities and threats. Agility means your capability of identifying and effectively responding towards opportunities and threats. If you ignore opportunities or if you ignore threat, in both the cases you are at a losing side, at a losing end. Succeeding through the talent of the people, use right person for the right task. Don't force people to do something which they are not supposed to, with which they are not comfortable with. You can't ask Virat Kohli to bowl, right? So go as per the strength and weaknesses and the talent and expertise of the people around you, sustaining the results. If you can't do the better result, at least sustain it. It should not go down. And then you have a conceptual framework. As I said, there are 3 people involved. One is 3 areas involved. One is people around the organization, then the strategy that you make to give the best quality assurance, and for that you will have to get connected to several resources, some partnerships. For that you will have to review all your processes, techniques, technologies, products, services, equipments, everything. When this is taken care of, your people around you will be happy, your customer will be happy because they are getting good quality product, your workers will be happy because they are getting work, sometimes even bonus, your investor will be happy because they are getting profit, so dividend will be high, your supplier will also be happy because he is getting a regular supply, he is getting a regular business from you. Then you have customer results, your customer will be happy, plus society results. If you are setting up a plant where 50 people can be accommodated, basically indirectly you are supporting 50 families. So that will be collectively called as a business result. So that was your economic model. Now, theory of constraints and throughput accounting can be asked as a practical question because it is more of key factor types. So, whenever there is a constraint, whenever there is a key factor which is limited in supply, whenever there is any resource which is limited in supply, it will be called as a key factor. And if there is a key factor, if there exists any key factor, all your decisions will be completely taken on the basis of that key factor. So, basically for that you just need to find out how much is the amount generated per unit of key factor. Like for example, if you are running short of time, find out how much is contribution or profit per minute or per hour. If you have invested a lot in the business, then that means your amount is blocked there. So even opportunity cost is required to be taken into consideration, and plus there will be operating cost which is incurred on a daily basis. So throughput is contribution per unit of key factor, that means contribution per hour. It can even be contribution per kg if material is a key factor. Minimize your investment and decreasing operating investment, that is a common sense. Because see, if I have 10 hours, my 10 hours will be used in such a manner that every hour utilized by me will give me more and more and more benefit. So I'm not interested in knowing how much is my revenue per unit. I'm interested in knowing how much is my revenue per hour. So if I'm dealing with 3 types of products, A, B and C. If I'm dealing with 3 types of product, A, B and C, the revenue per unit is 10, 15 and 9. The revenue per unit is 10, 15 and 9. I would say, okay, this is first, this is second, this is third. But this is per unit. I'm not interested in per unit. If I calculate on per hour basis, suppose, currently the ranking is this. It takes 1 minute to produce this, it takes 3 minutes to produce this, it takes 5 minutes to produce this, or rather 3 minutes. 1 minute, 3 minute, 3 minute. So 1 minute you work, you produce 1 unit, that gives you 10. So ideally your revenue per unit is per minute. Revenue per minute is 10. 3 minutes you work and you produce 1 unit which is giving you 15. So you're earning 5 per minute, and here you're earning 3 per minute. So ideally A should be given the first priority, B should be given the second priority, and C will be given the third priority. So look at this. As per contribution, as per revenue per unit, I was focusing on B first and then A. But when I realize I have a limiting factor called as time, my time will be used in such a manner that my highly profitable product per minute will be produced first, will be given the first rank. That is your throughput accounting. Kindly see the questions which we have solved in this textbook. Nothing else is required to be done. Nothing else is required to be done. This is all the same question that we have solved. Correct? And now supply chain management. Supply chain management. Basically, it is integration of key business processes from A to Z. From A to Z, everything will be covered here. In that case, you have push model. Push model means you throw your product into the market and wait for the customer to come. And pull model means wait for the customer to place an order and then produce goods. Around 5-6 years back or 10 years back, cars were getting produced in this manner. Produce, dump, let customer buy it. But then there was so much of carrying cost involved because all products were not sold immediately. Then at the year end, you will have to sell them at a lesser price because the manufacturing date gets older. You produce a car in the month of Jan 2023. Now, it is, since the quantity is so huge and demand is so less, you have 15 cars lying in your warehouse. Even in the month of November, you'll have to sell them at a cheap rate, at a discounted rate. That means there is a storage cost involved. There is a blockage of fund. Your opportunity cost is also exist because you have invested your funds in those cars, those units. Plus, at the same time, you also have to bear with loss of profit because you are reducing the selling price. When you consider all these things, push approach is not important. Pull approach is much more advisable. Let the customer place an order. Let him pay 15,000, 20,000 on booking. Then I'll start producing the car, and car will be delivered. So, push approach is this way, pull approach is this way. Clear? Now, customer account profitability, customer lifetime value, and gain sharing agreement. This can be used, and service level agreement. These four can be used as short notes. We will discuss one by one. What is customer account profitability? Okay, this means everyone knows how to calculate profit, revenue minus cost. But then you know how to find out profit, but you don't know the source of the profit. So, total sales minus total cost will give you total profit earned by the company, but then it is important for us to know the product that is giving me profit. It is important for us to know the division which is giving me more profit, or it can even be the customer base that is giving me more profit. Like if I give you example of iPhone 14 or iPhone 15, whenever they launch a new product, they have a specific age group targeted. When you are launching a laptop, if it is a general laptop, then if it is a gaming laptop with high graphics and all, you know the end target is different. You should have customer wise profitability. This is what we have done in profitability analysis also. So, analyze your customer base, identify your customer base, split that into various segments, north, east, south, west, or it can be west zone, east zone. It can also be male, female. It can also be age group wise, and analyze the profitability. So, analyze annual revenue segment wise, analyze cost, identify quality customers, and re-engineer. Like this happens, you must have seen this when you go to a regular restaurant where you have been quite often. They give you a different treatment, they give you a different service because you have a repeat value. So, see, platinum customer, gold customer, iron customer, lead customer. You classify them. When you have a business, you know your customers, those who come frequently, almost thrice a week, 4 times a week, they may given as platinum customers. Gold customers will be probably twice a week. Iron customers is once in a month. And lead customers means who come, they create a chaos, they misbehave, they can be blacklisted. You don't want such people to come. So, you categorize them, accordingly you can treat them. Customer lifeline value is a present value of the net profit which we derive over a period of lifetime of the customer. Like why do we get better services when the restaurant owner realizes that we are having the food regularly? Even if you go to a roadside bhel wala, roadside pav bhaji wala, roadside vada wala, they will treat you properly because they know that they have to take care of you because they can see the revenue that is going to get generated over a period of next 5 years, 10 years down the line. So the treatment given to you will be different. So customer lifetime value is a present value of the net profit that will be generated from the lifetime relationship with that customer. You may be given loyalty bonus, you may be given additional perquisites, not perquisite, but additional benefits. If you are buying a car, if you are regularly buying the car from the same manufacturer, you have given him more customers, you have given some references, probably he will give you accessory worth 10,000 free of cost, because ultimately you are helping his business. Then you have service level agreement. It's an agreement between customer and a service provider, legally binding, and can even be informal contract. It is basically documentation of all the components and service to be provided and the penalties if nothing is changed. It's like, what exactly are you going to do? What exactly the customer is supposed to do, what exactly a service provider is supposed to do, how much customer is supposed to pay, what services will be given by service provider. Like when you go for any gym, they give you a list. When you join a coaching class, they give you a list: teaching, test series, counseling, paper solving, whatever. So that is service level agreement. And gain sharing agreement means agreement between two parties without knowing the benefit. It is an agreement between service provider and service user, where they agree to share future gains. If there is no gain, that's fine. If there is a gain, they will share it. So instead of any payment received on the basis of benefits emerged to customer as a result of successful completion of the supplier side to bargain. So when you complete the deal, if there is a profit, it will be shared. So without even knowing how much you will be getting, you will work hard, you will give your best to complete the task, and then you can ask for the profitability. It's a win-win situation for both, no? The customer will also not have, will also have no risk to pay you despite of losses, and the supplier also has motivation to give his best, because if he doesn't, he will only lose his time and resources, because he will not be paid anything. Then there is one more concept called as outsourcing, which can also be used for short notes. Now see, they can always ask you a practical question. Just do not go for anything other than this textbook. Just do not go for anything other than this textbook. Even if you do this textbook, that is enough, because nothing is enough actually. Even if you take a different textbook of a different author, still whatever will be asked in the examination, that can be different from this. So you need to know the concept very well so that you can implement it anywhere on any question. Outsourcing, it's a practice whereby you shift your task, operation, job to another party for a certain span of time. The biggest disadvantage of outsourcing is you leak your information, you give your technical know-how to others, and if he comes to know how to give the better service and he comes to know how to produce the product in a much improved quality manner, he may start his own product line by putting you out of it. Losing of control over outsourced operations. Now, if it is outsourced, you don't have a control over it. You come to me for filing your income tax return. I outsource that work to my friend, and if he does some mistake, I don't have a control over it. But ultimately, responsibility will be mine because you have come to me. Quality at stake, because whatever quality I can give, I'm not sure the other person will also give you the same quality. Then ethical consideration, he may leak the information to my competitor. He may have inexperienced worker which may lapse the quality. Advantage is you save cost, you save time, your blockage, your working capital is not blocked. You have a flexibility, you outsource your work and you can spend time on strategic decisions, focus on core business. Since you have outsourced the work, you have a lot of time at your disposal to focus on the core strategies of the business. So that was your outsourcing part. Now solve all the questions which are given in this chapter in the JKSC material. There is no need to do anything else. So that was your modern business environment chapter. See you in the next one. The next chapter is lean system and innovation. Pretty important chapter. I will rate even this as important. And this is important from theory as well as practical, both point of view. See, lean system means system that minimizes your wastage. So you need to understand what are the different types of wastages. You have these wastages in terms of transportation, in terms of inventory, excessive stock, waiting time, motion, unnecessary transportation of material within the process, within the department, over processing of certain materials which may lapse the quality, which will take more time. Your labor cost, your electricity, variable overheads will also be high. Overproduction will lead to overstocking, your carrying cost will be high, and defects. Now, if you want to overcome all these things, you have to go for an organized method for waste minimization without sacrificing the quality of the product, productivity of the system. It basically, it is totally a opposite of traditional production. Traditional production is focuses on mass production, batch processing and all that. We basically focus on segment wise production, different types of operations which are conducted adjacent to each other in a continuous flow. We don't go for mass production only. I'll explain it to you. The first concept is just in time. Just in time is a very important concept. Again, theory as well as practical both. What have we been taught at CA Inter? You order material at a reorder level. You place an order at reorder level, wait for some lead time, you will be delivered the material. So you are not ordering material when you need it. You are ordering material once your stock level reaches to a particular level. That means you have to maintain a certain amount of stock in your warehouse, which will cost you carrying cost. There is a blockage of funds, so there is an opportunity cost. There is a storage cost because stock will need insurance, stock will need some maintenance, refrigeration, control temperature. So that cost will be involved somehow. That cost will be incurred. Instead of that, you should go for just-in-time approach. Whenever you need the material, order will be placed, there will be a faster delivery and the material will be delivered faster. So no stock is to be maintained. But then, yes, the risk is high. For that, you need to have a tie-up with a supplier where you may carry on auditing process to verify the quality of the material. Make sure that only best quality material will be delivered to you. So my sorting time, my piling time, my returns will be minimized. Inspection of material, that will also, time involved in inspection of material will also be saved. So just-in-time production, just-in-time system will make sure that your stock is minimized. What are the basic features of just-in-time? Organize production in manufacturing sales, a grouping. You basically go for group-wise production process so that the material can be delivered properly. The materials move from one machine to another machine where various operations are performed in sequence. Output of 1 transfer to 2, then 3, then 4, then it can be connected through a conveyor belt also. That saves your time. Hire and retain workers who are multitasking. So they will be able to do many, they will be able to handle different variety of options or operations. Then apply TQM. When you implement total quality management, all your systems, all your segments, all your functions will be safeguarded in terms of quality. So there won't be a quality lapse, there won't be a wastage. Reducing setup time. The company can respond to the customer faster. Carefully selected suppliers, you select your suppliers carefully, which will be capable of delivering the high quality material on timely basis. So quality will be assured. So my sorting, piling, inspection work will be saved. Material purchased, directly put into the machine, my time is saved because I am paying little more, but that is saving my time. Benefit, or rather, what is the basic requirement for implementing JIT system? Keep the variety minimum. Supplier should be the trustworthy one. Good communication, you should be very clear about what you need, what you want. There should not be any confusion or ambiguity. Demand stability, if demand is stable, then only you will be able to supply things on a regular basis. Today you need something else, tomorrow you will need something else, in a third month you will need something else. That will not suffice the purpose. If he knows that you need some material X, Y, Z, he will be ready with the enough stock so that your demand will be fulfilled. Then total quality management, defect-free material. Defect-free material is the most important prerequisite. And then preventive maintenance. What is the impact of JIT? Waste cost, your wastage is minimized, your carrying cost is minimized, your overheads are minimized because your carrying cost goes down, and then your product price also can be minimized so that you can compete in the market to fight with the competitors. Now this JIT has one more important point from short note or even from practical question purpose, that is takt time. Takt time is the maximum time available to meet the demand of the customer. Find out how much time you have. Suppose you have 10 hours time and suppose you are supposed to produce 1 unit or 100 units. For each unit you have 0.10 hours, that means 6 minutes to complete the task. So takt time, it can be asked as a short note or for a small question as well. For just in time, you solve all the questions which are given in the JKSC material. Those questions will be more than enough. At least one will be asked. That's what my intuition says. Kaizen costing is also important. Basically, Kaizen costing focuses on frequent changes. Frequent changes and a continuous improvement. Frequent changes means improvement. So, continuous analysis, continuous improvement. So, basically, it focuses on evaluation of the system on a regular basis, recognizing need to improve, recognize those areas of improvement strategies, implementation of those strategies, and then evaluation, how far it has worked. This will eliminate your wastage of all kinds, whether it is production, whether it is assembly, whether it is admin, distribution, any sort of wastage will be eliminated, and the redundant work will also be taken care of. If you have some additional movement of material from one place to another, if you can keep the machines connected through a conveyor belt, that much time is saved, that much energy, that much fuel is saved, and so on. So even that is important from the theory point of view. The concept of 5S is the next important task. Seri, Seton, Seiso, Shiketsu, Sitsuke. Seri basically, see, it's 5S is basically a Japanese technology and which Japanese philosophy, which basically talks about how your workplace should be. How your workplace should be. Workplace organization method in simple terms. Now, Seri is sort. You should be very much sorted as far as your work is concerned. So, no clutter, no confusion. Everything should be in order. You can have an alphabetical order, you can have numbers, you can have data stored in terms of geographical location, whatever. But you should have that allocation. Shine, cleanliness, standardized system, implement the best standards, best strategy to be implemented, and sustain. Sustain means train your employees, keep on training them, give them importance about teamwork, increase their movement, increase their enlighten them, increase their knowledge, keep on training them, and let them do the work without being told. Give them awareness of they are not helping the organization, that they are helping themselves, because if the organization goes, even they will grow. So that can be implemented here. 5S. Total productive maintenance. Now, total productive maintenance is a part of total quality management, because total quality management is a macro concept which involves every single organization. It involves every single organization. Total quality management involves every single organization. Total quality management involves every single segment. One of them is total productive maintenance. It will be associated with maintaining and improving the integrity of production and quality system. The integrity of production and quality systems. This is done through machines, equipment, processes, and employees that add to the value of business organization. This concept was first introduced by Nippon and Toyota, both. It helps in keeping all equipments in top working condition. Basically, you should be ready with all your cylinders on. Phases of introduction: preparation, introduction, implementation, institutionalizing. What do you mean by that? Okay, you keep the plan ready. Start implementing it. Initiate with it. Give your employees, let your employees know about it. Let those people know about it who are getting affected because of it. And then you slowly implement it and then see the results. So, it is one of the areas where you consider, the improvement in terms of machines. So, total productive maintenance focuses only on the productivity part, which is one of the segments which are considered in total quality management. Next important is performance measurement. How do you do it? So, it is OEE, overall equipment effectiveness. Overall equipment effectiveness. How productively you can use the equipment and effectiveness. There are three things available. One is availability. 100 hours are available. Okay. Out of 2000 hours, out of say 100 hours, 90 hours can be worked for 10 hours, any which way I cannot work. So, availability is 90%. Then I have to see the performance. I would love to see the efficiency, because if 90 hours are given to you and you are giving me 100 hours work done, If 90 hours are allowed, you are giving me 100 hours work, that means you are what? More than 100% efficient. If I give you 90 hours, you complete the work of 81 hours into that, that means you are 90% efficient. So basically performance, when they talk about performance, means this is efficiency ratio. And efficiency ratio means standard hours upon actual hours into 100. And then quality, acceptance. 100 hours were available, 10 hours I must spend on lunch and all these things. So 90 hours are capable of being worked for. So 90% is availability time. 90 hours work was completed in 81 hours. So 90 hours work was completed in 81 hours. That means whatever the team should have produced in 90 hours was done in 81 hours. 90 upon 81 is 111.11% is efficiency. And whatever you produced in 111.11 or 10,000 units you produced, only 8,000 were accepted by the customer. So this is 80%. When you take the productive product of these three, when you multiply these three, you get OEE, overall equipment evaluation effectiveness. So remember, your performance ratio is efficiency ratio, it is always standard hours upon actual hours into 100. If it is volume, then it is actual quantity upon standard quantity into 100. These are efficiency ratio. And quality ratio is how much was produced, how much was accepted. There can be a question of 2 to 6 marks on the basis of this. Simply solve these questions from the textbook. That will be more than enough for you. Now, what are the different types of maintenance that we see? Breakdown maintenance, it's a restorative process. If there is a breakdown, things will be taken care of. Preventive means it provides a system, it works in such a manner that there is no breakdown only. Cleaning, maintaining, inspection, overhauling, oiling, retightening and all that. It will be implemented in such a manner that breakdown will never happen. So first one is restorative, second one is preventive. Third one is your routine maintenance and fourth one is autonomous maintenance. Which is a routine maintenance by the worker itself rather than waiting for technicians. Like you clean your machine, you check oil level, steam level by on your own. What we do with the car, we check the oil level, we check the steam level, we check the brake oil level and all that, we check the water level. This is a autonomous maintenance done by us. You don't need a mechanic for that. And that was your total preventive maintenance, total machine maintenance. Cellular manufacturing means arranging your machines in such a manner in this format that only one person or two people can take care of the whole production process on their own. All these machines will be connected. All these machines will be connected either through a conveyor belt or through a vehicle, so that the material of output of one becomes input of two. So machine number 1, machine number 2, machine number 3, machine number 4, machine number 5, machine number 6. Now this machine number 4 can be in other loop also. So 1, 2, some other process it will be 3, then 4, then 5. So common machines will be held together, like the printer that you use in your office is a common printer which is connected to all terminals. So sometimes we give command and we go for a printout and we get someone else's printout, and that guy says, oh wait, that is my printout. Okay, then you give it to him. So same machine is used by various jobs. if it is a common machine. Otherwise, there will be a separate process available. So, cellular manufacturing is about that, which saves your time, which saves your efforts, which saves your labor cost, since only 1 or 2 workers can handle, rather than putting 1 worker per machine. You can handle, 1 worker can handle the entire segment of more than 1 machines, which is called a cluster, or which is also known as a cell. So, that is also important from the theory perspective. Now, Six Sigma talks about quality improvement. Six Sigma talks about quality improvement. Quality improvement means it basically focused on 0 defects. This is what you are supposed to write. Your major focus is on customer satisfaction. Customer should be happy, so that the only option is maintaining quality, giving improvements, changing forms of your products, upgrading your products. If there is a breakdown, then restorative actions. Basically, there are 2 types. One is Damaik and the other one is Damadav. Damaik is used only for the existing business, where you go for a simple strategy. You define the problem, then you measure the requirement, then you analyze the process to determine root cause. You analyze the process to find out the root cause, then implement that action, and then finally you can control the system. But Damadav means you define, measure, analyze, and after that you have to design, because Damadav is used for the new project. Damaik is used for the existing one. Damaik is used for the existing system. Damaik is used for the existing system. If Damaik is used for the existing system, you need not design anything. You directly start implementing after analyzing. So, it is Damaik. Here, Damadav it is. So, once you analyze, you actually design the process to meet customer needs, and then V is verify the design and performance. That means the implementation and post implementation evaluation. If you see the difference, the distinguish point: existing, new product, reactive, proactive. You are setting up things for the new project. It increases the capability, it increases the capacity, because you already know you need better space. Then it reduces cycle time. Examples: production time per unit is reduced, reduce number of errors, improve search time for critical information. This is for existing system. For new, add a new service, create a real-time system. That means you create a system where you will get the data on a quickly basis. So, basically Damaik is for existing system, Damadav is for the new system, and that is why it is design, measure, define the problem, measure the problem, analyze the problem, implement it and control it, because you already have the system. But if it is a new organization or a new product or a new entity, define the problem, measure the problem, analyze the problem. You analyze it, but you don't have a system, no, because it's a new one. So, decide the system, design the system, and then verify the system. So that was your Damaik and Damadav for quality improvement. Nothing will be asked beyond this. Questions, of course, I have told you already. I have already told you. Questions are to be solved from JKC material only. Just have a glance on these questions. Trust me, you will be able to crack these questions. There won't be a task. And the last part is process innovation and business process reengineering. Process innovation. Process innovation is implementation of a new or significantly improved production and delivery method. The process of innovating new solutions could fall into one of these areas. Matlab better production process, better delivery process, better support services. Process innovation. Innovation. Implementation of a new and significantly improved production system, improved delivery system, improved support system. And business process reengineering means a radical, right from the scratch change in your organization, like which was implemented by ICICI Bank in 90s, core banking when they introduced. Then business process reengineering. Business process reengineering is a fundamental rethinking and redesign, radical redesign of business processes to achieve dramatic improvement in a critical contemporary measures of performance such as cost, quality, service and speed. Cost, quality, service and speed. Cost, quality, service and speed. If you control all four, all types of wastages can be eliminated. Fundamental rethinking is about your business requirement. Why are you doing things? Why do we do what we do? Or why do we do the way we do it? That is your fundamental rethinking. Radical redesign is changing the structure right from the scratch. Right from A to Z, there is a change. Right from A to Z. Then dramatic improvement is a complete change in certain elements like it is not a continuous, it is not about improvement in quality, it is basically incremental changes, not radical changes. You already have something, change a little bit. You introduce something, that is radical change, that is your radical redesigning. Dramatic improvements is incremental change, and end-to-end business processes will safeguard reengineering should be end-to-end business processes, like what your customer needs must be provided. Like if you are talking about customer's order, when you place an order on Amazon, your account is verified. When your account is verified, when there is no red flag, the order will be accepted. That is why the order will be accepted. That is why we always get a message, your order is accepted. Even on Zomato, you can see this. Your order is accepted, that means you are not blacklisted on their website. Once the order is accepted, things go ahead. When the order is accepted, things go ahead. You start, then they will check the payment strategy, your credit score, creditworthiness, everything will be checked. Credibility will be checked. Once it is right, they will verify the inventory. Okay, the customer is genuine. See the inventory. You have inventory. Okay. If not, order. keep the product ready, clean it, pack it, rebadge it and distribute. Now all these things can be taken care of as end-to-end business procedures. So basically lean system was towards minimizing the wastage or nullifying the wastage. So this topic is important from theory perspective, and to be very honest, more than theory, practical perspective is also there. On just in time, they may ask you a question, on OEE. There can be questions based on this, so kindly go through JKSC material. You are not supposed to do anything else. Everything is covered here. Past paper questions are also covered here. So please refer to only this part. You will be able to crack it. Thank you so much. The next topic is again important. Cost management techniques. All new recent developments in the field of cost and management accounting will be discussed here. Your traditional cost accounting system was based on cost control and cost reduction, whereby cost control was regulation of cost. You set standard by applying standard costing technique. You find out variances by comparing actual with standard. Or else you can follow even budgetary control, where you set budget, actual data is compared with the budgeted data and all variances are analyzed. That was your cost control, but that required continuous comparison of actual with standard or budget. So eventually you should have an effective cost accounting system to provide the relevant information, because if you get a wrong information, wrong variances will be calculated, and that will not be able to give you the truth or the actual information. Cost reduction is permanent reduction in cost without impairment in quality, without impairing the quality. So cost reduction, when we talk about, it is reduction in cost, all types of cost, whichever cost you can bring down without affecting the quality, that is called as cost reduction. Now, in which areas your cost reduction can work? It can work in terms of product design. Your product can be designed in such a manner that the operational time can be reduced, or you can say the productivity or the efficiency of workers can be increased, so that instead of taking X number of hours, they will take X minus something. So time will be saved. If time saved, that means during the same time they will be able to produce more. Then you can also think of standardizing and simplifying the procedure, so that there will not be any time wasted in thinking or planning or something. It will be sheer implementation. It can also be spread towards the entire organization. There are sometimes it happens that you cannot alter your production cost. Your material quality cannot be impaired. Your workers' skill cannot be compromised. So if you cannot control your production cost, you still have an option of controlling or reducing your admin cost. If you cannot reduce your production cost, you can always reduce admin cost. All futile expenses of admin department can be reduced. Those who are traveling in first class in flight, they will travel with business class. Those who are traveling in business class will travel by economy. Those who are traveling in economy will travel by train. Those who are traveling in train will travel by bus. Those who are traveling in bus will sit at home and attend meeting through Zoom. I can actually save a huge amount of cost structure because of this. So entire organization, all functions, all responsibility, all divisions, everywhere, wherever it is possible, the implementation can be done. The cost reduction technique can be implemented. You can also implement it to factory. You can also implement it to production plan. Production plan, when I talk about, implement your lean system, reduce wastages of all possible kinds, and all can be done with the help of value analysis. You analyze the entire business structure. Then you go for just in time, which will save your cost plus carrying cost, overheads. Kaizen costing, continuous improvement, business process reengineering. Also, we have seen the radical change in the business system. Target costing is something which is important. Target costing means, see, we were told, you take material cost, take labor cost, other expenses, you take total, that is total cost per unit. You add your required profit figure and then you decide your selling price. Do you think your customer is waiting for your product to be launched in the market? Oh wow, you finally launched the product, lovely, I'm going to buy your product now. No, it doesn't happen that way. Whenever you're launching your product, you will be fighting with the existing competitors in the market. Why would a customer look at you? So you find out you compare all the products and you realize that all these products are on an average charging 1000 rupees. So you want to keep the selling price of your product to be 800. You want to keep selling price of your product to be 800. Now, if you want to keep your selling price to the extent of 1800, you already know you want 25% profit out of it. That means you will have to restrict your cost at 600 per unit. So from target selling price, when you remove your target profit figure, you get target cost. This is what practically is done. So basically it is a structured approach. Basically it is a structured approach which determines the desired level of cost structure. Because you cannot change the selling price, you cannot change the profit. So you have to restrict your cost structure at, in my example, 600 per unit. If your cost is more, 620 per unit, you apply cost reduction technique, bring it down to 600. If it is already less, enjoy the benefit. This is your target costing. So traditional costing was this way. We discussed this: product specification, design, then estimated cost, profit, selling price, which is practically not possible. So you find out, you complete the product specification, find out at what price it can be sold, what profit you want, find out the cost, and then go for design accordingly. So your product design will be the last stage of target costing. Advantages: proactive approach, then top to bottom commitment to the process and product innovation. Since your design is the last stage, you still have a chance to actually bring down the cost structure. Target costing starts with the customer study and market study. That means you are actually working on some authentic data, so the chances of mistakes are very less. It also ensures proper planning. It also ensures that it also enhances your employees' awareness and empowerment, because they are trained to bring down the cost structure by increasing their efficiency and productivity. As far as target costing is concerned, they may ask you a few questions based on target costing. But how do we set the design, which is the last stage of target costing? For that, you need to do value analysis and value engineering. Value analysis is planned specific approach to cost reduction, which reviews the important composition of the product and the production design, so that modification and improvement can be made which do not reduce the value of the product to the customer and the end user. Value analysis means basically each activity and component of the process is analyzed, and non-value added items are to be eliminated, removed. So you understand the system very well, you go through the system very well. If you can't find out the system properly, if you find some items are redundant, they can be replaced, then please do that. So that your cost will be minimized. And value engineering means the moment you realize which is a value added and non-value added items, you have to rearrange those resources. So it is application of your value analysis to the new product. So value analysis is evaluation of the entire system, find out which is value added, which is non-value added. Non-value added is eliminated. If non-value added is eliminated, you are left with only value added. And now rearrange those value added systems in this part. The process involved in value analysis and value engineering is similar, except that value engineering applies to new product. Of course, value engineering is applicable to new products, while value analysis is for the existing product. Obviously, if you are studying the system, that means system has to be there in existence. So value analysis Value analysis, existing product. Value engineering can be for the new product. Then you must also study the next part. What are the problems of target costing? It's a lengthy process. Huge amount of cost is involved in terms of, because see, when huge amount of cost structure is required to be reduced, because now you have been given a target to control your cost structure at 600 per unit. Now certain cost structures are to be reduced, then there will be a finger pointing. Your employees may feel, I was traveling in a plane, now they are sending me through train. So that is also a demotivating factor in many areas. Then representative of from number of departments on the design team can sometimes make it more difficult to reach consensus. Too many people associated with design from so many different departments, things can be really confusing, things can be really time taking, because all these people will take a huge time to get adjusted or get agreed on one particular point. Effective implementation requires development of detailed cost data. Now detailed cost data may not be available easily, so that will again be a costly affair. It may also reduce quality of the products, because your focus is on restricting the cost structure at 600 per unit. If you are restricting your cost structure at 600 per unit, that means basically you may take a call of sacrificing or impairing the quality. Now, what is the role of a management accountant in target costing? Management accountant will be playing a vital role in designing the system, generating cost, applying capital budgeting techniques to find out the feasibility of these activities. Management accountant should work with the design team to help to understand the nature of various costs and the cost benefit trade-offs. You can't simply eliminate the cost just because you feel it is non-value added. There can be some reason behind implementing certain things. In addition, the management accountant is responsible for tracking the gap between current cost and the target cost, which is team design's goal. So he should be very clear in terms of the reduction. You simply say reduce the cost, but you don't give the target. Then this information, this instruction can be misleading. You can always tell them to bring down your cost by 20%. I want 20% down. That gives them hint. You tell them the areas where you want to minimize the cost, otherwise they will sacrifice the quality. And finally, management accountant must continue to compare a product actual cost to the target cost on a regular basis, so that any variation can be found out. Target costing can be useful. Majority of the product costs are locked in during the product design stage. Thus, target costing is difficult to be applied for service industry. It is difficult but not impossible. Assembly-oriented industries, where you can actually have number of workers working for you. You can change the process, you can reduce the number of workers. Companies involved heavily with the diversification of product lines, use technologies of factory automation, including computer-aided design, flexible manufacturing systems, and office automation and computer-aided manufacturing. So basically, all sort of manufacturing industries can be used, can be using target costing system. Steps is again an important part. Create a project charter. Project charter, it's a document. Project charter is a document approved by senior management. So basically, it's a draft, approved draft. To do, not to do and don't, do's and don'ts we call it as. uh, it's like a rule book, basically bylaws sort of thing. It can actually help you out as a guidance. Then obtain a management sponsor, support from management. Then you have to go for a budget. The team manager who can manage things. Then you need full-time participants who can actually do the work and use different production management tools like variance calculation, database, different types of databases, Microsoft project to get things implemented. So target costing is one thing which you should be targeting on. Solve all questions of target costing and go. Again, I am telling you, this is more than enough. Whatever we have done, it is more than enough. Life cycle costing analysis. Your product has 4 life cycles: growth, introduction, growth, maturity, decline. At each stage, your cost structure is different. At each stage, your cost structure is different. Introduction is a stage where you have just launched the product. Introduction is such where you have just launched the product. As a product, since it is new, people are not aware of it. Probably you might be going for penetration pricing by keeping the price minimum. So your profitability can also be less. You don't have initial competition because nobody is taking you seriously. So people are not only taking, people are not even taking note of you. So profitability is less, competition is very less. But then when you see the introduction phase, you'll have to think about branding, packaging, labeling, high promotional cost, heavy research and development cost, profits are minimized, pricing is going up. You have to keep the selling, pricing about material and all may go up, but you can't increase the selling price because you have opted for penetration pricing. If you're going for skimming pricing, still, if you're going for skimming pricing, a huge price, you can, if the selling price is too high to recover your huge R&D and promotional cost, then in that case, your volume may go down. Then you have major focus on those buyers who are most ready to buy. You're not actually creating a market. How? Attract customer by giving discounts or promotional activities. Run after the customer to buy your product. Chew their brain, literally, by sending salesmen, by bombarding advertisements. Strengthening and expanding your distribution channel so that once the demand is high, you should be having enough bandwidth to fix up things. Setting price is alignment with the competitive realities in the market. Second one is growth. Now, growth is rise in sales. Competitors know you. The competition starts. High volume of business and increase in competition. Sales increase at increased rate. You will get a chance to increase the selling price also. Promotional spending can be more or it can be even slightly higher because the competitors have entered into the market. Educating market is your main goal. You don't want your customer to get shifted to your competitor's product, newly developed competitor. Third stage is maturity stage. You grow, but at a decreasing rate. You are growing, but at a decreasing rate. That means your sales are declining. The amount is more, but the percentage is less. Percentage rise is less. overcapacity in the industry, too many competitors available, too much of supply is available. Customers is getting shifted towards other products, strong marketing challenges. Plus, since you want to sustain in the market, you'll have to undergo changes, you'll have to update your product. So, heavy research and development cost. How will you tackle this? Heavy marketing to win, to beat the competition. Regular improvement, reduce some prices. Different sales promotions basically keep the customer attracted. Distribution becomes more intensive and incentives may be offered to encourage product over competing products. Distribution becomes more intensive and incentives may be offered to encourage product over competing products. You'll have to go for a higher commission because otherwise your distributors may pick up your competitor's brand. And decline is when your sales volume is going down. Till the time it reaches down to a particular level, you'll continue. After that, you won't wait, of course, till your demand goes down to zero. Someday you will stop. No, there is no strategy as such. Just keep low, go for made to order production. If the customer orders, you will produce. If they don't, you won't produce. That is your product life cycle. Okay, how do we use this in the lifespan of the product? It can be a planning stage. Your stage changes, your requirement changes. It can be a control tool. You know how much you want to achieve and how much you have achieved. You can always find out variation. It can also help you out in terms of forecasting because you anticipate sales accordingly. You anticipate your cost accordingly because you know the phase. Like when it is a growth phase, when it is a maturity phase, I know my research and development cost will be more because I need to keep on updating my product so that my maturity stage is prolonged. And then finally, appropriate strategy formulation since you know all stages. All these things, see, you already have these questions available. There is no point in wasting that. I am simply discussing the theory so that your concept will be revised. Questions and answers you already have in the textbook. You can always study that. You can always study that and get things done. Okay, there is no time to revise all questions here. I am just revising all important points so that the ideas will be refreshed in your mind, the concept will be revised in your mind, which you can implement for those questions and the solutions which are already there in the JKSC material. The next concept is Pareto analysis. Like Pareto analysis is like simply a teacher generally uses in the classroom. If there is a class of 100 students and if the teacher is facing control issues or if the teacher is facing discipline issues, you just need to do one thing. Just take action on one group of 3-4 people. Your other people are controlled. The kind of action you take on a group of 4 people will make other 96 understand what you are. This is simple Pareto analysis. It was realized by Pareto, an Italian economist, that 80% of the wealth, see, Wilfredo Pareto, he noticed that 80% of the wealth in the city Milan is owned by 20% of its citizens. So, you simply focus on 20%, 80% will be controlled by you. 80% will be controlled by you. Usefulness, prioritizing problems, quality improvement, customer relations, employee relations. See, if you select important, significant people, others will simply follow that and they will be just part of the system. Like if I satisfy all my senior faculties, my senior faculties only will be like laying down some example in front of the juniors. So I just need to take care of my 5 senior employees. Simple. others will also follow the same thing. They will realize that, okay, their efforts will be recognized. So, allocate physical and financial resources, that can also be one of the usefulness of Pareto analysis. How do we do this? Where can we apply this? Like for pricing, I have my 20% products contributing 80% of my total revenue. So, I will not play with those 20% products like Maruti. Maruti will never play with Alto. Maruti will never play with Swift, WagonR, Ertiga, because they're far more huge contributories of revenue. Okay, so 20% of my products are giving me 80% revenue. I will simply take care of those 20%. 80% of the revenue will be taken care of. Then you can apply this. 20% of my customer base is giving me 80% of my profit. Like CA Inter is the most lucrative. CA Inter is the most lucrative product for me. My 80% revenue comes from CA Inter. I will focus more on CA Inter, and I just simply implement those systems to other segments. Things are taken care of. If I take care of CA Inter, I can take care of other fields also. Then ABC analysis, class A, class B, class C, which you have done in stock control. Costliest material will be classified as a 7. All those different types of materials together contributing 70% of the cost structure will be classified A, and you should not have more than 10% quantity of that. Higher is the cost, lower should be the quantity. Lower is the cost, higher can be the quantity, because insignificant quantity loss of a costly material, insignificant quantity loss of a costly material can be sometimes more than a significant quantity loss of a cheaper material. Insignificant quantity loss of a costly material can be more than a significant quantity loss of a cheaper material. So, that is ABC analysis. This can be, Pareto can be used even in stock maintenance. You can use this in ABC analysis. You will focus on only those 20% cost drivers which will together contribute 80% of your total overheads. Even for quality, you can do this. So, Pareto analysis is again a very important concept. Many times questions have been asked on this. So, don't leave this chapter for option. My next concern, next important part is environmental management accounting. It is basically collection and analysis of the information relating to environmental cost for internal decision making. When I talk about environmental cost, it controls pricing, budgeting, investment appraisal and calculation of cost. It is basically focusing on the better use or the productive use or optimum use of resources along with environmental efficiency of the company. You can also implement this for cost saving. See, there are 4 basic types of cost involved. One is conventional cost. Conventional cost means that routine raw material, labor, fuel, factory overheads and all that. Hidden cost means your general overheads which can be directly attributable to the product, but these are general overheads which are clubbed together because they don't have a significant identification as such. Like factory overheads, when I say it includes rent, it includes depreciation on factory premises, it includes depreciation on machine, everything. So, I just need to take care of factory overheads. I am not going to look at each and every expense. So, these are hidden cost. Conventional cost means the directly identifiable cost like material, labor, direct expenses. If I am paying royalty on production, then that can be a conventional cost. Then you can have a contingent cost. Contingent cost, when I talk about, cost can be incurred on any future date. Like if there is something goes wrong with the pollution control device, and if suddenly there is a leakage of the contaminated water and all, then I have to undergo some cleaning process or probably penalties. All these cost structures which cannot be anticipated in advance will be called as contingent cost. And then finally I have relationship cost. Relationship cost means all cost in terms of intangible activities like reporting, certification and all that, licensing and all that. So two types of costs will be involved. One is to protect the environment, whereby I am going to prevent pollution, and second one is cost of wasted material, capital and labor. So it is an opportunity loss, inefficiencies in the production process, wastage. You can read this later. How will you go about it? Why are we supposed to control environmental cost? See, there are three main reasons why we implement environmental accounting. First one is carbon footprint. It measures the total greenhouse gas emission caused directly and indirectly by a person, organization. People are being very aware about carbon footprint and recycling. So carbon footprint is important. Carbon footprint is the calculation or quantifying the total pollution. Then environmental cost in terms of protection and restoration. And third one is regulation in increasing worldwide at a rapid pace with penalties, and non-compliance also increases accordingly. Regulation is increasing worldwide. So government intervention is there, rules and regulations are there. If you don't follow that, you can be penalized, plus your brand name will be at stake. So these are the three advantages of environmental accounting. For environmental accounting, this much is enough. Now you can simply read different areas of environmental accounting and simple classification. Again, the question that I have given, question number 16, you just go through this question. It already has the solution with it, plus you have my lecture also on the dashboard. You can see that. You will come to know how this is now, because one question takes 40-45 minutes. We don't have that much time. Okay, it's a last day revision, it's a quick revision. So I'm simply discussing all concepts. So basically in this chapter we discussed simple techniques. Cost control can be done through Pareto analysis. Then you also have environmental management accounting. You have cost reduction through target costing, value analysis, value engineering. You can also have cost reduction through life cycle costing. So this was the most important chapter from theory perspective as well as practical perspective as well. Do not leave any question from the textbook for this. So that was your cost management techniques chapter. Thank you so much, guys. And the next chapter is performance measurement and evaluation. So many things to be done. One by one we'll settle all theory concepts. Practically, as I told you, since this is a last day revision, revising concepts was important. Balance time you can use for solving those questions in the textbook. Our JKSC textbook volume 2 is enough for your exam. There is no need to do anything else. So how would you evaluate your profitability? For that you need to understand what is responsibility accounting. Responsibility accounting means Generally, you focus on profitability as a parameter of success. Responsibility accounting means collection, accumulation, summarizing all financial information for each manager or each division or each department. Either it can be function wise, it can be even product wise, it can be even customer wise. Like for example, you can have a functional organizational structure. Each function will be regarded as a separate responsibility center. You can have a divisional responsibility center where you can consider number of divisions separately. Types of responsibility centers. Types of responsibility centers. Cost center. Cost center means a department or a division or a person or a product where only cost is controlled. They do not have a right to decide their own selling price. They will be held responsible only for the cost. Revenue centers means they are supposed to collect only the revenue part. That's like, for example, you have electricity bill collection centers of Adani, of Tata Power, of MSEB. They don't have an authority to do anything else apart from receiving checks and cash. Profit center means an independent branch which is an independent center which can have its own revenue, its own cost structure. So profit is the parameter for evaluating such department. Investment centers means those responsibility center where the manager is responsible not only for revenue and cost, but he is also responsible for assets and liabilities also. So if it is a completely independent branch, it can be treated as investment center. How did you decide, or how do you decide the profitability? We'll first cover financial measures. It is ROI, return on investment. You take to your total revenue. Your profit is divided by total capital employed, and that percentage will be considered as a base. You may have residual income also as a base. Residual income in simple terms means contribution less than cost of capital charge. And when you consider this, only controllable cost is taken into consideration. Like for example, if I am a department, suppose I have 15 centers in a city and I am incurring 15 lakhs as advertisement cost in that city, then each center is bound to get 1 lakh rupees as cost. That 15 lakhs will be split into 15 centers. Each center will be charged 15 lakhs. Each center will be charged 15 lakhs. Each center will be charged 1 lakh. And accordingly 15 lakhs will be charged to the respective center. This cost is called as non-controllable cost. They will have to bear the benefit. They don't have an authority to accept it, to reject it. But controllable cost means individual cost of the individual department, like electricity cost of each department, staff salary of each department. That can be changed. That is within the control of the center in charge. But the advertisement cost, which is allocated by the head office among all 15 centers, is non-controllable cost. Such non-controllable cost is to be ignored when you consider residual income. It is contribution. It is basically contribution minus your cost of capital charge. Then this is important concept, economic value added. Economic value added means your net profit after tax. Economic value added means your net profit after tax. Net profit after tax, and you subtract weighted average cost of capital on capital employed. You subtract weighted average cost of capital. So basically you take the profit, and from profit you subtract the investment proportion. So basically, how do you get net profit after tax? You take profit, subtract tax, then you can also add, or you can also start with profit after tax and add back your net after tax effect of the interest charge, because when you pay interest, it is shown as an expense. If it is shown as an expense, by that amount your expenses increase, that means your cost goes up, that means your profit goes down. So profit goes down, that means there is a tax saving. So that part has to be removed here. Post-tax expenses to be considered. So you take net profit after tax, then you calculate weighted average in terms of dates and equity both. Weighted average in terms of dates and equity both. Take the weighted average rate, equity and date. Accordingly, it will be applied. Equity on equity, including reserves, and debt will be on the debt figure. When you do that, you will be getting the answer. Just simply go through questions solved by us. There is no need to do anything else. I am telling you since long. Shareholders value added. Shareholders value analysis is about evaluating the net present value of cash to shareholders. See, shareholders value added provides a framework of evaluating for improving shareholder value by determining the trade-offs between reinvesting in the existing. See, when you earn money, revenue, you can reinvest in the same business, you can invest in some other business, or else you can distribute it to your stakeholders, stockholders, shareholders by way of dividend. So how do you calculate? You take your future cash flows and simply apply cost of capital. So that was all financial matters which you can simply get through these questions. Important part is this. Social measures of performance evaluation. Triple bottom line is a concept where the evaluation of the business is done on the basis of environmental, social and economic factors. Environmental, what exactly are you doing with the resources? Are you using resources? Is this the optimum use? Is there any wastage? Is there any excess utilization, over utilization? Are you contributing anything towards the pollution by contaminating water or air? Everything will be classified here. Then comes the social. What exactly are you doing towards motivation or improvement of lifestyle to your workers? Then how much incentive are you giving their health, safety, the recreational facility, their upliftment in terms of knowledge? And then finally economic, by way of profit and all. So socially also, they may give you a question like this. Do this question, just simply revise this one question, you will understand what is triple bottom line and how it will be asked. They may give you a case study, they will ask you to classify what is economic, what is social, what is environmental. Something that is related to environment is environmental, of course. Something which is related to employees and society and betterment of a human being is social, and something which is talking about money and profitability is the economic factor. Apart from triple bottom line, you can also evaluate performance of a company or performance of a unit on the basis of critical success factors. Critical success factors are those factors. Critical success factors are those factors which will let you know what you want to achieve exactly. Basically, they are objectives which you are trying to achieve. So, it can be a profit, it can be well-being of employees, it can be recreation of employees. That depends on the department, that depends on the unit that you are discussing. Critical success factor represent the what are the things the company needs to do to achieve its goal. What exactly are you supposed to do is critical success factor, and whether you are achieving it, how you will achieve it, is your key performance indicator. So, critical success factor is what are you trying to achieve, and key performance indicator is how will you achieve. You want to clear CF final is critical success factor, and you are watching these lectures, you are studying hard, you have done 3 revisions, 4 revisions, that is your key performance indicator. You want to have a corpus of 5 crores at the age of 30 is a critical success factor, but your key performance indicator will be how much you are supposed to invest now by following the reverse direction. If you need 5 crores at the age of 30, with the simple amount of compounding interest at 10% CAGR, how much I should invest now? So, reverse calculation, that will give you how much monthly investment is to be made. That is your key performance indicator. Again, we can't waste time on the last day on solving those questions again. In practical chapters we have solved, because while solving those questions I completed the entire revision of the chapter. Like in standard costing, I solved first question where I discussed all variances including profit. Then in the same question I discussed marginal costing effect, then I also discussed key factor effect. So, one question, all the concepts were discussed. In decision making also I solved around 8 to 9 questions. I discussed all those questions because I wanted to discuss how to decide relevant material cost, how to decide relevant labor cost. But here, all these chapters, if you solve questions, if I solve question on the last day, you will not even get enough time to see the video. So, I am not wasting time in solving sums. I am giving you the basic clarity once again on the last day, so that you can sit back and solve those questions directly without going through the theory part. Only questions you are supposed to practice. Third one is balance scorecard. Now, balance scorecard means you evaluate your business in 4 different perspective. One is financial perspective. How do we look to shareholders? Whether they are finding us lucrative, whether they are not. Financial perspective. Then what do my customer think about me? Financial perspective, customer perspective, internal business perspective. Internal business perspective means at what we must excel. It's an internal development. It can be even training given to the workers. It can be even upgradation of workers. It can be even upliftment of the plant, anything. And finally, learning and growth perspective. How do we continue to improve and create value? That also includes employee training, enhancing employees' capabilities. So, internal business perspective means you identify processes and activities which are necessary to achieve, or non-value added activities are to be removed. Do value chain analysis, non-value added activities should be removed. You set the plan up, you set the infrastructure up, and then you can always enlighten your employees. You can change your systems and your organization procedures. Probably you may delegate a few work to your subordinates and get things done. So, financial perspective, customer perspective, internal business perspective. Customer, what do a customer needs? Timely delivery, quality of the product, best after sale service and best price. Are you satisfying it? Okay, yes, your company is fantastic. So financial perspective, customer perspective, internal business perspective, and learning and growth perspective. So that covers everything which can be applied through these questions. Just simply have a glance on these questions, you will understand how to write an answer. The common part is already discussed. 4 perspective you are supposed to write and then coincide with the question given to you. Here also they may give you a list of activities and they may ask you to classify that. That can also be done. Which one is financial perspective, which one is customer perspective, which one is internal perspective, which one is improvement perspective, last one. Performance pyramid, I feel it is important from the exam perspective and more of theory will be asked. See guys, your basic intention is your company should be strong from the external perspective. External effectiveness means from the customer's perspective, and internal effectiveness, that means from your own perspective. So if you really want to satisfy your customer, make sure that your quality is fantastic and your delivery is on time or even early. If you can ensure quality and timely delivery, your customer will be happy and your external effectiveness is achieved. As far as internal effectiveness is concerned, reduce cycle time. Cycle time means time required to produce one unit. If I reduce that, in the same span of time, I can produce more number of units now. More number of units will be sold, or more number of units will be available. Like for example, if I give you example now Maruti Ertiga, Suzuki Ertiga, Suzuki XL6, almost all cars, Etios or rather Innova High Cross, they have one year waiting. If they reduce cycle time, probably that waiting can come down to 8 months. Now, if the waiting comes down to 8 months, if the delivery is faster, you will retain your customer. So, quality and delivery is for external effectiveness, cycle time and minimum wastage will be internal effectiveness. Now, quality and delivery will give you customer satisfaction, cycle time and wastage will give you productivity and flexibility. Since see, if your customer is happy with you, you get little leverage in terms of after sales service and all that. People don't take it, people don't be harsh to you because they know if something is going wrong, that there has to be some reason. Because of some reason it must have happened this way. There is a benefit of doubt. So basically you are covering, you are taking care of market as well as all financial matters, which is your ultimate corporate vision. Corporate vision is the success. So success can be done in 2 ways. One is financial, one is market. Market needs customer to be happy and financial needs yourself to be cost effective. Okay, so if you want to satisfy the customer, focus on quality and delivery. If you want to improve yourself, internal effectiveness, if you are talking about, reduce your production time per unit and minimize your wastage. That's your performance pyramid. Now, building block model, it is basically a solution of performance measurement problem in service industries. See, you have to remember this chart. You simply draw this chart in the examination and just explain it. For any business, you have to set a standard first. You decide what exactly your employees, your staff, your value chain is supposed to achieve. There should be equity. The standard should be equal to all. It should not happen that you are giving a stiff target to some person and some rigid target and some easy target to some other person. So it has to be equal. Equality has to be maintained. Secondly, it must be achievable. Something which cannot be done practically should not be given as a standard. And secondly, the target should be such that they should be held responsible for that. Something which is uncontrollable can't be charged to them. Now, you can't actually ask them to produce some product which is currently banned in India. Now, they cannot change it, right? So, it's beyond their capabilities. So, it should be equal, it should be achievable and it should be controllable by them. The moment you set a standard, you basically be ready with the reward. Boss, if you achieve this, I will pay you this. I will give you bonus. I will give you increment. I will give you a promotion. Motivational. Motivation should be very clear. There should be absolutely clarity. You do it. We'll see what is to be done. We'll do something nice for you. There has to be a clarity. You give me this, I'll give you this. You give me this, I'll give you this. It is very clear. And of course, the controllability factor has to be considered. Now, when a business flourishes, basically are looking out for 4 determinants. One is quality, which cannot be sacrificed, which will prolong your success in the market. Then you should have flexibility. You can't be rigid in terms of demands. If the customer is asking you something else, you can't simply go by rigidity. No, we are closed from 1 to 4 o'clock, you come after 4 o'clock. No, we can't do that. If you want to sustain the competition, you can't do that. Then you will have to keep on doing research, updating yourself in terms of system, updating yourself in terms of infrastructure, updating yourself in terms of processes which you implement for production, update yourself in terms of sometimes even goals. So that needs innovation. Different techniques. You should be dynamic enough. You should be dynamic enough to accept the new change that is prevailing in the market. You can't keep on playing your own record. When the market is changing, you will be out of the market. So, the last one is resource utilization. You have to utilize your resources in such a manner that your maximum profitable resource will be utilized to the fullest extent, so that there is no wastage and there is no idle resource. So, how would you evaluate everything? On the basis of results, and results will be analyzed on the basis of financial performance as well as what is happening with the competition. If the competition is going down, that means you are doing well. If your profits are increasing, you are doing well, and vice versa. So, that is your building block model, which is basically a measure of performance evaluation, which you can write clearly by explaining that table. I don't anticipate such a lengthy question there, but then theory they can definitely ask you. So, whenever they ask about building block model, remember, whenever they ask about building block model, use standard, rewards, determinants and result. You write down the chart, those balloons, those clouds, you explain that, you draw that, you explain that, and then connect your question with it, and you will be getting the solution very quickly. Performance prism. Now, when you talk about balanced scorecard, it focuses on shareholders and customers. It focuses on shareholders and customers, but performance pyramid concentrates on customers as well as shareholders. That is fine, but it also focuses on other stakeholders, like for example, stakeholder satisfaction is important, right from supplier, manufacturer, workers, employees, distributors, suppliers, customers, everything will be taken care of. Select your strategies accordingly, so that every stakeholder's need will be fulfilled. Similarly, some processes will also be developed in the same manner, then capabilities and stakeholders' contribution. So, performance prism may be asked only for theory, nothing else. Now, what are the advantages of performance measures? It develops agreed measures of activity. So, same measures can be utilized by all, so that there will be a parity in terms of comparison. If I am considering ROI of one company and residual income of the other company, I cannot compare them. They have to be at par. Then it also clarifies the objectives of the organization. Greater understanding of the process. Since you are going for value engineering, you will have better understanding of the process. Then you can compare and evaluate divisions. Then you can promote accountability to stakeholders. You can promote accountability to the stakeholders. Since you are taking care of customers, suppliers, employees and everyone, it will definitely help you out in promoting the accountability to stakeholders. Helps in setting target for managers, and helps to facilitate comparison between different organizations. As I told you, it will create a base of parity. So, like accounting standards, why they were developed? Because all financial statements of all the companies will be presented in the same manner. So, it gives you a complete understanding, and it makes you very comfortable to have a comparison. But what are the drawbacks of performance measure? Tunnel vision, that means you only focus on some of the key performance, not all. You can't have a performance evaluation on the basis of all parameters. Some parameters have to be focused on, prioritize, and some parameters have to be ignored. Sub-optimization. Now, if you focus only on financial targets, then the outcome will be different. If you focus on non-financial target, your outcome is different. Like if I consider profitability as a base, probably my customer satisfaction will not be taken care of. Myopia means too much of focus on short-term measures at the cost of long-term impact. Taking short-term techniques, shortcuts to fulfill the requirement. So, rather than taking the remedial action, rather than changing the system, the faulty system radically, you opt for some petty adjustment, some short-term adjustment. So, that is giving you short-term result, but definitely in the long run it is going to affect you. Misrepresentation, misinterpretation. If you don't understand the data and the results, if you are not experienced enough to understand the hint given by the data and the direction or the percentages, it will be again of no use. And finally, ossification. Ossification is something which can be used where basically you are using some outdated techniques. Ossification means something where you are using some outdated technique, some old techniques of comparison or evaluation. So, these are the drawbacks of performance evaluation. And finally, benchmarking. Benchmarking is again focusing on continuous improvement. Comparing firms, products, services, activities with the best in the industry. So, you are not doing it you are not comparing your performance with your own budgeted performance, you are comparing your performance with the best in the company. If I am having market share of 20%, how much number one has? He has 50, okay, I have 30, okay. That's how you evaluate yourself. Now, that is called competitive benchmarking. Strategic benchmarking means you compare only the strategic part about products, about core competency of the product. Global benchmarking means it is through distinction in the international culture. So, you may compare your data with some international data where the culture is different, the structure is different, but still you will be able to get where you lack. Or you may realize that you can implement the foreign technology or the foreign know-how, imported know-how for better services, for better performance. Then you can have process benchmarking. Only processes of the two, production process of company A, production process of company B, distribution process of company A, distribution process of company B. I will not compare both. I will compare only the process. And functional benchmarking means function to function marking. Instead of process, you will focus only on functions. Then internal benchmarking, two business units of the same organization. One is in Patna, the other one is in Ranchi. Compare. One is in Delhi, the other one is in Ahmedabad. Compare. External benchmarking means outside the organization comparison. Then you may have intra-group. Intra-group means similar services are rendered by the benchmark company. Inter-industry means comparing motor car industry with electrical fittings industry. Comparing coaching class industry with marketing industry, manufacturing industry. Inter-industry. Now, there is a code of conduct required. First of all, legality. It has to be done in a legal manner. If I am taking some information from you, I am supposed to give you my information. If I'm getting your information, it will not be leaked anywhere. It will not be used for any reason other than the benchmarking and the performance evaluation activity. Then first party contract and third party contract. First party contract means initiate contracts whenever possible through a benchmarking contract designated by a partner company. Direct permission will be taken, and principle of third party contract means obtain an individual's permission before providing their name in response to the contract request. You are giving your information is a first party, you are giving someone else's information is a third party. Principle of preparation, demonstrate commitment to the efficiency and effectiveness of benchmarking process with adequate preparation at each process stop. That means your preparation has to be done in a much more professional manner. Finally, we have performance measurement of a non-profit organization. The problem is if it is a profit organization, benefit can be quantified in terms of profit, but here non-profit it is, so benefit cannot be quantified. It may take a longer period of time to realize the benefit because it's a non-profit one. So for any charitable organization, you cannot evaluate the growth, you cannot evaluate the performance based on profit because there is no profit. So the real strength of the organization, real trust of, real faith, real strength of the NGO or that trust you will realize once it grows. Initially there were only 30 people who were donating, now there are 3,000 donors. So that shows the strength, that shows that can be used to evaluate the performance. Value for money framework. Value for money framework. Now, when you have a trust, see the effectiveness of the work which have been done. If you are donating, if you are working a old age home, what exactly have you done? Was that required? So the effectiveness is important. Efficiency is important. Are you doing it in a much efficient manner, or you can arrange 50 crores and you are arranging only 40 crores? That means there is something lacking. And then you have economy. Whether the desired output has been obtained using the lowest cost. Of course, the cost has to, see, there is no revenue. So you will have to minimize your cost because money saved is money earned. So again, you can take the balance scorecard concept only. So that is customer, financial, internal process, and this is innovation and learning. This is related to employees, humans. So here we go, guys. We have discussed all the theory concepts. There are many questions available. As I told you, it is not possible to revise those questions because first of all, those questions are of repetitive nature. So what you can do is you can pick up 1 or 2 questions after every concept. Just go through those questions and your things will be taken care of. So just watch these lectures to know the concept. Once you know the concept, rather than reading the concept, you can directly go for question answer session. So that was your entire revision of your SCMPE. Time constraint is such that we cannot cover all the chapters, all the I mean, of course, major chapters are already covered, but we cannot cover all the questions because this has to be done on the last day. So this is just to give you an overview and gist of the entire SCMPE in a shorter time, so that it can help you out as a guide on the last day, or probably even one day before the exam, or anywhere, wherever you want to revise it quickly. All theory concepts are revised. Questions, due to time shortage, we cannot cover all the questions. We have already done that in the classroom though. So go through those lectures on the dashboard for questions. If you have any doubt, you can contact us. We have online products also. So if you want to buy any product, you want to buy any chapter, even that is possible, you go to jkshaclassesonline.com. You have the list of chapters. If you want only standard costing, you can buy only standard costing, a nominal charge you have to pay. If you want only performance evaluation and control, the entire chapter is already there with all questions. There I have not left a single question because it was a full complete chapter. So everything is explained in detail with more examples because we had a lot of time then. You can go through that. You can buy these products if you want. We will be there on doubt solving sessions also. I will be there on helpline also. Theory helpline is with me. You can always contact me. So here we go. All the best, guys. Just do well, and I'm sure you're going to crack this. Thank you so much. This is Professor Mayuresh signing off. Thank you so much. Jai Hind.